So SFM December 25 and June 2026. So these classes are applicable until the syllabus changes. So first of all, let us see the chapters. So I have categorized the topics into three categories: A category, B category, and C category. A category, 6 topics. A category, 6 topics. So high priority, the 6 topics. If you are committed, married, if you are committed or married or employed, if you are doing job, then you have to focus only on A category topics. Okay. If you are single and isolated, then what? You can focus on A and then what? B category. So in A category and B category and C category also, I have categorized the questions in question bank into two: main and additional. Main and additional. Okay. In worst case scenario, I would expect you to practice main questions from A category. Main questions from A category. Okay. Main questions from A category. And then, if time permits, CMA final past exam papers, 10 papers. 10 papers. And in the 10 papers also, most of the questions will get repeated. Hardly 20% of the questions will be new questions. Okay. Worst case scenario. So once again, I'm repeating, worst case scenario means, I mean, if you have no time, so instead of giving up, then you have to focus on what? A category main questions, and then what? Past exam papers, CMA final past exam 10 papers. More than enough. Okay. So more than enough. So see the topics. What are the topics? In A category, securitization. So this securitization is a very small topic, theory topic, and you might get one MCQ. Might. Okay. You may get. Okay. Only one MCQ you may get. So not mandatory. You may get one MCQ. And compulsory question, theory question, 4 marks. 4 marks, 4 pages, 4 marks. You have to read the theory, only 4 pages. Hardly we discuss 1 hour. This topic we take 1 hour time. In 1 hour we can complete this securitization topic. And the weightage of this chapter is 4 to 6 marks. So this topic comes under A category because the content is very less. Content is less, so that's why this topic comes under A category. Next, security valuation. Security valuation. Security valuation. So security valuation, you will get 2 7 marks. You will get 2 7 marks and 1 to 2 MCQs. 1 to 2 MCQs. So 1 to 2 MCQs, and this is a practical topic. So already you might have completed business valuation. So you will find similar kind of questions because this is a valuation concept. Here we are going to value security. Security includes equity shares, preference shares, and debentures. So in security valuation, we have two parts: equity valuation and bond valuation. You will get one question from equity valuation, one question from bond valuation. Next, portfolio management. Portfolio management. So portfolio management, so very important topic, portfolio management, because if you, without knowing the portfolio management topic, we cannot understand the mutual funds, derivatives, and security valuation. There is a link. So there is a link. So that's why the portfolio management is the base for SFM. So the weightage of this chapter is 14 marks descriptive, 2 7 marks questions, 2 7 mark, and 3 to 4 MCQs. You will get 3 to 4 MCQs, multiple choice questions. Okay, and for those 3 to 4 multiple choice questions, you need not prepare separately actually. If you do the practical questions, with that practical knowledge, you can solve those MCQs, multiple choice questions. Next, mutual funds. Mutual funds, you will get 1 7 marks question and 1 to 2 MCQs. 1 to 2 MCQs. Derivative analysis and valuation, nothing but derivatives. We call it as derivatives, derivatives chapter. Again, this is important topic, derivatives, 14 marks. You will get 2 7 marks question. 2 7 marks and MCQs 3 to 4. You will get 3 to 4 MCQs, multiple choice questions. So digital finance is a theory topic. Digital finance is a theory topic. Digital finance is a theory topic, okay? And again, this is A category because you will get compulsory 1 MCQ. Sometimes you will get 2 MCQs and 1 descriptive theory question. The last question of SFM will be theory question. The last question will be the theory question, and they will ask 3 theory questions. 5 and 4. Total 14 marks. So securitization 4 marks, 5 marks digital finance, 5 marks digital finance. So the content will be very less in digital finance. Content will be very less. So that's why this topic comes under A category. A category. That means a worst case scenario. I'm talking about worst case scenario. If you read at least securitization and digital finance theory topics, you can score 4 plus 5, 9 marks from the theory question. 9 marks from the theory question. Forget about the other theory question. Even if you at least, okay, you read a securitization and digital finance, you will be able to score 9 marks. Okay, 9 plus, at least if you are able to solve one descriptive question. So 14 plus 9, 23 plus MCQs. You can easily get 40 marks. That is worst case scenario. So, and to complete this securitization and digital finance, we will be taking 2 hours maximum, 2.5 hours. 2 theory topics. Okay. So that means in A category, we have only 6 topics, and out of 6 topics, there are 2 theory topics, and that means only 4 are the problematic. 4 practical. What are the 4 practical topics? Security valuation, portfolio management, mutual funds, derivatives. Okay. In this first portfolio management is the order, portfolio management, and then derivatives, and then mutual funds, and then we move on to the security valuation. Security valuation. Okay. So these are the A category topics. In worst case scenario, I would expect you to focus on A category topics. So A category topics weightage 78 to 88 marks. 78 to 88. Okay. Next, B category. Evaluation of risky proposals for investment decisions. Evaluation of risky proposals for investment decisions. So this is advanced capital budgeting. This is an extension to the investment decisions. You know the capital budgeting topic. You might have came across in CMA Inter. So this evaluation of risky proposals for investment decisions is an extension to the capital budgeting. So why this topic comes under B category? Because you will get only one descriptive question. You will get only one descriptive question, and at the same time, so there are a lot of questions. You have to spend more time. And to solve this evaluation of risky proposals chapter, first you must have a knowledge of investment decisions. So this topic comes under B category because weightage is 7 marks, and the content wise, it will take some time. So that's why. And the Forex weightage, Forex 14 marks. Forex weightage 14 marks, 2 7 marks questions. You will get 2 7 marks. You will get 2 7 marks, and 1 to 2 MCQs. 1 to 2 MCQs, and MCQs always they will be asking a basic MCQ. Basic MCQ. Hardly if you can solve 4 MCQs, out of 4 you will get 1. Same concept. So Forex, you will get 1 to 2 MCQs and 2 7 mark questions. 2 7 marks. Okay. International Financial Management, IFM, International financial management. This is mostly a theory topic. You will get one theory question, 5 marks. But why it is B category? Because content wise, it will take time. Content wise, it will take a time. Okay. So, so IFM. So 5 marks, theory. IFM is a completely theory topic. So even though there are 1 to 2 practical questions, they are not asking a practical question, they are asking a theory question. So IFM, International Financial Management, 5 marks. Next, interest rate risk management. Interest rate risk management. So in new syllabus till now, in out of 5 attempts, so they haven't asked any question from interest rate risk management. I'm expecting this question. I'm expecting question from this chapter, but they were not asking. In old syllabus, they used to ask, but now in new syllabus, they were not asking a question from interest rate risk management. Okay, but they might ask a currency swap question. So interest rate risk management, actually it is a part of a derivatives. It is a part of a derivatives. So these topics comes under B category. Next, C category. C category, investment decisions. Investment decisions weightage 7 marks. You will get 7 marks question and 1 MCQ. You will get 1 descriptive question and what? 1 MCQ. 1 MCQ. 1 descriptive and 1 MCQ. So then why it is C category? Why not B category or A category? Investment decisions. Because investment decisions already you came across in CMA Inter. First point. Second point. Why it comes under C category? Because you will get only 1 7 marks question and there are a lot of concepts to be learned. Discounting techniques, non-discounting techniques, ranking conflict. So resolving the ranking conflict, there are a lot of concepts. And next point is always they will be asking a new question. For suppose if we are practicing 20 questions, so in exam you will find 21 question. For suppose if you are practicing 50, you will get 51. I mean there is no boundary. Okay, capital bursting. Last time they have asked a question from CA Inter study material. CA Inter past exam question, and that too in suggested answer there was a mistake. CA Inter suggested answer there was a mistake, but so I don't know how they are asking that such kind of a questions, and always you will get a new question. So that's why. So instead of wasting time on investment decisions, better you focus on A category topics. So that's why investment decisions what C category. Leasing decisions also the C category topic, because once again the leasing decisions the same reason. Okay, for the last 2 attempts, so questions were asked from super 50. Okay, but I would say completely that is luck. In IFM also I have guessed the foreign bonds question, theory question. The theory question was asked, but that is completely luck. IFM and leasing decisions, so that is completely luck. But whereas portfolio management, there is no scope. I mean, they cannot ask beyond the super 50 questions. Definitely you will get question from what? Super 50 only. Okay. Leasing, there is a chance that they might ask a question beyond. Security analysis, a completely theory topic. They are not asking any question. They might ask 1 to 2 MCQs, and that 1 to 2 MCQs also, they will be little bit complicated and they will be asking out of the way. So that is what I have told. You will be able to answer what? 13 MCQs. So that is the best case scenario. Best case scenario. Security analysis, completely theory topic, a lengthy topic. So instead of wasting time on security analysis, you better focus on A category. Okay. So or else what? You can focus on business valuation or cost audit. So this is the categorization. So total we have a 13 topics. Total how many topics? 13. Total 13 topics. And what are the 13 topics? So first A category 6 topics. Out of 6 topics, 4 practical, 2 theory. So that means hardly you should focus on what? 4 chapters. Even if you focus on 4 chapters, that would be fine. but conceptual understanding is very important. So without understanding the concept, by hearting, you cannot solve these questions. So conceptual clarity is very important. The next B category, there are three topics. Evaluation of risky proposals, Forex. Sir, Forex weightage is 14 marks. You will get 1 to 2 MCQs. Then why it comes under B category? Because it will take time to learn the Forex concepts, and some students may not be able to understand for the first time. Okay, so some students, they have to listen to the class at least 2 times. So they will get confused. At the same time, it will take time for practicing those questions. So that's why I have categorized the Forex into B category. Okay. So C category, three topics. C category, how many topics? Three topics. Investment decisions, leasing decisions, security analysis. Once again, I'm giving the reasons because some students they're asking in Telegram group. Sir, investment decisions, they frequently they're asking 7 marks question. Then why it is categorized under C? Because simple reason, even though they are asking 7 marks from investment decision, why it comes under C category? Simple reason. Always they will be asking what some new question. If you have a concept, then you will be able to attempt. I would not say you will be able to correct. I mean, attempt 100%. At least you will be able to attempt. That's it. Okay. So that's why that comes under what? C category. Even leasing also. Why leasing categorized under C category? For example, so in June 2024 attempt. So okay, they have mentioned the word wet lease. Wet lease. Wet lease. Wet lease means lessor is responsible for maintenance of a asset. Generally, lessee is responsible for maintenance of a asset, but wet lease means what? Lessor is responsible for maintenance of a asset. Okay. So, but there is no such kind of a word in board material. How the student will be able to do such kind of a questions? Because there is no such kind of a word wet lease in entire study material. Wet lease. Okay, even I don't know what is wet lease. After seeing the question examination, so I came to know wet lease means what? So lessor is responsible for maintenance of a asset. So such kind of a questions will be asked. So that's why what? So from B and C category, what we do is we solve the questions which are from Super 50. A category main questions. A category main questions. And then what? Solve the questions from Super 50 for B and C category. Clear? So for C category topics also, I would be giving two. I mean, for leasing, I will be guessing 2 or 3 questions. You do those 2 or 3 questions, that would be enough. And for B category also the same. Okay. So clear. So these are the topics. Total, how many chapters we have? 13 chapters we have. So out of 13 chapters, so the most important topics are portfolio management, derivatives, mutual funds, security, valuation, and theory topics, securitization and digital finance. Securitization and digital finance. Am I clear? Okay. So without wasting time, let us start portfolio management. Portfolio management. So before starting a portfolio management, so what is our subject name? Strategic financial management. Strategic financial management. So in CME inter level, you discussed financial management, yes or no? So financial management, two aspects are procurement of fund, effective utilization of a fund, procuring fund and utilizing the funds. And what is the main object of financial management? The main object of a financial management is to maximize the wealth. Maximize the wealth of a shareholders. That is the main objective. Maximization of a wealth of a shareholders is the main objective. Okay. So to maximize the wealth of a shareholders, the finance manager has to take 3 decisions in FM. So what are the 3 decisions? Investing decision, where to invest money. Financing decision, from where to get money, from where to get money. Next, what? Dividend decision, whether to declare a dividend or not, whether to declare a dividend or not. So these are the three important decisions in financial management. What are the three important decisions in financial management? Investment decision, financing decision, dividend decision. So that is financial management. So the financial management, the basic objective is to maximize the wealth. For that matter, not only the financial management, here whatever the subject we are learning in CMA, all subjects objective is to maximize the wealth. Okay, you're learning direct taxes, indirect taxes, you're learning SCM. So even SCM objective is also what? To maximize wealth. Of course, in examination we write a competitive advantage, superior performance or something. But the ultimate objective is to what? Maximize the wealth. Here also SFM. So any business objective is to maximize the wealth. So SFM, to do any business, so we need three fundamental essentials. Okay. So to do any business, we need three fundamental essential elements. First, we should have a financial resources. We should have a financial resources. We need money. Yes or no? So what is the basic essential of a business? Basic essential. First, money. Money is very important. Nothing but financial resources. Financial resources. The basic essential of any business is financial resources. Yes or no? Okay. So what is the second? For example, there is a financial resource. There are financial resources. There are financial resources. For example, Bhargav, he is a crorepati. He is having a money. He wanted to do a business. He wanted to do a business. He has a financial resources. But is the financial resources enough to do a business? We need a right management team. Right management team. Yes or no? For suppose if there is no right management team, then obviously what happens? The business will fail. Even though we have a financial backup, if there is no right management team, then obviously business will fail. Yes or no? So that's why the first essential of a business is what? First essential of business, financial resources. What is the second essential? Management team, right management team, right management team. For suppose we have a right management team, right management team, we have a financial resources, but still what else we require? For example, Nokia. Right now Nokia is leading or not? Nokia is not leading. Yes or no? Once upon a time Nokia was leading company. Yes or no? So why right now the Nokia was not in leading position? Because because simple reason, there is no innovation. Yes or no? There was no innovation. So simple, they do not have any strategy, clear and realistic strategy. Strategy means a long term action plan. Long term action plan strategy. So a business to become successful, there should be a strategy, and that strategy should be what? Clear and what? Realistic. Clear and realistic. Are you getting my point? So that has to be clear and what? Realistic. For example, Bhargav, he wanted to do a business. He has a strategy. What is the strategy? He wanted to do a real estate business. Okay, he wanted to do a real estate business, not on earth. He wanted to do a real estate business on moon. Okay, is it realistic or unrealistic? Unrealistic. Okay, ఎందుకని? ఈవెన్ ఇఫ్ భార్గవ్ ఎలాగోలా కష్టపడి మూన్ పైకి వెళ్ళినా, మనోడు లేఅవుట్లు వేసినా జనాలు రావాలి కదా అక్కడికి. సో దట్ ఈస్ వాట్ unrealistic. Yes or no? So the strategy should be clear and realistic. Strategy should be clear and realistic. Nothing but the business to become successful, three fundamental essential elements. First one, finance. Second, management strategy. Nothing but strategic financial management. అలా మన సబ్జెక్ట్ కలిపేశారనమాట మన వాళ్ళు. అర్థమవుతుందా? సో మన సబ్జెక్ట్కి అలా కలిపేశారు మన వాళ్ళు. సో ఎనీ బిజినెస్ టు బికమ్ సక్సెస్ఫుల్ వాట్ దెర్ షుడ్ బి ఎ స్ట్రాటజీ, there should be a finance, there should be a right management team. So that's why we are going to learn what strategic financial management. Strategic financial management. And the basic objective of strategic financial management is to maximize the wealth of our shareholders. If you become a CFO, okay, CFO. So the basic objective is to what maximize the wealth of our shareholders. To maximize the wealth of our shareholders, you are going to take a four types of a decisions: investing decision, where to invest money; financing decision, from where to get money; and next what, dividend decision, whether to declare a dividend or not; and next, portfolio decision. Portfolio decision. So portfolio decision is also a part of a financial management, SFM, strategic financial management. So four types of a decision. So you already know three types of a decision. Investment decision, you know, you have already, okay, learned capital bursting in CM interest or no. So you know how to take investment decision. Second, financing decision, you know how to procure money, you know the cost of a capital chapter, capital structure, leverages, etc. Yes or no? And next, what, dividend decisions, you know Walter model, you know Walter Gordon model, Modi Gilani Miller. Yes or no? You know when to declare a dividend and when not to declare a dividend. So the fourth type of a decision we are going to take in SFM is portfolio decision. Portfolio decision. Okay. So here portfolio means, general meaning is portfolio, two or more assets. Two or more assets. That can be any asset. That can be any asset. Okay, portfolio means what? Two or more assets. But whereas here in our SFM, portfolio, two or more securities. Two or more securities. Securities means shares, debentures. Okay, here portfolio means what? Two or more shares or two or more debentures. Two or more debentures. But general meaning of a portfolio is what? Two or more assets. Okay, two or more assets. Nothing but, so portfolio management. Why we should learn this portfolio management chapter? As a cost accountant, why we should learn this chapter? The simple reason, for suppose you may be appointed as a fund manager of any mutual fund company. You may be appointed as a fund manager. Fund manager. So what is the responsibility of a fund manager of a mutual fund company? Fund manager has to analyze the securities of a various companies in the market. Fund manager responsibility is to analyze the securities of various companies in the market, and he should select the best securities for investment. Okay, and fund manager has to make an investment on behalf of investors. You know the concept of mutual funds, right? You know the concept of mutual funds. So one thing, public can directly invest in stock market. Public can directly purchase Reliance shares. Public can directly purchase Wipro shares. Yes or no? Okay, so that is retail investment. That is retail investment. An individual will be buying one share, two share, or 10 shares, or 100 shares. That is a retail investment. But if an investor wants to make an investment in stock market, first he require time. First he must have a time, and the second he must have a knowledge. He should know how to analyze the security, how to select a security. He should know how to select a security. Yes or no? What is the prerequisite to make an investment in stock market? For suppose Bhargavi is having money, okay, fine, he is having money. He want to make an investment in stock market. So what is required? First of all, time. First of all, what? Time. He has to go through the business newspaper daily, business news, yes or no? He has to invest time. Second one, most importantly, more than a time, he require what? Knowledge. He should know how to select a security. He should know how to select a security. Yes or no? So Bhargav, he is a software employee, let us assume. If he is a software employee or if he is a doctor, practicing doctor or something, if he is having a surplus money, okay, he wanted to make investment in stock market. The drawback is what? He will not be finding time to analyze the security. And second point, even though he is having time, he cannot analyze the security due to lack of knowledge. So that's why what they will do is, these kind of retail investors will be investing in mutual funds. Mutual funds. Now the mutual funds is a custodian. Mutual funds is a custodian. Mutual fund will be appointing a fund manager. Mutual fund will appoint a chartered accountant or a cost accountant or a CFA, chartered financial analyst, as a fund manager. And this fund manager, for suppose Manasa is a fund manager. Okay, so Manasa, she will be analyzing the securities in the market and she will be making investment on behalf of investors. Are you getting my point? Ardona, SBI mutual funds, SBI mutual funds will be appointing Manasa as a fund manager. Are you getting my point? So who will invest money in SBI mutual funds? Public. Public will be investing money in what? Mutual funds. You know the concept of SIP, systematic investment plan. So every month 1,000 rupees. Every month they will be investing 1,000 rupees in SIPs, and this amount SBI mutual fund will be investing in a stock market on behalf of investors. So SBI mutual funds require what? Cost accountants or a chartered accountants to analyze the securities. So that's why as a cost accountant, you should know how to analyze the security, how to select the securities for investment. How to select a security for investment. Are you getting my point? Okay. So that's why we are learning this chapter. The ultimate objective of this subject is what? Wealth maximization. Your objective is what? Wealth maximization. So మీ ఫ్రెండ్స్లో కూడా చాలా మందిని చూసుంటారు. Some people, they have started their own. So they are pooling money from friends and they are investing on behalf of them in the stock market. You might have seen someone. Okay. So that is a concept of a mutual fund. Actually mutual fund చేసే పనే. ఇప్పుడు ఏం చేస్తున్నారు? Individuals have started on their own, practicing chartered accountants or some semi-qualified CAs or CMAs also they have started. So they will be asking money from the public, friends and relatives, and they will be investing money in the stock market on behalf of the friends and relatives. Okay. So, but here the fact is what? Only 97%, only 3% of our retail investors are making profit. Only 3%. 97% of retail investors are making losses in a stock market. So that's why stock market addiction అనేది కరెక్ట్ కాదు. Even though okay, you know the analysis, everything, but everything will get influenced. Okay. So that's why only 3% of the stock market investors, I'm talking about retail investors. Retail investors, they are able to make a profit of only 3%. Out of 100, 97% of the retail investors are losing money. Only what? 3% are making money. Only 3%. Okay. If you have a surplus, you can make investment, but by taking debt and making investment in stock market is not advisable. So the point is, here a chartered accountant or a cost accountant will be appointed as a fund manager. So they should know how to select a security. How to select a security. So portfolio means what? 2 or more assets. Portfolio means 2 or more assets generally. Okay. So why do we make portfolio investment? Portfolio investment. Portfolio investment. So portfolio investment means, for suppose, even in our family, father or a mother, they will be making a portfolio investment. Maybe our families might be middle class or lower middle class. So, but generally upper middle class or a rich people, they will be what? Making a portfolio investment. Portfolio investment means what? Example, they will be buying a commercial land. Commercial land means land in the town, land in the town or a city. Okay, commercial. And they will be purchasing what? Agricultural land as well. Agricultural land as well. They will be holding lands in Hyderabad and Amravati, both. So, and Vizag also. Why? What is the purpose of holding the land at three places? Why? For example, if they are going to lose money in Hyderabad land holding, they may get benefited in what? Amravati. Okay. So, for example, depending upon the party, the capital of Andhra is changing, yes or no? Earlier, our capital was Vizag. Now, our capital is what? Amravati. So, after 2021, we don't know which is our capital, yes or no? 2029. So, the point is what here. So, if for suppose right now what Amravati is our capital, the obviously land price will what increase. Vizag land price will decrease. Okay. So, and people will be buying the gold also. People will be buying what? Gold. So nothing but what? I'm talking about rich people. So if they have a surplus cash, they will be what? They will be making a investment in portfolio. So they will not be investing in one single asset. They will be investing what? Two or more asset. Why do they invest in two or more assets? What is the purpose? Simple reason, to diversify the risk. To diversify the risk. You should know the meaning of a risk. Risk means possibility of occurrence of loss. Risk means possibility of a occurrence of a loss. Risk means possibility of a occurrence of a loss. Okay. So general meaning, risk means a possibility of occurrence of a loss, or we can call it as uncertainty, or we can call it as possibility of a deviation from the mean. Possibility of deviation from the mean. Possibility of deviation from the mean. Okay. Risk means what? Possibility of occurrence of a loss. Possibility of occurrence of a loss. For suppose Manasa is jumping from fourth floor. That means what? She is taking risk or not? She is taking risk. Yes or no? Why? There is a possibility of occurrence of a loss. There is a possibility of what? Occurrence of a loss. Yes or no? Okay. For example, Sai Krishna, he is going opposite to the train. He is walking opposite to the train. Taking risk or not? Taking risk or not? There is a possibility of what? Occurrence of a loss. Adhodna. So we cannot say there is a possibility. There is a possibility. High possibility. There is a high possibility. There is a high possibility of a occurrence of a loss, because Manasa, she is jumping from what? Fourth floor. There is high possibility of occurrence of loss. That doesn't mean definitely the loss is going to occur. There is a high possibility. సో దెర్ ఈజ్ 1% ఛాన్స్. మేబీ ఇక్కడ నుంచి జంప్ చేస్తే ఏంటి, సన్నగా ఉంది కాబట్టి గాల్లో తేలుతూ అలాగా కింద పడవచ్చు. దెర్ ఈస్ నేను చెప్తుందండి 0.001% ఛాన్స్. ఓకే, అర్థం అవుతుందా? లేదా యమదంగుల ఎన్టీఆర్ లాగా ఏ ట్రీ మీద పడి అలా స్లోగా ఏంటి పడవచ్చు. ఓకే, సో దెర్ ఈస్ 0.001% ఛాన్స్, బట్ దెర్ ఈస్ హై పాసిబిలిటీ ఆఫ్ వాట్? Occurrence of a loss. Likewise, Sai Krishna walking on opposite to the train. There is a high possibility of what? Occurrence of a loss. But కరెక్ట్గా యాక్సిడెంట్ అయ్యే టైంకి కాజల్ అగర్వాల్ వచ్చి లాగేసింది మనండి. ఐ మీన్ 0.001% ఛాన్స్. రాదు అమ్మాయి, బట్ వస్తే లాగితే అర్థం అవుతుందా? So the point is there is high possibility of occurrence of a loss. Risk means what? Possibility of occurrence of loss. Okay. So when you join CMA course, somebody might have told you why you are taking risk. Why are you joining CA or a CMA course? Why are you taking risk? Yes or no? So they might have told you no. So what is their perception? Why their perception is what there is a possibility of occurrence of a loss, failure. There is a possibility of occurrence of a failure. If somebody is getting married, you will say why you are taking risk. Yes or no? And after marriage, if they are going to honeymoon to Meghalaya, then you will say what? The risk is increasing or decreasing? If they are going to Meghalaya, the risk is increasing, yes or no? So that too via Air India flight, high risk. So the point is what here risk means what a possibility of a occurrence of loss. Possibility of a occurrence of a loss. For suppose if you are investing your first salary in stock market, then your friend will say, why are you taking risk? Why are you taking risk? So what is the perception? They're saying why you are taking risk? Why you are taking risk? What is that meaning? Why you are investing your money in stock market, your first salary, you might incur loss. So risk means what? A possibility of occurrence of loss. మనం ఏం చేసినా రిస్క్ ఉంటుంది. ఖాళీగా కూర్చున్నా రిస్క్ ఉంటుంది, హార్ట్ అటాక్ వస్తుంది, పరిగెట్టినా వస్తుంది. సో రిస్క్ అనేది ఏంటి? డిపెండ్స్. రిస్క్ ఏంటమ్మా? డిపెండ్స్. అండ్ అగైన్ రిస్క్ డిపెండ్స్ అపాన్ అ పర్సెప్షన్. రిస్క్ డిపెండ్స్ అపాన్ పర్సెప్షన్. రిస్క్ డిపెండ్స్ అపాన్ అ పర్సెప్షన్. రిస్క్ డిపెండ్స్ అపాన్ పర్సెప్షన్ అంటే so for you CMA might be risky course. For some other person what this might be a non-risky. This might be what? Non-risky. Are you getting my point? So risk depends upon a perception. Risk depends upon perception. Perception అంటే అర్థమైందా మీకు? సో ఇప్పుడు నా పర్సెప్షన్లో ఎస్ఎఫ్ఎం రిస్కీ అంటారా నాన్ రిస్కీ అంటారా? నా పర్సెప్షన్లో నాన్ రిస్కీనే, నా పర్సెప్షన్ అది. But your perception may be different, yes or no? My perception SFM is not risky and even CMA is also not risky. That is my own perception. But your perception is what? Entirely different. Your perception is entirely different. So the risk depends upon what? Perception. So why we are talking about this risk topic? Because portfolio means what? Two or more securities. Two or more securities. Combination of a securities. Portfolio is a combination of a securities such as stocks, bonds, money market instruments. Money market instruments means an instrument which is having a maturity less than 1 year. So treasury bill maturity less than 1 year. Treasury bill will have a maturity less than 1 year. So portfolio is a combination of a securities such as what? A stock, bond and what? Money market instruments. Money market instruments. Clear? So why we should learn this portfolio management topic and what is this portfolio investment? Why should we should make a portfolio investment? Why we should make a portfolio investment? So we have already discussed. For suppose if we are holding a land in Hyderabad, Amravati and Vizag. So why the purpose? I mean, why we should hold a land in 3 areas? Even if we get loss in one place, we will get benefit in the other 2 places. The other 2 places, yes or no? So nothing but what? If we make a portfolio investment, the risk will get diversified. The risk will get diversified. The possibility of a occurrence of a loss will get reduced. The possibility of a occurrence of a loss will get reduced. Yes or no? Although the possibility of occurrence of a loss will get reduced. మీకు అర్థమవుతుందా భార్గవ్? Okay, so portfolio investment. If you're making investment in two or more assets, there is a possible reduction in, there is a reduction in possibility of a occurrence of a loss. Clear? Possibility of occurrence of a loss. So likewise here securities also. For example, if you see the ITC company has got diversified into several businesses, yes or no? So what are the ITC products? ITC classmate notebook, yes or no? Classmate notebook. Next, hotels, hospitality. Next, tobacco, cigarettes. Next, FMCG, Vivel shampoo, Sunfeast, ITC Sunfeast, dark fantasy. Yes or no? ITC Mangaldeep Agarbatti, Ashirvad. ITC Ashirvad. So they have got diversified into several products. Yes or no? For suppose if a government, originally they used to manufacture what? Tobacco products. Originally they used to manufacture what? Tobacco products. For suppose the government, if it is banning the cigarette, still the ITC company will not get affected. Why? Because there are several other products, yes or no? Even if cigarette is banned, then what? They have Mangaldeep Agarbatti. Okay? So that cannot be banned, yes or no? So the point is, even if cigarette is banned, there is no issue. For suppose classmate notebook is banned, example. Okay? So usage of paper is not environmental friendly, so that's why the notebook has been banned. Even then what? They will not get affected because they have several other products. Clear? So nothing but what? Less risk because they got diversified into several products. So if you are depending upon only one line of a business, for suppose you have taken a tender for a wine shop, okay, so that is risky. Why? For example, if government changes, if state government changes, then what? The policy will change, and the people who has taken a tender for wine shop will get loss. So whenever, I mean, if you're relying only one business, then what? There is a high possibility of a occurrence of a loss. Likewise, if you are investing in one single security, okay. So if you are investing in Reliance, one single security, then what may happen? So there is a high possibility of a occurrence of a loss. If something happens to Mukesh Ambani, then share price might get affected. Yes or no? Yes or no? So if a government puts some regulations on that particular industry, then also what? The share price will get affected. So that's why the purpose of the objective of a portfolio management is to reduce the risk. What is the chapter objective? The chapter objective is to learn how to reduce the risk, how to diversify the risk. First we should know how to calculate the risk, and then we should know how to diversify the risk. So the chapter theme in this chapter we are going to learn how to calculate the risk and how to diversify the risk. How to diversify the risk. Sir, why are we talking about the risk topic? Why the risk is relevant? Why risk is so relevant? So what is our objective? Objective of any business is to what? Maximize wealth. Objective of any business is to maximize the wealth. Okay. So there are two objectives: profit maximization, wealth maximization. But the superior objective is what? The superior objective is wealth maximization. What is wealth maximization? Profit maximization is different from wealth maximization. Profit maximization is different from wealth maximization. Okay. So if a profit is increasing, that doesn't mean wealth is also going to increase. Profit is different, wealth is different. Profit is different, wealth is different. For example, the rental income you receive on a building, the rental income you receive on a building is a profit. Wealth means the building value. Building value is the wealth. EBIT of a business is a profit. EBIT of a business is a profit, but the value of a firm is a wealth. Value of a firm is a wealth. In business valuation or a cost of a capital or a capital structure, you might have came across value of a firm is equal to EBIT divided by KO. EBIT divided by KO. So value of a firm. Wealth is different. Wealth is different. For suppose if you have a farmland, how much profit are you getting? That is the question. You will say what 1 lakh or 2 lakhs. If I ask you what is your wealth, you will say 5 acres or 6 acres. Yes or no? So wealth is different from profit. So the superior objective of a business is wealth maximization. Your perception might be what if a profit increases, wealth will also increase. No, wealth depends on two factors. Wealth depends on two factors. One is the profit, the second one is risk. Second one is what? Risk. If a profit increases, wealth increases. But if risk increases, wealth decreases. If risk increases, wealth value decreases. If risk increases, what happens to the value? This is the fundamental of a SFM. Fundamental of a SFM. So which is the superior objective? Wealth maximization, no doubt. So in this chapter, mainly we are going to discuss about what? Risk. Risk. We are going to learn how to calculate the risk. So we are going to learn how to calculate risk and how to diversify the risk. How to diversify the risk. Okay. So why we are talking about risk is the question. Because the objective of a business is to what? Maximize the wealth. So this is very fundamental of a SFM. You have to learn this. You have to remember, retain. Wealth depends on how many factors? Wealth depends on two factors. What are the two factors? Risk and next what? Profit. Risk and profit. Wealth depends on two factors. One is risk and the second one is what? Profit. If a profit increases, profit increases, wealth increases and vice versa. If a profit increases, wealth will also increase and what? Vice versa. If a profit increases, wealth increases and what? Vice versa. Yes or no? For example, so there is a land which is giving 1 acre land is giving a revenue of a 1 lakh per annum. And there is another land, another property which is giving a income of a 10 lakhs per annum. Which land will be having a more value? First one or second one? Are you getting my point? But suppose we have a two properties. One property is giving 1 lakh rupees benefit every year. Second property is giving a benefit of 10 lakhs every year. So which property is going to have a high value? Second property is going to have a high value. Why the second property is going to have a high value? A simple reason. Simple reason because second property is having a high profit. Simple. For suppose, so this building, same building, let us assume it is located in some Ongole or something. You will get same rent or different rent? Different rent. When compared to Hyderabad, rentals in Ongole will be less or high? Less. Which building will have a more value? Hyderabad building or Ongole building? Hyderabad building will have a more value because if a profit increases, wealth increases. Wealth increases. Yes or no? So next, if risk increases, so this you might have came across in business valuation also. For business valuation also, this is the fundamental. If risk increases, first of all, the required return will increase. Required return, expectation will increase. Required return. If risk increases, required return, nothing but expectation will increase. For example, K is equal to RF plus RM minus RF into beta. K is equal to RF. RF means a risk-free rate of a return. At zero risk, you want RF. At zero risk, you want RF. As you are taking a risk by investing in equity share, you are expecting RF plus RM minus RF into beta. For suppose beta is equal to 0, then your expectation is equal to RF. If a beta is equal to 1, then your expectation is RF plus RM minus RF. Nothing but RF will get cancelled and your expectation is RM. Market return. Market return. Yes or no? If a beta increases, then what happens to the K? K will increase. K will increase. Yes or no? So you might have came across D1 divided by K minus G formula in business valuation. D1 divided by K minus G. So first of all, if risk increases, required return, expectation will increase. For example, BCom student and CMA student, who will expect more? Who will have a more expectation? BCom student will have a more expectation or a CMA student will have a more expectation? Degree student or a CMA student? CMA student will have a more expectation. So why CMA student will have a more expectation? Because more risk. If you're taking more risk, you will expect what? More return. When the expectation increases, what happens to the value? Value decreases. If expectation increases, what happens to the value? If expectation increases, what happens to the value? So let me give an example. So these days, everybody, I mean, most of the people what will be in depression, yes or no? At 11 o'clock or 11:30, they will be putting a status, start status. These days, yes or no? So you might have seen in Instagram, especially Gen Z. So they will be keeping a sad status at 11:30, feeling lonely or something. You have seen or not among your friends? Okay, you have seen that such kind of a status or not? Okay. So even you also, if you're questioning yourself, you might be feel, I mean, sad. I mean, might be feeling some sadness or depression sometimes. So the reason might be what? The reason might be something. So let us compare with the previous generation. The previous generation and this generation. The previous generation they used to have a non-veg once in a month. They used to have a non-veg food once in a month. Yes or no? Now daily once. Yes or no? Daily once, twice, or thrice also. Okay. So the previous generation they used to watch movie in Doordarshan on Sunday. Okay. So this generation they are watching re-release. Yes or no? They are watching a new release at the same time what re-release also, and re-release of any kind of a movie also they are watching. Yes or no? Yes or no? Okay. And the previous generation they used to walk 2 kilometers or 3 kilometers to catch RTC bus. This generation what? Uh, so feeling lazy. I mean, we cannot go down and pick the food also. That's why we are ordering food in Zomato or a Swiggy. And what? Even after going down, we are booking Rapido bike or something. Yes or no? But still, this generation is what? Unhappy. When you compare this generation with previous generation, this generation is what? Unhappy. This is the fact, as per my observation. So why the reason? Because they have a too much of expectations on a life. Everybody is having a smartphone. Everybody is having a smartphone. Earlier there was no smartphone and nothing. Yes or no? So these days what we have everything, but still what the value of a life is less. Value of a life is less. The reason is what the expectations have got increased. Expectations have got increased. If expectations have got increased, then what happens to the value? The value decreases. Value decreases. Depends upon perception. Again, the value depends on perception. Risk depends on perception. Expectation depends on perception. And the value also depends on perception. Value depends upon perception. Okay. In my perception, so for suppose some asset is having some value, in your perception the asset will have a different value. Okay, so the value depends upon a perception. So that's why you will be important for someone and you are nothing for someone. Are you getting my point? Your value is different for different people. You are a most valuable person for your father and mother, and you are nothing for someone. Yes or no? So that means what? The value depends upon what? Perception. Value depends on perception. Okay, if your expectations are low, the value will increase. So generally, if risk is low, expectations will also be low, and if expectations are low, then value will be high. Okay, so our objective is to keep the risk low, so that what happens to the wealth? Wealth will increase. Are you getting my point? Okay, so that's why, for suppose, I mean, father, I mean, what is your name? Varun. So Varun, for example, Varun's a family expecting Varun to get a All India first rank. Family expecting what? All India first rank. Their expectation. Their expectation. For suppose Varun has got 39th rank. Will the family feel happy or not? No. Because their expectation is what? First. He got 39th. So they may not be celebrating the moment. They may not be celebrating the moment. Yes or no? Why? Because the family expectations is too high. Expectation is too high. The family expectation is too high. So that's why what happens to the value of a Varun in perception of a family? Decreases. Value of family will get decreased. Are you getting my point? Okay. For example, Raju from Coimbatore, his father expectation is what? He should not, okay, fight with someone and go to a police station. He should at least come to the classes. He should at least come to classes is the expectation of his father. Okay. For suppose he is coming to classes regularly and he cleared one group. He cleared one group. Still father is going to celebrate. Why? Because father is having a low expectation. Father is having a low expectation. So that's why you should try to keep your family expectations very low. You should always keep your family expectations very low. You should not say I will get rank. Okay, paper ఆడిద్దాం అట్లాంటివి చెప్పకూడదు. You should keep your family expectations low, then your value will increase. Then your value will increase. అర్థమవుతుందా? సో అది అవునా కాదా మీరే ఒకసారి చూసుకోండి, ఆలోచించుకోండి. దెర్ ఆర్ సెవరల్ వీ కెన్ సే రియల్ లైఫ్ ఎగ్జాంపుల్స్, సో మెనీ ఎగ్జాంపుల్స్. ఇఫ్ ఎక్స్పెక్టేషన్ ఇంక్రీజ్, వాట్ హ్యాపెన్స్ టు ద వాల్యూ? If expectation increase, what happens to the value? If expectation increase, value decreases. Yes or no? You might have watched Coolie movie. Okay. If you have gone to the movie without any expectation, that you might have at least what? Okay. At least you might have accepted the movie. I mean, yes or no? Without expectation. But you might have gone to the movie with high expectations. హై ఎక్స్పెక్టేషన్. అలాంటప్పుడు ఏమవుద్ది, మూవీ ఒకలా ఉన్నా కానీ మనకి ఎక్కదు, ఇంకా అయిపోయింది. అదో అవుతుందా? సో ద వాల్యూ డిపెండ్స్ అపాన్ వాట్ కంప్లీట్లీ expectations. Okay. So if risk increases, what happened to the required return? Required return means expectation. What happens if risk increases? Required return. The required return increases, and if required return increases, what happens to the wealth? Wealth decreases. If risk increases, required return increases, and what happens to the wealth? Wealth decreases. So this is a basic fundamental for SFM and business valuation. You should understand the concept. Even for business valuation also, business value depends on two factors. One, the profit benefit we receive, and the second one is risk. If risk increases, required return increases, and if required return increases, wealth decreases. So that's why our objective is to what? Minimize the risk. So that's why in portfolio management, we are going to learn how to calculate the risk and how to diversify the risk. Excellent, Amabargo. So how to diversify the risk, how to calculate the risk, and second one, how to diversify the risk. Adodna. So why we are learning this topic? Are you able to understand the connection? So the objective is to maximize the wealth. So to maximize the wealth, risk has to be minimized. So portfolio decision is a part of a SFM. Portfolio decision is a part of a SFM. So portfolio decision. So in portfolio management, mainly we are going to learn how to calculate the risk of a security, and risk of a portfolio. So why we should find out the risk of a security and risk of a portfolio? Simple, we should select a security which is having a low risk. We should select a security which is having a low risk. So before taking any investment decision, we keep in mind two factors. One, the benefit we get. Second one is the risk we are going to take. So generally we want to what? Maximum benefit with low risk. Maximum benefit with low risk. Yes or no? Maximum benefit with low risk. Bhargav, yes or no? Okay. If risk increases, required return increases, and wealth decreases. Clear? So portfolio is what? Combination of a securities such as what? Stock, bonds, and money market instruments. Okay. So portfolio management involves three major activities. So we are not going going to invest blindly. Yes or no? The first one is selection of a securities based on return and risk. In market, you will find thousands of a securities. You will not be investing in thousands of a securities. You will be selecting securities based on what? Return and risk. Before making investment in any security, we consider two factors. One is the return. What is the benefit we are going to get? And the second one is what? Risk. And next, construction of all feasible portfolios with the help of selected securities. Construction of all feasible portfolios. All financially feasible portfolios. Nothing but For suppose we have for example, we selected 6 securities. We selected how many securities? 6 securities. So this is the first step. How do we select these 6 securities? We selected these securities based on what? Return and risk. Based on return and risk. Yes or no? Next, second step is what? Second step, selection of a feasible portfolios. I mean, construction of a feasible portfolio. Construction of a feasible portfolios means nothing but, for example, we decided to invest in A, B, C, D, or we are going to invest in B, C, D, E, or we are going to invest in F and A, B, C. Likewise, we construct what? Feasible portfolios. Okay, feasible combinations. What are the feasible combinations? We have selected 6 securities. So first combination is what? A, B, C and D. So we are going to invest in what? A, B, C and D. Second, or else we can make investment in B, C, D and E. Or else we can make investment in F, A, B, C. Or else, if it is feasible, we can make investment in what? A, B, C, D, E, F. Likewise, we construct a feasible portfolios. Okay, I mean, what combination has to be invested? Investment. In which combination the investment has to be made? So that we decide, that we construct. And next step is to decide the weights. Decide the weights. In which proportion we have to make an investment? In which proportion we have to make an investment? In which proportion we have to make an investment? So in which proportion we have to make an investment? Okay, in which proportion means what? We have to decide the weights also. First step is to selection of securities. First step is toward selection. Selection of our securities based on return and risk. Second step is what? Construction of all feasible portfolios. Construction of all feasible portfolios. And next, third one, deciding weights of different securities. Deciding weights. Weights means what? In which proportion the investment has to be made. Example A 30, B 30, C 20, D 20. 30, 30, 20, 20. 100 overall. 30%, 30%, 20% and 20. Or else 45, 45, 5 and 5. So we have to decide the weights. We have to decide the weights. So once we do the practical questions, you will get clarity about these points. So what is the first point? Selection of securities based on what? Return and risk. Second, construction of all feasible portfolios. Third, deciding weights of different securities. Different securities. Objectives of a portfolio management. So what is the main objective? So first, everybody is worried about what? Principal. So that's why the main objective of a portfolio management is safety of a principal amount. Mind lo enti ఎక్కడైనా ఇన్వెస్ట్మెంట్ చేసేటప్పుడు అట్లీస్ట్ యూ మస్ట్ బి ఓకే కీప్ ద సేఫ్ ప్రిన్సిపల్ అమౌంట్. ఓకే, నెక్స్ట్ స్టెబిలిటీ ఆఫ్ ఇన్కమ్, capital growth, marketability and liquidity both are same. Marketability means what? If you don't want the security, you must be able to sell the security immediately. So that's why mostly the mutual funds will be investing in a listed securities, because listed securities are marketable. Unlisted securities are not marketable. Yes or no? Mutual funds will not be investing in a private limited company. First of all, the Companies Act will not allow. At the same time, so why it is not allowing? Because in private company the shares are non-marketable. Nobody will purchase, yes or no? If they have to, only existing shareholder will be purchasing the shares. So marketability means what? Marketability or liquidity means uh, we must be able to convert this investment into cash immediately. Diversification. So one of the main object of a portfolio management is to diversify the risk. Diversify the risk. The phases of a portfolio management, we have a 5 phases in portfolio management. First one, security analysis. First, security analysis. The first step is to selection of a securities based on return and risk. Yes or no? So we select the securities based on return and risk. So that's why the first part, first phase of the portfolio management is security analysis. Second, portfolio analysis. Analyzing the portfolio, construction of all feasible portfolios and analyzing. And then what? Selecting the best portfolio out of it. Portfolio selection. Next, portfolio revision. Time to time we change the weights. Time to time we change the weights of our securities. That we are going to learn in portfolio management and derivatives chapter. So we are going to do a practical questions on portfolio revision. Portfolio revision. Portfolio revision means what? For example, we have selected A, B, C, D combination. We invested 30, 30, 20, 20. 30, 30, 20 and 20. Later on, after 6 months, after 6 months, A 20% of shares sold and this amount is invested in D. This amount is invested in D. Then the weight is A 10, B 30, C 20 and D 40 or something. Okay. So this is called what? Portfolio revision. And next, portfolio evaluation. Time to time we are going to evaluate the portfolio and we make a necessary revision. We make a necessary revision. So these are the phases of a portfolio management. So for everything we are going to do a practical question for all the phases. All the phases. Okay. So in this chapter, so we can categorize this chapter into 2 parts. In the first part, we are going to learn how to find out return and risk of a security and how to find out the return and risk of a portfolio. So in this chapter, we are going to learn how to find out return and risk of a security. We cannot directly go to the portfolio, yes or no? Because portfolio is a combination of securities. Portfolio is a combination of securities. So that's why the first step, finding out what? Return and risk of securities. From examination point of view, the first we are going to learn how to find out the return and risk of a security. And then what? How to calculate return and risk of a portfolio. So that is the first part of a portfolio management. First part of the portfolio management is return and risk of a security, return and risk of a portfolio. And second part, we have several concepts. Second part. Okay. So we can categorize the portfolio management into 2 parts. The first part, everything is linking. I mean, everything is interlinked. So without learning how to find out the return and risk of a security, you cannot understand how to find out the return and risk of a portfolio. So without understanding these two, you cannot understand the part 2 of a portfolio management. And if you cannot understand this part 2, you cannot understand what a derivatives chapter. So derivatives, mutual funds, these 3 topics, especially these 3 topics are interlinked. Portfolio management, derivatives, mutual funds. Each and every class of these 3 chapters are very important. So I've already told you, and if you're busy, if you're committed, and if you're married, or if you're already a job holder, at least try to attend what? A category topics. A category. So we have only 4 problematic: portfolio management, derivatives, mutual funds, security valuation, and 2 theory topics. Okay, so those two theory topics, even you can watch in YouTube also. So at least you try to attend what four topics. So this is the minimum expectation. I'm keeping my expectations very low. I'm expecting your attendance for at least what a category topics, so that your value will increase. Okay, so my expectation is very low. Okay, clear. So what is the first part? The return and risk of a security. So security is example equity share, bond, money market instrument. Yes or no? Okay. So are you able to understand the link? So why we are learning this chapter? For suppose you may be appointed as a mutual fund manager, then you have to analyze what security, where to invest. You have to decide where to invest. First, you have to select the securities based on return and risk. Second, what? Decide, I mean, construct a feasible portfolio, decide the weights. And then what? You have to revise the portfolio time to time. You have to evaluate the portfolio time to time. Okay, so clear. So before making investment in any security, we consider two factors. What are the two factors? Return and risk. Return and what? Risk. Okay. Return means benefit, yield. So tell me what benefit the equity shareholder will get. Dividend, no doubt. Equity shareholder will get dividend. But you know the Walters model. If R is greater than KE, no dividend is paid as per Walters model. Yes or no? Now the point is equity shareholder will be expecting what? Dividend, no doubt. Equity shareholder is going to get a benefit in the form of a dividend. Not just the dividend, yes or no? Raise in a market price. Mainly these days, everybody making investment in stock market with an objective of making a profit out of increase in market price. అంతే కదా. So you might have seen many of your friends investing in stock market. Their expectation is what? Increase in market price. So that means equity shareholder will get a benefit in the form of dividend and capital appreciation. Dividend and what? Capital appreciation. Okay. Dividend and what? Capital appreciation. Equity shareholder gets a return in the form of capital appreciation and dividend. Yes or no? So debenture holder, what about debenture holder? Debenture holder will get a return in the form of interest and capital appreciation, but generally debenture holder will get a less amount of a capital appreciation. Yes or no? Because market price of a debenture is not going to get fluctuated. Why do the market price of debenture will get fluctuated? Because the investor will get a fixed rate of a return. Investor will get a fixed rate of a return. So that's why if a face value of a debenture is 100, then market price might be what? 110 or 120. That's it. It will not get fluctuated. But equity share price, face value can be 1 rupee and market price can be 70,000 or 80,000 like MRF. Yes or no? So face value can be what? 1 rupee. So equity shares, equity share market price what? So may increase. I mean, there will be a frequent fluctuations. So generally equity shareholder will get a more amount in the form of capital appreciation. But whereas debenture holder will get a less amount in the form of capital appreciation. Capital appreciation. Okay. So first part of this chapter is to learn how to find out the return and risk of a security. That is what we are going to learn. First, we are going to learn how to find out the return. How to find out return. We denote this with X. We denote with what? X. So this is a simple, everything is logical. You can understand the logic. So we are calculating the percentage of a return. Percentage of a return on an investment. So let us assume P naught. P naught means price at the beginning, 100 rupees. For suppose today I am making investment. Today I am purchasing a share at the rate of rupees 100. After 1 year, I am selling that share at 120. So I am getting a return in the form of capital appreciation. So what is the capital appreciation? What is the capital appreciation? 20 rupees is the capital appreciation. Yes or no? 20 rupees is the capital appreciation. Am I correct? 20 rupees is the capital appreciation. Meanwhile, during the year I have got a dividend of, I have received a dividend of 20. Understand the example. At the beginning, nothing but today I am purchasing a share at the rate of rupees 100. After 1 year, I am going to sell a share at the rate of 120. So what is the benefit I got? 20 rupees capital appreciation plus dividend 20 rupees overall. I got 40 rupees on. 40 rupees on. What is my investment? 100 rupees is my investment. I have received 40 on 100. That means what is the percentage? 40 percentage is the return of the security. So first phase of a portfolio management is security analysis. First phase of a portfolio management is what? Security analysis. So that's why we are learning return and risk of a security. How to find out the return and risk of a security. Clear? So how do we find out x? Return x is equal to P1 minus P naught plus D1 divided by P naught. That is equal to return. So this is very important. In mutual funds, we use the same formula. We use the same formula for each and every question. For each and every question, we use the same formula. So P1 minus P naught. Are you able to understand what is P naught? P naught means price at the beginning, investment. P1 means price at the end of the year 1, investment value at the end of a year 1. D1 means dividend for the first year, dividend for the first year, dividend for the first year. Clear? So write down the example to learn how to find out the return and risk of a security. So write down the example. After one example, let us take a break. Return and risk of a security. 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 So already you know how to find out x return. P1 minus P naught plus D1 divided by P naught. So we denote this with x. X. You will be coming across a lot of formulas in portfolio management, but every formula will have some logic. So return and risk of a security. So first part of the portfolio management, security analysis. So first we collect the data of a security. For example, if you want to make investment in Reliance share, you collect the data of a Reliance. If you are considering ITC, collect the data of a ITC. Okay. So And then what we calculate the return and risk of a security. Return and risk of a security. So risk means what? Risk meaning, what is the meaning of risk? Possibility of occurrence of a loss. Possibility of occurrence of a loss. Okay. Possibility of occurrence of a loss. So let me take example. Let me take example. Okay. Year 1, 2, 3, 4 and 5. Year 1, 2, 3, 4, 5. P naught, P1, D1. P naught, P1, D1. P naught means what? Price at the beginning. Let us assume price at the beginning is equal to 100. Price at the end of first year is equal to 110. Dividend is equal to 10. Now tell me what is the X? 20%. Clear? So how do we get this data? Nothing but I have taken year 1, 2, 3, 4, 5. I will collect this data from the stock market. Past 5 years data. I have collected past 5 years data. Past 5 years data of a security X. Past 5 years data of a security X. So P naught 100, P1 110, D1 10 rupees, X is equal to 20%. Clear? So what is the second year P naught? Second year P naught will be 110, yes or no? Price at the end of first year is equal to what? Nothing but beginning of the second year. So the price has got increased to 120, dividend 20 rupees. Dividend 20 rupees. What is the percentage? 27.27%. Next, third year. Third year beginning what? 120. Let us assume 140 and 0. 16.667. Clear? 140 minus 120. 20 plus 0 divided by 120. Because for third year investment is equal to 120. For third year investment is equal to 120. For second year, what is the investment? 110. For first year, what is the investment? 100. Next, fourth year. Fourth year, what? 140. Let us take 150 and nil. 7.14. So next 150, 180 and 10 rupees. So 180 minus 150. 30 plus 4, 10, 40. 40 divided by 150. 26 point. So what is this information in practically? I have collected data of a security X for the past 5 years. for the past 5 years, I have collected the data of a security X, and using the data, I have calculated return. I have calculated return. Understand how do I analyze the security? How do I calculate return and the risk? So simple, for the past 5 years, what was the return? First year 20, next year 27.27, 16.667, 7.14, 26.67. This was the return of the past 5 years. Return for the past 5 years. So I have not yet invested in security X. Now I'm going to decide whether to invest in security X or not. So to decide whether to invest in security X or not, so I should find out what return and risk. Return means what here, expected return. It is also called as average return. So for me, past is a basis. That's it. Based on past, I should expect the return for the next year. I should expect the return for the next year. So now tell me, so for the past 5 years, returns 20, 27.27, 16.667, 7.14, 26.67. Tell me for the next year, will you expect 7.14 or what? Will you expect 7.14 or what? Are you getting my point? This is the return for the past 5 years. Now my question is, what return, what percentage of return will you expect for the next year? What percentage of a return will you expect for the next year? Will you expect 7.14? That is extremely low. No. Will you expect extremely high? 27.27? No. Average. Whether it is or no. Even in cricket also, average runs. Average will be given, yes or no. So in cards, you might have played card game. Cricket players. Idea ఉందా? Cards ఉంటాయి కదా. In that cards also they will be giving what average, bowler average, batsman average, yes or no. So based on that, even while watching IPL also, when a batsman come for batting, you will be seeing the average, what, yes or no. Based on that average, you will be what expecting how much score he is going to make, yes or no. So likewise here also, in stock market also, we are not going to expect what extremely high or extremely low. We expect what average. We expect what average. How do we get average? Total divided by n. Total divided by what? N. Total divided by n, yes or no. So how do I get average? So what is the total? 90. So will I expect 97.75? No. Bhargav, are we going to expect 97.75? 97.75 expect చేయం కదా. 97.75 అంటే ఎగ్జాంపుల్ ఆఫ్టర్ రైటింగ్ ఎగ్జామినేషన్ యూ విల్ బి గివింగ్ అ మార్క్స్, ఎస్ ఆర్ నో. మినిమం 45, maximum 70, on an average 55, yes or no. Likewise you will make an estimation, you will not be adding the minimum and maximum, yes or no. So how do I get average? 97.75 divided by what? 5. 19.5. 19.55. What is this 19.55? Average return. So for the next year you are going to expect what? 19.55. Common sense, yes or no. You will be expecting 19.55. Okay. So this is return, expected return. So in question they will ask you to find out the expected return or average return. Expected return or a average return. Expected return means nothing but average. X bar, X bar. Okay. So next. So how to find out the risk? What is the meaning of a risk? Risk means possibility of occurrence of loss. Risk means possibility of occurrence of loss. Risk means possibility of a deviation from the mean. Risk means possibility of deviation from the mean. Risk means possibility of a deviation from the mean. Mean means what? Average. Mean means what? Average. So for this chapter, to understand the risk calculation, remember the sentence, risk means a possibility of a deviation from the mean. Average, your expectation. Possibility of a deviation from your expectation is called as a risk. What are you expecting for the next year? For the next year, you are expecting what? 19.55. 19.55. But next year, the security may give 20% return, 27.27, 16.667, 7.14, 26.67. Yes or no? We are expecting 19.55, but there is a possibility of deviation from the expectation. For suppose if it is a risk-free security, year 1, year 2, year 3, year 4, year 5, I will get the same return. Average will also be the same. Average will also be the same. In that case, there is no possibility of a deviation from the average. Are you getting my point? If it is a risk-free security, year 1, 8, I will get year 1, 8, year 2, 8, year 3, 8, year 4, 8, year 5, 8. Average will also be what? 8. So risk means a possibility of what? Deviation from the mean. In case of risk-free security, is there a possibility of deviation from the mean or not? No. So that's why we are calling it as what? Risk-free security. There is no possibility of a deviation from the mean average. But here in this question, there is a possibility of deviation from the mean. You are expecting 19.55, but there is a chance that you will get 20%. Possibility of a deviation from the mean. Risk means a possibility of a deviation from the mean. So that's why I will take next column x minus x bar. Understand why we are taking these columns. For risk calculation, I take these columns x, x bar, x minus x bar. Why x minus x bar is required? Because risk means what? Possibility of a deviation from the mean average. So that's why we are taking what? X minus x bar. So 20 minus 19.55. 0.45. Next, 7.7, 7.72. Minus 2.8, minus 2.883. Minus 12.41. 7.12. 7.12. Clear? 0.45, 7.72 minus 2.883 minus 12.41, 7.12. What is this x minus x bar column? Deviation from the mean. Deviation from the what? Mean. Yes or no? Deviation from the mean. Okay. Risk means a possibility of a deviation from the mean. X minus x bar is nothing but deviation from the mean. So we are taken for total how many years? 5 years. So this is also we have to do the average. This is also we have to do the average. Yes or no? The first possibility of a deviation is 0.45. First possibility. What is the second possibility? 7.72. Third possibility, minus 2.883. Fourth possibility, minus 12.41. Fifth possibility, 7.12. So there are how many possibilities? There are 5 possibilities. Yes or no? So total, you will get 0. So whatever the example you take, any example, I have taken 100, 110 and 10. 110, 120, 20. Yes or no? You can take any number. Any number. If you are taking the total of x minus x bar, nothing but summation sigma x minus x bar, you will get 0. If you divide the 0 with 5, you will get 0. That means risk is equal to 0. We cannot say risk is equal to 0. Why? Here we are able to see the possibility of deviation from the mean. There is risk. There is a risk and there is a possibility of deviation from the mean. We are able to see the risk. But if you take the total of x minus x bar, you will get 0. So why are we getting the total 0? Because there is a positive sign, negative sign. There is a positive deviation, negative deviation. There is a positive deviation and negative deviation. So there is a negative sign and positive sign. So that's why you're getting a total what? 0. So that's why in order to eliminate this negative sign, we will be taking the square. We will be taking a square of a deviation. So that's why next column will be x minus x bar square. So these are the columns you should take for finding out the risk. X bar, x minus x bar, x minus x bar square. So tell me why we are taking x minus x bar square. If I take total of x minus x bar, I will get 0. So any example you will get 0 only. Any question. For any question you will get total of x minus x bar 0. That doesn't mean risk is equal to 0. Yes or no? So that's why to eliminate the negative sign we are taking what? To eliminate negative sign we are taking square. So x minus x bar square. So first case 0.20 0.2025. Next 59.59884. అమ్మా నస చెప్పమ్మా మనస 8.2944. 8.2944. Next 150 154. 15.50. 50.694. So total 27 272.82. Do proper rounding of okay 272.82. Yes or no? What is this 272.82? This is summation sigma x minus x bar square. So understand the columns first. What is x? How we calculated this x by using p1 minus p naught plus d1 divided by p naught. You know that p1 minus p naught is capital appreciation. D1 is the dividend. So that is the return to the equity shareholder. X bar. Why are we taking X bar? Average. So okay, risk means a possibility of deviation from the expected return. X minus X bar. So why again we are taking X minus X bar square to eliminate the negative sign. So we have taken a total. So this total cannot be called as a risk. Okay, because we have to do a average. We have to do average. So that is called as variance sigma x square. Risk of a security can be measured. Risk of a security can be measured using variance. Using variance. How do I get variance? Summation sigma x minus x bar square divided by n. That is equal to 272.82 divided by 5. 54.56. 54.564. 54.564. Variance sigma x square is equal to 54.564%. Risk of a security can be measured using variance. So how the variance is denoted? Sigma x square. Sigma x square is equal to summation sigma. So both sigma are not same. Standard deviation sigma. Paduguna sigma. Summation sigma. Nilsuna sigma. Sigma x square is equal to summation sigma x minus x bar square divided by n. So answer 54.564. Next, standard deviation. Standard deviation. Standard deviation is the square root of variance. Standard deviation means what? Square root of a variance. Nothing but we take root. Square root of a summation sigma x minus x bar square divided by n. Again the logic is you have taken a square to eliminate negative sign. So to nullify the square, we are taking a root. In author books, they will be taking n minus 1 in denominator. So to be 100% correct, in denominator we should take n minus 1. But in CA final and CMA final, suggested answers, study materials, they are falling divided by n. Okay. In one or two solutions, you might find n minus 1 in study material, CMA final study material, but the standard is n. So what is the answer? 7.38. This is the standard deviation. Risk of a security can be measured using variance, standard deviation, or a coefficient of a variation. What is the next one? Coefficient of a variation or variance. Coefficient of a variation. Coefficient of a variation. So you will get MCQ. They are asking MCQ on this coefficient of a variation. So how do we get coefficient variation? Simple. X bar divided by sigma x. expected return minus standard deviation. 1 minute, sorry. Standard deviation divided by x bar. Standard deviation divided by x bar. Standard deviation divided by x bar. What is the standard deviation? 7.3867 divided by x bar. 19.5. 19.55. 0.37. 0.3778. 0.3778. So what is the meaning of this coefficient of a variation? What is this 0.3778? 0.3778 is risk for every 1% of a mean return. If you are expecting 1% return, there is a possibility of a deviation of a 0.3778. Coefficient of a variation. What does it denote? Coefficient of variation? It denotes risk per 1% of a mean return, or else you can call it as risk per unit of a mean return. Risk per unit of a mean return. Risk per unit of a mean return. So understand the number. So in denominator we have a 19.55, which is a mean return. In numerator we have a standard deviation 7.3867. So the answer is 0.3778. What is this? For every 1% expected return, there is a possibility of deviation of 0.3778. Standard deviation is total risk. Standard deviation is total risk. Coefficient of a variation is what? Risk for 1 unit of a mean return. Risk per 1 unit of a mean return. Clear? Are you getting my point? Okay. So understand the link first. Understand the link. Our chapter name is portfolio management. Portfolio means a combination of securities. Securities includes shares, bonds, and money market instruments. Okay, so SFM includes investment decision, financing decision, portfolio decision, dividend decision. So the objective of SFM is to maximize the wealth. If you want to make a portfolio investment, what is the first phase? Security analysis. Nothing but you should select the security based on return and risk. If whoever want to make an investment will consider two factors. One is the return and the risk. Before you joining CMA or anybody, before choosing any career option, so they will be considering what? Two factors. One is the return and the risk. రిటర్న్ ఒకటే చూడరు కదా, రిటర్న్తో పాటు ఏంటి? రిస్క్. ఆ రిస్క్ మనం వేర్ చేయగలమా లేదా చూస్తారు. సో దట్స్ వై బిఫోర్ టేకింగ్ ఎనీ ఇన్వెస్ట్మెంట్ డెసిషన్ వీ కన్సిడర్ టూ ఫ్యాక్టర్స్, రిటర్న్ అండ్ రిస్క్. So that's why in this chapter our priority is to learn how to find out the return and risk of a security first, and then what? Return and risk of a portfolio. This is the first part of the portfolio management. I have taken a simple example to explain the return and risk of a security concept. I have collected the data, 5 years data. I have collected the past 5 years data of a security X. Price at the beginning, price at the end, and dividend during the year. Using that information, I have calculated X. Nothing but return for every year. Return for every. So portfolio management. Portfolio management. So what are the A category topics? First topic, securitization theory topic, security, valuation, portfolio management, derivatives, mutual funds, digital finance. So digital finance and securitization theory topics. So four practical topics. Okay. So these are very important. Next B category, international financial management, forex, interest rate risk management, evaluation of risky proposals. Four topics comes under B category. And C category topics, investment decisions, leasing decisions, security analysis. Okay, fine. So the most important topic in SFM, portfolio management. So portfolio means what? Combination of securities such as stocks, bonds, and money market instruments. So portfolio management involves three major activities: selection of securities based on return and risk, construction of feasible portfolios, deciding weights of different securities. So what is the main objective of a portfolio management? Diversification is the main objective, but there are other objectives. What? Statement of safety of a principal amount, stability of income, next capital growth, marketability, liquidity. Diversification phases of a portfolio management: security analysis, portfolio selection, revision, evaluation. Okay. So return of a security, equity shareholder will get a return in the form of capital appreciation and dividend. So that is a common sense point. Debenture holder will get a return in the form of interest and capital appreciation. Return x is equal to P1 minus P naught plus D1 divided by P naught. Okay. So in the previous example, we have collected the past data. In case of a past data, how do we get expected return? By doing a simple average. By doing a simple average, we can get expected return x bar. Risk means a possibility of a deviation from the mean. Risk means a possibility of a deviation from the mean average. Okay. So there are three: possibility of occurrence of a loss, possibility of deviation from the mean, and next what? Uncertainty. So here for this chapter you have to remember the point: possibility of a deviation from the mean average. Okay. So what are the columns for calculating the risk? X, x bar, x minus x bar, x minus x bar whole square. So we take year column also, year x, x bar, x minus x bar, x minus x bar whole square. So P1, P0 and D1 columns are not required because in X column itself we calculate P1 minus P0 plus D1 divided by P0. So you have to remember the columns. Instead of formula, you have to remember the columns. Whenever there is a summation sigma in the formula, instead of formula, you have to remember the columns. If there is a summation sigma in the formula, that means what? We should take a table. We should take a table. Risk of a security can be measured using variance, a standard deviation, or a coefficient of a variance. Yes or no? So variance is equal to summation sigma x minus x bar square divided by n. Okay. And next, the standard deviation is equal to square root of variance. So square root of summation sigma x minus x bar square divided by n. Coefficient of a variance is equal to standard deviation divided by x bar. So we should know the meaning. Okay, coefficient of variation indicates risk per unit of a mean return, risk per 1% of a mean return, average return. So high variance, high standard deviation, high coefficient of a variance indicate high risk. High variance, high coefficient of a variance. So high standard deviation indicates what? High risk. So we should select a security which is having what? Low risk. From risk point of view, we should select a security which is having a low risk. Yes or no? Okay. So but instead of, formula, variance or a standard deviation formula, we should Remember the columns. What are the columns? X, x bar, x minus x bar, x minus x bar whole square. So, and you should know the reason for taking those columns also, because the risk meaning possibility of a deviation from the mean. Deviation from the mean. So that's why the third column is what? Deviation from the mean, x minus x bar. And why again we are taking x minus x bar square? Because the total of x minus x bar you will get 0. So that's why you are taking what? X minus x bar whole square. X minus x bar whole square. Am I clear? Okay. So the question we have done is, example, whatever we have done is what? That is without a probability. That is for past data. That is for past data. If there is a past information for the security, then so we take x, x bar, x minus x bar, x minus x bar square. Nothing but we take equal weight to each year return. Simple average means what? Simple average means we are giving an equal weight to every year return. Equal weights. Okay. So, but sometimes in the question, they might give a future data with a probability. Future data with probability. So when future data with probability is given, we should do a weighted average for calculation of a average return. We should do a weighted average. So when the future data is given, we should do a weighted average. See the additional question number 1. I think for you additional question is not there. So I will explain the question with question number 1. Question number 1 is with the probability. So I think question is missing in with you. Okay. So see the question. Question number 1. I'm going to explain return and risk of a security with the probability. The earlier example is for what? Without a probability. Now this question is for what? With a probability. So when the past information is not there, future information is there, then a stock costing rupees 120 pays no dividend. A stock costing rupees 120 pays no dividend. The possible prices that the stock might sell for the end for at the end of the year with the respective probabilities are 115, 120, 125, 130, 135, 140. So dividend is not given actually here. Okay. So required calculate the expected return and calculate the standard deviation of a return. So try to understand the question. A stock costing rupees 120 pays no dividend. What is the stock cost? 120. So which pays no dividend? So dividend is not given, which is not paying any dividend. That means the only benefit investor is going to get is capital appreciation. Capital appreciation. Yes or no? So what is the next sentence? The possible prices that the stock might sell for at the end of the year. Right now the stock cost is 120. The stock cost 120. It might sell for rupees 115, 120, 125, 130, 135 or 140. So total there are 6 possibilities. This question is different. The previous question is what? We have collected the past data for the past 5 years. The previous question is what? We have collected the data for the past 5 years. We have collected the data for the past 5 years. Yes or no? For the past 5 years, for first each and every year we have calculated return P1 minus P0 plus D1 divided by P0, and then we have taken a simple average. So that question is the past data. So what about this question? This question they have given a future data. Right now the stock cost is 120. Next year, at the end of the year, The stock might sell at rupees 115 or 120 or 125 or 130 or 135 or 140. So these are the possible prices. Possible prices. This is not the past information. This is the future information. This is the future information. This is not the past information. This is the future information. So are you able to get this point? So calculate the expected return and also calculate what a standard deviation of a returns. Standard deviation of a returns. So question number 1. So please do understand the concept and get clarity. This is about a future data. About future data, probability is also given. Nothing but weights are given. So there is 10% chance that price at the end of first year will be 115. Another 10% chance that the price may be 120. 20% chance that price may be 125. 30% chance that price may be 130. 20% chance that the price may be 135. 10% chance that the price may be 140. Possibilities are given. Probability is given. Okay. So when there is a probability, even if you get conceptual clarity, there are high chances that you will do a clerical mistake. Clerical mistake in SFM. So even though students have a conceptual clarity, most of the people, they are doing a clerical mistake. Okay. So let us see the question number 1. So what kind of a clerical mistakes you will do, I will tell you. Question number 1. So what they are asking? They are asking you to calculate what expected return, standard deviation. So take heading calculation of expected return and what standard deviation. You write the full form. Calculation of expected return and what standard deviation. First part and second part. In your question bank, you might find a different presentation, but note down the solution. Calculation of expected return and standard deviation. So what is the standard deviation? Possibility of a deviation from the mean. Risk can be measured using variance, standard deviation. Yes or no? So what is the risk possibility of deviation from the mean? Nothing but we require x and what? X bar. We require x and x bar. So when there is a probability, be careful with columns. The columns will be x. First column x. How do we get x? P1 minus P dot plus D1 divided by P naught. P1 minus P naught plus D1 divided by P naught x. Next column will be P probability and then P into x. Next x bar, x minus x bar, P into, just write x minus x bar, P into x minus x bar. These are the columns. X, P, P into x, x bar, x minus x bar, P into x minus x bar. So understand the question. What is the stock price as on today? 115. Within a year, 120. As of now, what is the price of a stock? 120. So price of a stock 120. And this price of a stock may increase to what? May increase or decrease? May decrease to 115. That is the first possibility. First possibility. The first possibility is the price may decrease to what? 115. Price may decrease to what? 115. Clear? So that means what is the first case return is equal to minus 4.16. Very good, Amma. Minus first case, we are not going to get a positive return. We are going to lose money. In first scenario, we are going to lose money because the present stock price is 120, but the price will decrease to 115. That means we are going to lose money. So that means what? So what is the calculation? 115 minus 120 divided by 120. So that is equal to minus 4.17. Clear? Next calculation. What is the next calculation? This is the first chance. So first possibility is next year we might get a negative return of a minus 4.17. This is not the past information. This is the future. So next year we may get minus 4.17 percentage. What is the percentage of occurrence? 10%. Nothing but 0.1. So there is 10% chance that we might get a negative minus 4.17. What about the next one? 120 minus 120 divided by 120. 0. What is the probability? 0.1. 0.1. 120 minus 120 divided by 120. So what is the chance? 0.1. Next 120. 125 minus 120 divided by 120. 4.17. What is the percentage of occurrence? What is the percentage of occurrence? 0.2. 20% chance. 20% is chance. Next 130 minus 120 divided by 120. 8.33. So what is the percentage of occurrence? 30%. So 30% chance that we may get 8.33% return. What is the next one? 130, 135 minus 120 divided by 120. 12.5. So this is a fifth possibility. Yes or no? So what is the percentage of occurrence? 0.2. What is the next one? So 140 minus 120 divided by 120. 16.67. Percentage of occurrence 0.1. The percentage of occurrence is 0.1. Clear? So this is the probability. Am I clear? Next P into. So next let me explain. So there are 6 possibilities. Yes or no? So first possibility you may get minus 4.17. Second possibility 0. Third possibility 4.17. Yes or no? So likewise there are 6 possibilities. In previous example we have done simple average. Simple average. So now we can do a simple average or not. We cannot do simple average because here the chances are not equal. Here the possibilities are not equal. The percentage of occurrence is different, yes or no? First case 10%, second case 10%, third case 20%, fourth case 30%. So that's why we have to do a weighted average. So we have to do weighted average. So that's why 0.1 into 4.17, 0.417, 0. Thank you, Nan. Thank you. నిజంగా థ్యాంక్స్. కెరీర్ పాడైపోయేది నాది. నెక్స్ట్ థర్డ్ వన్ 0.834, 2.49, 2.5, 1.6. నేను మిస్టేక్ చేస్తే మీరు కరెక్ట్ చేస్తారు, అర్థమవుతుందా? సబ్ కాన్షియస్ మైండ్ వేరే ఏదో ఆలోచిస్తే నేను రాశాను అనుకోండి, వెంటనే మీరు కరెక్ట్ చేస్తారు. కానీ మీరు ఎవరో కరెక్ట్ చేయరు మీకైతే. కొంచెం జాగ్రత్తగా ఉండండి. సో వాట్ ఇస్ ద టోటల్ ఎక్స్ బార్? 7.0. వాట్ ఈస్ దిస్ 7.083? మనోడు ఏదో చెప్తున్నాడు. నీ పేరేంటమ్మా? వాట్ ఈస్ యువర్ నేమ్? కృష్ణవంశీ. వెరీ గుడ్ అమ్మా. 7.083. వాట్ ఈస్ దిస్? Expected return. This is expected return, average return. Average 7.03 is the average return. Yes or no? We have done a weighted average. We have done weighted average. So students will do a clerical mistake. Clerical mistake means what? They will do 7.083 divided by 6. Subconscious mind. మన సబ్ కాన్షియస్ మైండ్ ఏంటంటే ఎప్పుడన్నా టేబుల్లో నెంబర్స్ రాస్తే వీ షుడ్ టేక్ అ టోటల్ ఆఫ్ ఇట్. ఓకే, అండ్ దెన్ వాట్? డివైడ్, అంతే. ఓకే, బట్ హియర్ ఇట్ ఈస్ వాట్? ప్రాబబిలిటీ క్వశ్చన్. సో దట్స్ వై వాట్? 7.083 ఇట్ సెల్ఫ్ ఈస్ వాట్? ఎక్స్పెక్టెడ్ రిటర్న్. నెక్స్ట్, వాట్ ఇస్ ద నెక్స్ట్ కాలమ్? ఎక్స్ బార్. వాట్ ఈస్ ఎక్స్ బార్? 7.083. So what is the 7.083? Next year we are expecting an average return of a 7.083. But there is a possibility of a deviation from the average or not? Yes, there is a possibility. If you are expecting 7.083, you may get minus 4.17. You may get minus 4.17. Yes or no? So there is a possibility of a deviation. Tell me the possibility of deviation. Minus 11.253, minus 7.083, minus be careful while finding out x minus x bar. Probability ఉన్నప్పుడు there are high chances of doing a clerical mistake. Subconscious mind will say you to take the total and then what? Divide with n. అదొకటి. నెక్స్ట్ ఏంటి? while taking x minus x bar also, some students might take instead of x, they will take p into x. పక్క పక్కన ఉన్నాయి కదా, ఆ పక్క పక్కన ఉన్న నెంబర్స్ ఏం చేస్తారు? మైనస్ చేసి రాస్తారు. బీ కేర్ఫుల్. చచ్చా అలా ఎందుకు చేస్తారంటారా? చేశారు అలాగా పాస్ట్లో స్టూడెంట్స్. నేను చెప్పింది అర్థమైందా? తీసుకోవాల్సిన ఎక్స్ మైనస్ ఎక్స్ బార్, కానీ స్టూడెంట్ ఏం చేస్తాడమ్మా హడావుడిగా? సబ్ కాన్షియస్ మైండ్ ఏం చెప్తుంది? ఫాస్ట్ త్వరగా చేయి, పక్క నెంబర్లు మైనస్ చేయి అని చెప్తుంది. అంటే -0.417 మైనస్ ఏంటమ్మా 7.083. అట్లాంటి మిస్టేక్స్ చేసిన వాళ్ళు ఉన్నారు. సో బీ కేర్ఫుల్. చూడ ద నెక్స్ట్ నెంబర్ -2.913, 1.247. నెక్స్ట్ 5.417, 9.587, 9.587. క్లియరా? So do not write P into x minus x bar. Just tell me the numbers. You tell me the numbers. You do not write, okay? So tell me what is this x minus x bar? Deviation from the mean. Can we take total of this x minus x bar and divide with n? No. First of all, dividing with n is not correct because there is a probability. Okay, first point. Next, so we have to do what? Weighted average of this deviation. Weighted average of this deviation. Do not write. First tell me, what is the first case? There is 10% chance that there is a possibility of deviation of a -11.253. There is a possibility of a deviation. What is the possibility of deviation? There is a possibility of deviation of a -11.253. What is the percentage of chance? 10% is the chance. Risk means a possibility of a deviation from the average. Possibility of deviation from the average. X minus x bar is nothing but what? Deviation from the average. So this deviation from the average has to be, okay, we have to do weighted average because weights are given. So nothing but 0.1 into -11.253. You will get -1.1253. Next, -0.7083. Next, -0.5826. Next, 0.3741. Next, 1.0834. Next, 0.9587. Last one 0.9587. Okay. So the last column total you will get 0. Are you getting 0 or not? Check whether you are getting 0 or not. Check whether you are getting 0 or not. You will get 0. When there is no probability, if you are taking the total of x minus x bar, you will get 0. When there is probability, the total of x minus x bar, you may not get 0. But if you directly do the weighted average of x minus x bar, you will get 0. Why we are getting 0? Because there is a negative and positive. So that's why we should do a weighted average of a deviation square. So that means we should take what? P into x minus x bar square. రాయొద్దు అని 4 times చెప్పా, ప్లీజ్ డు నాట్ రైట్ అని. బట్ అందరూ రాశారు. ఏదో ఊరు వెళ్ళాలనుకుంటా మరి. అప్పటికి చెప్పా నేను 3 times 4 times రిపీట్ చేశా, ప్లీజ్ డు నాట్ రైట్. సో టెల్ మీ ద నెంబర్స్ అని చెప్పి. సో లాస్ట్ కాలం చెప్పాను నేను రాయొద్దని. నా తప్పేమైనా ఉందా? లేదు కదా. 2 times 3 times చెప్పాను. So we should take what p into x minus x bar square. Why we should take p into x minus x bar square? If you directly do the weighted average of x minus x bar, the total will be 0. So that is not correct, because the reason is there is a possibility of a deviation. Okay, if you directly do the weighted average of x minus x bar, you will get a 0. So that's why we should take x minus x bar square. So p into x minus x bar square. Now tell me the numbers. You can write now, but space లేదు. So p into x minus x bar square. Bhargav, tell me the numbers. P into x minus x bar square. 1.262663. Okay. 12 point. ఓన్లీ వాటర్ అనేది నువ్వు తాగింది బాబు భార్గవ్. ఏంటా నెంబరు? 12 పాయింట్. భార్గవ్, వాట్ ఈస్ ద నెంబర్? పి ఇంటూ ఎక్స్ మైనస్ ఎక్స్ బార్ స్క్వేర్. కరెక్టేనా? వాట్? So tell me the last column. P into x minus x bar square. 12.663. Next. 5.0168. 1.697. 0.4667. Next. 5.868. 9.1910. Total 34.9. Okay, 34.903. 34.903. Next. Next what? Variance is equal to డివైడ్ బై చేస్తుంటారు కదా. చేశారా? చెప్పుకోకండి, బాగుండదు. వేరియన్స్ ఈజ్ ఈక్వల్ టు 34.903. This number itself is a variance. This number itself is a variance. I have already told you there is a high chance of doing a clerical mistake. Subconscious mind total చేసి డివైడెడ్ బై చేయింది మనకి మనసు ఒప్పదు. సో వేరియన్స్ ఈజ్ ఈక్వల్ టు 34.903% variance. This number itself is a variance because already we have taken an average. Already we have taken an average. Okay, so that's fine. Next, standard deviation. Standard deviation is equal to 5.908. 5.908%. 5.908%. So clear? 5.908. What is the question bank answer? 5.908 percentage. So understand the concept. This is not the past data. This is the future data. The future data is given with probability. So when future data with probability is given, so what are the columns? X, P, P into X, X bar, X minus X bar, P into X minus X bar square. Square is only for X minus X bar, not for probability. Square is only for X minus X bar. So why we are taking square to the X minus X bar? To eliminate the negative sign. Clear? So when there is probability, so what is the variance formula? Variance formula, summation sigma P into X minus X bar whole square. Divide by n untunda? No. Next, standard deviation. Standard deviation is equal to square root of summation sigma P into X minus X bar whole square. But when there is a summation sigma in formula, so more than a formula, columns are very important. What columns we should take? Okay. So the summary is, when the past data is given, the columns are year X, X bar, X minus X bar, X minus X bar whole square. Okay. When probability is given, what are the columns? X, P, P into X, X bar, X minus X bar, P into X minus X bar whole square. So these are the columns. Okay. So what is the first part of the portfolio management? Return and risk of a security, return and risk of a portfolio. So we have discussed how to find out the return and risk of a security. In this there are two categories. One is the past data and the second one is what? Future data. Past data and future data. Okay. Clear? So go through this question. Question number 2. I mean question number 1. So okay, how to find out the return and risk of a security? So if a past data is given, so what are the columns? Here X, X bar, X minus X bar, X minus X bar square. How do you find out X? P1 minus P naught plus D1 divided by P naught. So equity shoulder will get return in the form of a capital appreciation, that is P1 minus P naught plus dividend. So that's why P1 minus P naught plus D1 divided by P naught. Okay. So next what? So when future data is given with probability, then what are the columns? x p into x bar, x minus x bar, p into x minus x bar whole square. Yes or no? Okay. So be careful when the probability is given in the question. Okay. So next. So what is the first activity in portfolio management? The selection of a securities based on a return and risk. So how do we select the securities? For that, so we apply rule of a dominance. Rule of a dominance. See this question, question number 7, rule of a dominance. How do we select the securities? How do we select securities? How do we select the securities? Rule of a dominance. For example, so this rule of a dominance was proposed by Markovich. So nothing but even if he has not recommended this rule of a dominance, even so the common sense can be applied. Following is the data regarding 6 securities. Return and risk is given. Return and risk standard deviation is given. Assuming 3 will have to be selected. Only 3 can be selected. State which one will be picked. State which one will be picked. So there are 6 securities. We can select only 3. Which 3 are we going to select out of 6 securities? So return we should get high, yes or no? Risk should be low. So rule of a dominance. We say one security is said to be dominating the other security. One security is said to be dominating the other security if the security is giving higher return for low risk. Higher return for what? Low risk. So what is the point? Rule of a dominance. We are discussing rule of a dominance. One security is said to be dominating the other security. One security is said to be dominating the other security if the security is giving a higher return for low risk. Higher return for low risk. So for example, if you compare A and B securities, which security is dominating? A is dominating. How can we say that? Because A is giving a same return for low risk. Same return for low risk. Understand 4 points. So rule of a dominance. One security is said to be dominating the other security if the security is giving a high return for low risk. High return for low risk. High return for low risk means, for example, A, B. Return and risk. So A is giving a 16% return for 8% risk. B is giving 14% return for 10% risk. Which security are we going to select? A or a B? A return 16%. What about risk? 8%. B return 14%. What about risk? 10%. Which security am I going to select? I'm going to select A. So nothing but A is dominating B. A is dominating B. So A is dominating B because A is giving a higher return for low risk. So this is an example for what? High return for what? Low risk. So one security is said to be dominating the other security if the security is giving a higher return for low risk. The second example already we have seen in the question number 7. Question number 7. What is the second example? For example, security A is giving a 16% return and B is also giving 16% return. Risk 8 and 10. So which security am I going to select, A or a B? I'm going to select A. Why I'm going to select A? Because A is giving a same return for low risk. So the second rule of a dominance is same return, low risk. Okay. Third example, for example, A is giving a 16% return. A is giving a 16% return. B is giving 14 and the risk is 10 and 10. Which security I am going to select? I am going to select security A. Why I am going to select security A? Because the security A is giving high return. So high return, I am getting an extra return for same risk. So that's why A will be selected. Nothing but one security is said to be dominating the other security if first one, the security is giving a high return for low risk, security is giving same return for low risk, security is giving high return for same risk. And the last rule is high return, high risk. Last one is what? High return, high risk. For example, A is giving 20% and risk is 12. B is giving 14 and the risk is 8. Which security am I going to select? I am going to select A because A is giving a high return for high risk. So there are four rules of a dominance. Rule of a dominance. One security is said to be dominating the other security. If it is giving a high return for low risk, same return for low risk, high return for same risk, or high return for high risk. Okay. So we call this concept as efficient frontier. Efficient frontier. So likewise here there are six securities. Out of six securities, we should select how many? Three. First, let us compare A and B. A and B. If you compare A and B, which security are you going to select? You are going to select what? A. Why A? Same return for low risk. So nothing but I am not going to select B because A is dominating B. So if I compare A and C, if I compare A and C, I cannot eliminate C because C is giving a high return for high risk. At the same time, I cannot eliminate A also. Next D. If I compare A and D, so I am not going to select D. Why I am not going to select D? Because A is giving a higher return for same risk. Because A is giving 8% return for 4% risk. D is giving 4% return for 4% risk. So I'm not going to select D. Yes or no, Priya? Yes, sir. We are not going to select D. Very good, Amma. Next. Next, A and E. What about A and E? If I compare A and E, E is giving a high return for high risk. So that's why I cannot eliminate what E. What about F? F we can eliminate, yes or no? Why? A is giving a same return for A is giving a same return for low risk. పోన్లే భార్గవ్ వదిలే ఇది కంగారులో చెప్పాడు. A is giving a what? Same return for low risk. Yes or no, Shaheen? So out of six securities, we should select only three securities. What are the three securities to be selected? A, C, E. Okay. So what is the first activity of a portfolio management? Selection of a securities based on a return and risk. So we apply this rule. Okay. So for selection of a securities. Okay. Clear? Done. So what are the rules? First one, high return for low risk. Second, same return for low risk. High return for same risk. High return for high risk. So question number what? 7. So if you do the plotting, this graph and all not required. So there are 6 securities. Out of 6 securities, we should select what? 3 securities. So x-axis and y-axis. So risk, return. Okay. So tell me the A. So A security. A is giving 8. Return 8. What about risk? 4. Graph is not required, but note చేసుకుంటారు మీరు నాకు తెలుసు. 2, 4. హైయెస్ట్ రిటర్న్ ఎంత? 12. So 2, 4, 6, 8, 10, 12, 14, 16, 18. Return yes or no? What about risk? So risk 2, 4, 6, 8, 10, 12, 14, 16. Okay. So what is the first security? Security A. Security A is giving 8% return for 4% risk. Yes or no? So this is the point. Yes or no? Security A is giving what? 8% return for 4% risk. What about next one? Security B. 8%. 8% return for what? 5% risk. Nothing but yes or no? So 8% return for what? 5% risk. Next one what? 12% return for 12% risk. So this will be somewhere. Yes or no? Next what? Next 4%. 4% return for 4% risk. Next 9% return for 5% risk. Next 8%. 8% return for 6% risk. Okay. Yes or no? So efficient frontier nothing but so here we are going to select a securities which are lying on this line after taking a right turn. After taking a right turn. If you observe this, so this is the I think security is C. Yes or no? Security C. Okay. Security C. So next, what is this next one? E. 9% return for 5% risk. E. And this is what? A. And this part is known as a efficient frontier. This part. This part is known as what? Efficient frontier. So after plotting the points, so we select the securities which are lying on the efficient frontier. Efficient frontier. Efficient frontier. We call the efficient frontier. I mean the after this line takes a right turn, that part is called as what? Efficient frontier. So whichever the security falling on efficient frontier will be selected. So which are the securities selected on efficient frontier? A, E and C. But without plotting also we can say that what? We can select A, E and C. Because we cannot select B because B is giving a same return for high risk. Yes or no? We cannot select a D because D is giving a low return for same risk. We cannot select F also. Same return for higher risk. Clear? So this plotting and graph is not required actually. So this part is known as what? Efficient frontier. So whichever the security falling on the efficient frontier would be selected. Clear? Okay. So what about this security? This security is no way closer to what? Efficient frontier. Yes or no? We are not able to link the line also. So this is not going to be selected. What is that security? 4 and 4. Security D. Security D. Clear? Okay. So this is rule of a dominance. Rule of a dominance. So how we are going to select a securities? Securities are selected based on what? Return and risk. One security is said to be dominating the other security, which is giving a high return for low risk, same return for high return for same risk, high return for low risk, same return for low risk, high return for high risk. అంతే కదా. ఫస్ట్ వన్ హై రిటర్న్ ఫర్ లో రిస్క్, సేమ్ రిటర్న్ ఫర్ లో రిస్క్, హై రిటర్న్ ఫర్ సేమ్ రిస్క్, హై రిటర్న్ ఫర్ హై రిస్క్, హై రిటర్న్ ఫర్ హై రిస్క్. ఇది గ్రాఫ్ డ్రా చేద్దాం అనుకున్నట్టున్నావు. సరే మళ్ళీ ఒకసారి ఈ గ్రాఫ్లని రావని చెప్పి ఇవన్నీ మన ఇటువైపు వచ్చింది. ఓకే. ఫస్ట్ సెక్యూరిటీ, వాట్ ద ఫస్ట్ సెక్యూరిటీ? నీ పేరేంటి? కల్పననా? శ్రీలేఖ. ఓకే. వాట్ ద ఫస్ట్ సెక్యూరిటీ? ఏ. 8% రిటర్న్ ఎట్ 4. ఓకే ప్లాటింగ్ చేసుకున్నామమ్మా. నెక్స్ట్ నెక్స్ట్ సెక్యూరిటీ 8% రిటర్న్ ఫర్ 5% రిస్క్. ఓకే. నెక్స్ట్ 12% రిటర్న్ ఫర్ 12% రిస్క్. ఓకే. నెక్స్ట్ 4% రిటర్న్ ఫర్ 4% రిటర్న్ ఫర్ 4% రిస్క్. నెక్స్ట్ 9% రిటర్న్ ఫర్ 5% రిస్క్. నెక్స్ట్ 8% రిటర్న్ ఫర్ 6% రిస్క్. Okay, there are three 8% returns, yes or no? There are three 8% returns. One is 8% return for 4% risk. Second, 8% for 5% risk. 8% return for 6% risk. Clear? Done. So now, so here where this graph is taking a right turn or U-turn, okay, so that part is called as what? Efficient frontier, and the securities which are falling on this efficient frontier will be selected. Okay, nothing but which securities are we selecting? A, C and E. A, C and E. Clear? Okay. So examination point of view, no relevance for this graph. Clear? So this is rule of a dominance. Clear? Are you able to understand this part? How to find out the return and risk of a security? Return and risk of a security. Clear? Columns x, x bar, x minus x bar, x minus x bar square. And when there is probability, x, p into x, x bar, x minus x bar, p into x minus x bar whole square. Clear? Okay. Now see the additional question number 1. So for you, I think additional question number 1 is not there right now. The following information is available. Krishnavamsi, the following information is available in respect of expected dividend, market price, and market condition after 1 year. The question is not available. Okay. So market condition, good, normal and bad. Probability 0.25, 0.5 and 0.25. Market price and dividend per share is given. The existing market price of an equity share is 106, which is a cum. Cum means including 10% bonus debenture of rupees 6 each per share. X Finance Company Limited had offered the buyback of debenture at face value. Messrs. Find out the expected return. Find out the expected return and variability of our returns of the equity shares. Of the equity shares. If the buyback offer is accepted by the investor, and also advise whether to accept a buyback offer. So this is a miscellaneous point. The main point is what? Find out the expected return and variability of a returns of the equity share. Variability of a returns of the equity shares means nothing but what? Variance, standard deviation. We should find out variance and standard deviation. So this question is the past data question or a future data? Future data. Probability is given. If the market condition is good, expected dividend, market price and market condition after 1 year is given. After 1 year, market condition, if it is good, the market price will increase to 115. The market price increases to 107. If the market is normal. If the market is bad, market price decrease to 97. If the market condition is good, we are going to receive a dividend of 9. So if it is normal, 5. If it is bad, 3 rupees. So what is the percentage of market condition being good? 25%. 25%. And next what? Market condition being normal. 50%. Market condition being bad. 25%. The off chase 25%. Clear? So let us find out the expected return and variability of returns. So take heading calculation of expected return and variability of our returns. Additional question number 1. Calculation of expected return and variability of our returns. Calculation of our expected return and variability of our returns. Calculation of expected return and variability of our returns. రైటింగ్ అర్థం కదా, ఐసైట్ వస్తుంది, రాసుకోండి మీరే. క్యాలిక్యులేషన్ ఆఫ్ ఎక్స్పెక్టెడ్ రిటర్న్ అండ్ వేరియబిలిటీ ఆఫ్ అవర్ రిటర్న్స్. ఓకే. సో వాట్ ఆర్ ద కాలమ్స్? ప్రాబబిలిటీ is given, yes or no? Probability is given, so what are the columns? Very good. X, P, P into X, X bar, X minus X bar, P into X minus X bar. Okay. For X we should take more space. X, P into X, X bar, X minus X bar, P into X minus X bar square. So next. So there can be 3 possible returns, yes or no? There can be 3 possible returns. What is the present stock price? Present equity share price? 106. Present equity share price? 106. So including 10% bonus debenture of rupees 6. 10% bonus debenture, yes or no? The existing market price of an equity share is rupees 106. Face value 1 rupee, which is come means including 10% bonus debenture of rupees 6 each per share. So we should take pure equity share price. What is the pure equity share price? 100 rupees. So 106 minus what? 6 rupees. So 100 rupees is the P naught, price at the beginning. So if a market condition is good, then the price of a share will increase to what? Price of a share will increase to 150, na? So 115 minus 100 plus, what is the dividend? 9, divided by 100. See, if a market condition is good, if market condition is good, if a market condition is good, then what? If a market condition is good, then what? 24%. If market condition is good, then what? 24%. Yes or no? If a market condition is normal, then what? Priya, then what is the calculation? Huh? Okay, I'm sorry. Sorry, Priya. That's my mistake. So if market condition is normal, then what is the market price? 107. So then what is the calculation? 107 minus 100 plus 5 divided by 100. For these type of a calculation, we should not use calculator. If you are using the calculator, then you have to think twice. Next, what is the P1 at the end of the year? Third category. Question is under 97 and dividend 3 rupees. So 97 minus 100 plus 3 divided by 100. 0. Yes or no? Clear? Bhargav. So what is the probability? So probability of market condition being good, 0.25. So that means 25% chance that we will get 24% return. Next, 50% chance that we get 12%. 25% chance that we get 0. P into X, 0.25 into 24, 6. 0.5 into 12, 6. 0.25 into 0, 0. So 12. Yes or no? So 12. What is this 12? X bar. Divide by 3 చేద్దామా? No. X bar 12. So next year we expect 12%, but there is a possibility of deviation. So first case, what is the possibility of deviation? 12. There is a positive deviation. Second case, 0. Last case, minus 12. Next, P into X minus X bar whole square. 36, 0, 36 total. So what is this 72? Variance. 72 is the variance. Standard deviation is equal to, what is the standard deviation square root of 72? 8.49. 49? 49%. 8.49 percentage. So 8.49 percentage is the answer. Standard deviation. Standard deviation. Clear? So this is with probability. So there is a dividend also. And there is one miscellaneous point. This is miscellaneous point. Advise whether to accept buyback offer. Whether to whether to accept what? Buyback offer. So what is the expected return on equity share? 12% is the expected return on a equity share. So Mrs. X Finance Company has offered the buyback of debenture at a face value. The face value 6 rupees. There is a reasonable 10% rate of interest compared to expected return 12% from the market. If investor is investing in equity share, he is going to get 12% return, but whereas on debenture he is getting 10%. So considering the dividend rate and the market price, the credit worthiness of the company seems to be very good. The decision regarding buyback should be taken considering the maturity period and opportunity in the market. Normally, if the maturity period is low, say up to 1 year, better to wait, otherwise to put buyback option. For example, if maturity is less than 1 year, okay, then better you wait. Otherwise, what? It is better to accept the buyback offer. Why? Because the debenture is paying only 10%, but if investor invest in stock market, he will get 12%. If it is maturity is less than 1 year, then what? Better to wait. Otherwise, what? Accept the buyback offer, take money and invest in equity share so that he will get a 12% rate of a return. You can write in simple language. So he can accept the buyback offer because he is getting 12% return on a equity share compared to the rate of interest on a debenture, that is 10%. Clear? The rate of interest on a debenture is what? 10%, but whereas return on equity share is 12%. So it is better to accept the buyback offer. Return on equity share is 12%. Rate of interest is 10%. So it is better to accept the buyback offer of a debenture. Rate of interest is 10%. Rate of a return on equity share is 12%. So it is better to accept the buyback offer of a debenture. Buyback offer of a debenture. So 106 rupees includes 6 rupees debenture face value. So 10% bonus debenture means what? The rate of interest is 10%, but the rate of return on equity is 12%. So it is better to accept the buyback offer so that he can take money and invest in what? Equity shares and can earn 12% rate of a return. So this additional question is miscellaneous and not for practice and not for referral also. Okay, clear? Not for referral also. This is an additional question. So risk means what? Possibility of occurrence of a loss, uncertainty, or a deviation. Possibility of deviation from the mean return. Risk of a risk-free security is 0. Why the risk of a risk-free security is 0? Because X for all the years will be same. X of a risk-free X of a risk-free security for all the years will be same, and X bar will also be same. X minus X bar will be same as 0. Risk of a risk-free security is equal to 0. Yes or no? Risk of a risk-free security 0. Why it is 0? Because P1 minus P naught plus G1 divided by P naught. For all the years it will be the same risk-free return. The rate of a return will be same every year, no uncertainty. Same return. So then X bar will also be same. If X and X bar are same, then X minus X bar will be 0. So if you take the square of a 0, 0. And overall standard deviation is equal to 0. Clear? Okay. So risk can be measured using variance or a standard deviation or a coefficient of a variance. Coefficient of variance denotes deviation per unit of mean return. So when past data is given, these are the columns. Here x, x bar, x minus x bar, x minus x bar square. Clear? When future data is given, what are the columns? So here the wrong columns are given. X, p into x, x bar, x minus x bar, p into x minus x bar whole square. P into x minus x bar whole square. Clear? Done? So in next class, we are going to discuss return and risk of a portfolio. So meanwhile, you should understand how to find out return and risk of a security. So we have discussed an example for past data and question number 1 for future data and additional question number 1. So 2 questions for future data. Okay, clear? Done? So first part of a portfolio management, return and risk of a security, return and risk of a portfolio. Okay. So a return to the equity shareholders. Equity shareholder will get return in the form of what? Capital appreciation and dividend. Capital appreciation and what? Dividend. Okay. Fine. Capital appreciation and dividend. Vaishnavi, am I audible? Jyoti, Priyadarshini, Abhimati, am I audible? Okay, fine. So return and risk of a security, return and risk of a security, and return and risk of a portfolio. So in yesterday's class, we discussed how to find out the return and risk of a security. Okay. So portfolio decision is a part of a strategic financial management. Portfolio management is a part of a strategic financial management. So portfolio decision. Portfolio means a combination of a securities such as shares, bonds, and money market instruments. Money market instruments. So what are the three major activities in portfolio management? First activity, selection of a securities based on return and risk. Based on return and risk. Next, construction of all feasible portfolios. And next, deciding the weights of different securities. And the phases of a portfolio management: first, the security analysis, portfolio selection, portfolio revision, portfolio evaluation. Okay, fine. So equity holder will get return in the form of capital appreciation and dividend. Next, debenture holder will get a return in the form of interest and capital appreciation. Interest and capital appreciation. How do we find out return? That is X. Return X is equal to P1 minus P naught plus D1 divided by P naught. P1 minus P naught is nothing but capital appreciation plus D1 divided by P naught. P naught is the investment at the beginning. Investment at the beginning. So return X is equal to P1 minus P naught plus D1 divided by P naught. Am I clear? So next, X bar. So in question, so they may give past data or a future data. Okay. So for some companies, past data may be available in the market, and for some companies, past data may not be available. So if a past data is available, then how do we get average return? By doing a simple average. By doing a simple average. But when there is no past data and when probability is given, so how do we calculate the average return? Weighted average. X bar is equal to weighted average of a security returns. Yes or no? Risk of a security can be measured using variance, standard deviation, or a coefficient of a variation. Coefficient of a variation or a variance. Okay. So risk. So why are we discussing about risk? The objective of a SFM is to maximize the wealth. Wealth depends on two factors: profit and risk. If risk increases, required rate of return increases, and if required rate of return increases, wealth decreases. Wealth decreases. Okay. If required rate of return increases, wealth decreases. Am I clear? So that's why we should keep risk as low as possible. We should keep risk as low as possible. Are you getting my point? So what is risk? Risk means a possibility of a occurrence of a loss. Possibility of occurrence of loss or possibility of a deviation from the mean or uncertainty. Uncertainty. In board material, they have given a distinction between, distinction between risk and uncertainty, but both are same, risk and uncertainty. So if there is no uncertainty, that means what? There is no risk. Future is certain or uncertain? Uncertain. So that means risk is there, yes or no? So risk means a possibility of a deviation from the mean. Okay. So what are the columns to find out the risk of a security? When the past data is given, what are the columns? X, X bar, X minus X bar, X minus X bar whole square. When probability is given, when x p into x bar, x minus x bar, p into x minus x bar whole square, p into x minus x bar whole square. So these are the columns, yes or no? Clear? Welcome to SFM class. Find me who I am. How are you? So here, so these are the, in yesterday's class we completed what return and risk of a security. Now we are going to discuss what return and risk of a portfolio. Return and risk of a portfolio. Let us start. Return and risk of a portfolio. Next 1.5 hour class is very important. Return and risk of a portfolio. 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 So our chapter name is portfolio management, and the simple point is we should make a portfolio investment so that we can diversify the risk, yes or no? Even if we lose money in one security, we may get gain in the other security. So that's why the object of making portfolio investment is to diversify the risk, reduce the risk. Okay. So portfolio means a combination of securities. First part, selection of a security is based on return and risk. So in yesterday's class, we have already learned how to find out the return and risk of a security. And we have seen rule of a dominance also. Rule of a dominance. We select a dominant securities, and a security is said to be dominating if it is giving higher return for same risk, or higher return for low risk, same return for low risk, or high return for high risk. So that's how we select the securities. That's how we select the securities, yes or no? So after selection of securities, next step is to what? Construction of a feasible portfolios. In which combination we should make an investment? We are not going to invest in one security. We are going to invest in two or more securities. So, and the second step is to construction of a feasible portfolios, and also what third step, deciding the weights, in which proportion we should make an investment. Okay, so that's why we should learn how to find out the return and risk of a what? Portfolio. Return and risk of a portfolio. So portfolio 1, 2, 3, for all the three portfolios, we find out return and risk. And then what? We select a dominant portfolio by applying rule of a dominance. By applying rule of a dominance, we select a security which is dominating. Are you getting my point? We are not going to select all the portfolios. We are going to select the best portfolio. Okay. So return of a portfolio. Return of a portfolio. So return of a portfolio, P bar. Return of portfolio. Return of a portfolio, P bar, is equal to return of a portfolio, P bar, is equal to Wx x bar plus Wy y bar, and so on. Wx means weight of a security X. WY means weight of a security Y. So return of a portfolio P bar is equal to WX X bar plus WY Y bar. Okay. So weighted average. Weighted average. Clear? So weight, nothing but proportion. So we are not going to invest into securities equally, yes or no? For example, in security X, we may invest 70%, in security Y, 30%. Yes or no? Or else X 40% and Y 60%. Okay, or else 20% and 80%. So depending upon the proportion, the return of a portfolio will change. So P bar is equal to WX X bar plus WY Y bar. Okay, and so on. So if there are two securities, then WX X bar plus WY Y bar. And if there are three securities, then what? WZ Z bar. And if there are four, W4, okay, security 4. Likewise. Are you getting my point? Okay. So return of a portfolio is nothing but what? Simply weighted average of a security return. Weighted average of a security return. Next. Do not write risk of a portfolio. Risk of a portfolio, nothing but standard deviation of a portfolio. Sigma P. Sigma P means what? Standard deviation of a portfolio. Okay, so risk of a portfolio, that is standard deviation of a portfolio, is equal to, if you apply the same logic, return of a portfolio is nothing but what? Weighted average of a security return. Yes or no? Likewise, if you apply the same logic, then risk of a portfolio is equal to weighted average of a security risk. Yes or no? Weighted average of a security risk. That means here the formula should be WX sigma X. Sigma X means standard deviation of a security X plus WY sigma Y and so on. Yes or no? So let us take two securities. If you apply the same logic, return of a portfolio is equal to WX X bar plus WY Y bar. Nothing but weighted average of a security return. If you apply the same logic, then what? Risk of a portfolio sigma P is equal to WX sigma X plus WY sigma Y. WY sigma Y. Yes or no? If you apply the same logic. Okay. But so this is not correct. So we cannot simply do the weighted average of a security risk, because you know that the main object of a portfolio investment is to diversify the risk. We cannot simply do the weighted average of a security risk, because we should consider correlation coefficient. Which denotes the closeness of a securities. How close are the securities and how the securities are moving, whether they are moving in same direction or opposite direction. So depending upon the correlation coefficient, the risk of a portfolio will be calculated. Nothing but, so here we cannot do what? Weighted average of a security risk. We cannot do weighted average of a security risk. Why we cannot do a weighted average of security risk? Because the simple reason, so the risk will get diversified when you are investing in two or more securities. Why the risk will get diversified? Securities may not move in same direction. Securities may be moving in opposite direction. If securities are moving in opposite direction, that too in proportionate manner, then what happens? If you're losing money in one security, then definitely you are going to get gain in other security. Yes or no? Even if you get loss in one security, you will get gain in other security. So the risk of a portfolio will get reduced. So that's why it cannot do a simply weighted average of a security risk. I should consider a correlation coefficient. I should consider correlation coefficient. What does it denote? Correlation coefficient. Correlation coefficient denotes closeness of a securities. It ranges from -1 to +1. It ranges from -1 to +1. Okay. So correlation coefficient, you may get -1. If you calculate the correlation coefficient between two securities. So correlation coefficient denotes what? Closeness of a securities. Closeness of a securities. Are you getting my point? It ranges from what? -1 to +1. -1 to +1. For suppose if you want to calculate the correlation between Krishnavamsi and Pooja Hegde, you will get 0. You will get what? 0. What does it mean? There is no relation. So Pooja Hegde dances. Krishnavamsi is going to dance or what? No. Krishnavamsi is listening to portfolio management class. Pooja Hegde will also listen to class or what? No. So there is no relation at all between Krishnavamsi and Pooja Hegde. So that's why you will get what? Sigma xy. Nothing but correlation coefficient 0. For suppose, okay, let us assume correlation coefficient between Krishnavamsi and Pooja Hegde is equal to +1. +1. What does it mean? For example, Krishnavamsi is standing. Pooja Hegde will also stand. Krishnavamsi is sitting. Pooja Hegde will also sit. Are you getting my point? If Krishnavamsi is coming to class, Pooja Hegde will also come to class. Okay. So sigma, if a correlation coefficient is equal to +1, what does that mean? So they are moving in same direction and in same proportion. They are moving in same direction and in same proportion. Are you getting my point? Okay. So for suppose the correlation coefficient between Krishnavamsi and Pooja Hegde is equal to -1. Okay. So that means what? Opposite. Okay. Pooja Hegde is getting married. So then Krishnavamsi is not going to get married. Are you getting my point? If she gets married, he is not going to marry. So then the correlation coefficient will be what? -1. 0 means what? No relation. So but reality is correlation coefficient is not equal to -1 or +1. There is no relation. So that means what? If you calculate the correlation coefficient between Krishnavamsi and Pooja Hegde, you will get 0. అర్థమైంది? ఎందుకంటే సంబంధమే లేదు కదా. ఉందా రిలేషన్ ఏమన్నా? లేదు కదా. So that's why what? Correlation coefficient will be 0. If a correlation coefficient is +1, that means what? Same direction. Likewise, Krishnavamsi Limited and Pooja Hegde Limited shares. So there may be a correlation coefficient. So we have to consider correlation coefficient between the two securities. Okay, K and P. K Limited and P Limited. Okay. So K Limited shares and P Limited shares, we calculate the correlation coefficient between the K Limited and P Limited shares. If the correlation coefficient is 0 between K Limited shares and P Limited shares, that means what? So not at all related. Not at all related. Are you getting my point? If a K Limited and P Limited shares are moving in same direction and in same proportion, then correlation coefficient you will get +1. For suppose K Limited share price, if it increases, P Limited share price is decreasing, then what? Minus. You will get correlation coefficient minus, because securities are moving in opposite direction. So here the point is, risk of a portfolio is not equal to the weighted average of a security risk. Risk of a portfolio is not equal to the weighted average of a security risk, because we should consider a correlation coefficient. Correlation coefficient. Correlation coefficient denotes closeness of security. It ranges from -1 to plus 1. If you are getting 103, if you are getting correlation coefficient 103 or 105, you will get 35 in SFM because you cannot get 103. Why, Varun? Anta ఆశ్చర్యపోతుంది ఏంటి? Because correlation coefficient must range from what? -1 to +1. If you're getting 103 means what? That is wrong. Any numbers, you can take any numbers. For any number you will get what? Correlation coefficient -1 to +1. -1 to what? +1. Am I clear? Okay. So next. So okay, return and risk of a portfolio. So now risk of a portfolio. For finding out the risk of a portfolio, what should we consider? We should consider what? Correlation coefficient. Okay. So the risk of a portfolio, first write down the formula. I will give you the justification later on. Sigma p, standard deviation of a portfolio. Standard deviation of a portfolio is equal to square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. So this is a formula for standard deviation of a portfolio. Wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy sigma xy. Okay. So this is the formula. So if you see the formula, this is similar to what? A square plus b square plus 2ab. Yes or no? So this is a square b square 2ab. So a square b square plus 2ab can be written as what? A plus b whole square. What is a here? Wx sigma x plus b wy sigma y. Yes or no? Okay. Nothing but this will be the formula. Risk of a portfolio. Yes or no? So we can simplify this. But here we have one factor, sigma xy. But suppose if sigma xy is equal to what? If sigma xy is equal to 1, sigma xy is equal to 1, then what? If sigma xy is equal to 1 means what? Plus 1. If sigma xy is equal to plus 1, then obviously this will be what? A square plus b square plus 2ab. Then you can write it as a plus b whole square. Square and square root will get cancelled and the formula will be wx sigma x plus wy sigma y. Clear? Okay. So but sigma xy, that means this happens only if sigma xy is equal to plus 1. Sigma xy plus 1 means what does it indicate? Securities are moving in same direction, same proportion. So that's why if securities both are moving in same direction and in same proportion, what does that mean? Risk cannot be diversified. If you get loss in X, you will get loss in Y also. Are you getting my point? If you get loss in X, if you will get getting loss in Y also. So if sigma xy is equal to plus 1, if sigma xy is equal to plus 1, what does that mean? If sigma xy is equal to plus 1, risk cannot be diversified because both the securities are moving in same direction and in same proportion. So that's why risk cannot be diversified. Clear? So then answer is what? Then what is the formula? No doubt the above formula you can apply. Sigma P is equal to Wx sigma x plus Wy sigma y. Okay. Clear? Wx sigma x plus Wy sigma y. Nothing but simply you can do the weighted average of a security risk when sigma xy is equal to plus 1. Clear? So next. So there can be another scenario. Sigma xy can be minus 1. Correlation coefficient can be minus 1. Then this will be a square plus b square minus 2ab. A square plus b square minus 2ab. Nothing but this can be written as what? A minus b whole square. Square and square root will get cancelled. And you will be left with a minus b. Nothing but what is the formula? Wx sigma x minus Wy sigma y. Simple. So this is not a weighted average. This is not a weighted average because Wx sigma x minus, we are not adding, Wx sigma x minus Wy sigma y. The risk will get reduced. Minus, in between there is a minus, yes or no? And when sigma xy is minus 1, the securities are moving in opposite direction and in same proportion. Okay. Opposite direction and in what? Same proportion. Same proportion. Clear? Okay. So when sigma xy is equal to minus 1, then you can simply write sigma p is equal to what? Wx sigma x minus Wy sigma y. Clear? Are you getting my point? So there can be another scenario. Sigma xy can be what? 0. If it is 0, that 2ab part will be 0. That 2ab part will be 0. And what? So what is the formula? Square root of a square plus b square. Square root of a square plus b square. Clear? Square root of a square plus b square. So what is this correlation coefficient? How do we calculate this correlation coefficient? And sigma p also. So this is the formula sigma p. So Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy sigma x sigma y sigma xy. Or write down another formula. Or square root of Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy covariance of a x comma y. Covariance of a x comma y. Covariance of a x comma y. After 1.5 hours, you will get clarity. So Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy covariance of a x comma y. Okay. Now so first step, I mean, if you want to find out the risk of a portfolio, sigma p. Sigma p. So what is the sigma p formula? Square root of a Wx square sigma x square plus Wy square sigma y square plus 2Wx Wy sigma x sigma y sigma xy. First you should know the procedure. Okay. I will explain the concept, but write down the steps. The first step. See the formula, what you require. weights will be given in the question. Generally, weights will be given in the question. Yes or no? We cannot calculate because they have to be given in the question. In which proportion the investment is made. So that will be given in the question. Yes or no? Wx and Wy. What about sigma x and sigma y? Sometimes they may give in the question, but most of the times they may not be giving sigma x, sigma y. So how do we get sigma x? Sigma x. What are the columns for sigma x? X, x bar, x minus x bar, x minus x bar whole square. Sometimes in the question they may give sigma x. Sometimes they may not give. Yes or no? So that means what? We have to calculate sigma x by taking a table. What is the table columns? What are the table columns? X, x bar, x minus x bar, x minus x bar whole square. But when there is a probability, what are the columns? X, p into x, x bar, x minus x bar, p into x minus x bar whole square. Yes or no? Now the point is, in question, they may ask you from the scratch. That means they may not be giving you x also. They may not be giving you x also. Yesterday we have done a question, yes or no? So we have to calculate from what? X. They will be providing P1, P0 and D1. Yes or no? So that means the first step will be, you should start from calculating X, X bar, Y, Y bar. Yes or no? X, X bar, Y, Y bar. Yes or no? Then only you can find out what? Sigma x. Second, you can find out what? If you have a x, x bar, y, y bar, you can find out what? Sigma x, and what? Sigma y. Sigma x and sigma y. Okay. So after finding out sigma x and sigma y, can you find out sigma p directly? You cannot find out sigma p directly because you require what? Sigma x y. Sigma x y. But we cannot directly find out sigma x y. So for finding out sigma x y, we require covariance of x comma y. We should find out what? Covariance of x comma y. Covariance of x comma y. Okay. So if you are finding after finding out covariance of x comma y, you can find out sigma p by applying the second formula. So what is the second formula? Wx square sigma x square plus wy square sigma y square plus 2wx wy covariance of x comma y. Okay. So we are going to discuss concept also. Wait for some time. So covariance of x comma y. Clear? But instead of applying the second formula, fourth step, you can find out what? Sigma xy. What is the sigma xy? Correlation coefficient between security x and y. Correlation coefficient between the security x and y. Correlation coefficient. Sigma xy means what? Correlation coefficient between security x and y. Sigma xy. If you are finding out sigma xy, then what? Then what? Last step, fifth step, sigma p. If you are finding out sigma xy, the benefit is, for suppose if you're finding out sigma xy, then what is the benefit? For suppose, let us assume if sigma xy is equal to plus 1. Sigma xy is equal to plus 1. You got sigma xy plus 1. Then what? Fifth part, sigma p. Instead of applying the lengthy formula, you can use a simple formula. What is a simple formula? Wx sigma x plus wy sigma y. For suppose you got sigma xy minus 1, then wx is sigma x minus wy sigma y. That means your calculation will get simplified. Yes or no? For suppose if you get sigma xy 0, then what? Square root of wx square sigma x square plus wy square sigma y square. So that is the benefit if you calculate what? Sigma x y. So this is the process. This is the process. And sigma x y ranges from what? Minus 1 to plus 1. Minus 1 to plus 1. Covariance of xy ranges from minus infinity to plus infinity. Minus infinity to plus infinity. Covariance of x comma y ranges from minus infinity to plus infinity. Minus infinity to plus infinity. Am I clear? Done. So these are the steps, okay? So sometimes in question directly they may give sigma x, sigma y and sigma xy also, and they will ask you to find out what? Sigma p. Directly you can substitute the values. Yes or no? Sometimes we should start from what? Calculation of x. How do we get x? P1 minus P naught plus D1 divided by P naught. Okay? Am I clear? So now, so let me take examples. Example number 1, write down the examples to understand the concept. Example number 1. Example number 1. So for this example, you're going to get sigma xy plus 1. For this example, you're going to get sigma xy plus 1. So example, here x, y. Here 1, 2, 3, x 10, 15, 25. Sorry, 20. 10, 15 and 20. Security X returns. Security X returns. So what are the security X returns? 10, 15, 20. First year 10% return. Second year 15. Third year 20%. Okay. And the security Y. 12, 14, 16. 12, 14, 16. Okay. So now tell me, security X returns year 1 10%, year 2 15%, year 3 20%. What about security Y? Year 1 12%, year 2 14%, year 3 16%. Now tell me whether the securities are moving in same direction or opposite direction. Securities are moving in same direction because X return is increasing, Y return is also increasing. So now tell me whether the securities are moving in same proportion or not. Same proportion. Securities are moving in same proportion or not. So securities are moving in same proportion. So when X is increasing by 5%, Y is increasing by 2%. Same proportion. I'm not talking about same percentage, same proportion. When X is increasing by 5%, Y is increasing by 2%. So that means what? Securities are moving in same proportion and same direction. Then obviously you will get sigma xy plus 1. You will get sigma xy plus 1. Okay. So now see the steps. What is the first step to find out the sigma p? First x, x bar. Y bar, yes or no? So we already have a x. Already we have a x. We need not calculate, yes or no? Y is also there. So directly we can approach. So nothing but sigma x, sigma y. Directly we can start what? Sigma x, sigma y. So write down the solution. So first sigma x. So what are the columns for sigma x? Here x, x bar, x minus x bar, x minus x bar whole square. So these are the columns. Yes or no? Risk means a possibility of a deviation from the mean. So we are calculating risk for the past data. Here column 1, 2 and 3. So what is x? 10, 15, 20. So total 45. X bar 15. X bar 15. X minus x bar minus 5. 0 plus 5. Can we take the total of x minus x bar? If you take the total of x minus x bar, you will get 0. Yes or no? So that's why we should take square. Minus 5 square 25. 0, 25. 50. So 50 x minus x bar square. Summation sigma x minus x bar square. So we need sigma x. Sigma x is equal to square root of 50 divided by 3. Yes or no? Square root of summation sigma x minus x bar square divided by n. So square root of 50 divided by 3. So what is the answer? 4.0. Are you able to understand the concept how to find out the sigma x and y? This is what sigma x. Online students, please do watch the yesterday's class. Otherwise, you may not be able to understand this class, okay? Please do watch the yesterday's class. Otherwise, you feel demotivated. So sigma x is equal to 4.082 percentage. Clear? Likewise, we should find out for what? Sigma y. Okay, by seeing the numbers, just wait. By seeing the numbers itself, we can say security y will have a lower standard deviation. By seeing the numbers, we can say y will have a lower standard deviation. Yes or no? 10, 15, 20, there is 5 deviation. But whereas y, only 2 deviation. Okay, so sigma y. So what are the columns sigma y again? Here y, y bar, y minus y bar, y minus y bar square, y minus y bar square. So tell me 1, 2, very good Amma, 3. Next y, 12, 14, 16. Total 42 divided by 3. 14 minus 2, 0 plus 2. 4, 0, 4. 8. Yes or no? So next sigma y is equal to square root of 8 divided by 3. 1.6633. By seeing the numbers, we can say y will have a lower standard deviation. So what is the standard deviation of security y? 1.633. Okay, so ultimately we have to find out what return of a portfolio and what risk of a portfolio. So what are the steps? X bar, y bar, sigma x, sigma y. What is the next one? Covariance of a x comma y. Covariance of a x comma y. It ranges from what? Minus infinity to plus infinity. Covariance of x comma y, it denotes co-movement of a securities. Co-movement. It ranges from minus infinity to plus infinity. Nothing but covariance, it denotes in which direction the securities are moving, whether they are moving in same direction or opposite direction. It will just denote the direction, covariance. But whereas correlation coefficient denotes closeness of a securities. How close are the securities? Nothing but, so correlation coefficient denotes what? Direction as well as what? Whether they are moving in same proportion or a different proportion. But covariance just denote what? The co-movement of securities. How close are the securities and how they are moving. Okay, are you getting my point? So, covariance of x comma y, columns. Here, x minus x bar, y minus y bar, x minus x bar into y minus y bar. Understand why these columns are being taken. Covariance denotes co-movement of securities. How the securities are moving, whether they are moving in same direction or opposite direction. Here 1, 2 and 3. X minus x bar minus 5, 0, 5. So what is y minus y bar? Minus 2, 0, 2. By seeing these numbers, we can say the both x and y are moving in same direction. When x deviation is negative, y deviation is also negative. When x deviation is positive, y deviation is also positive. Yes or no? So deviation of x into deviation of a y. We are multiplying what? Deviation of x with deviation of a y. If there are two minus, minus and minus will get cancelled and it will be plus. Yes or no? If there are two plus, a plus. So ultimately you will get covariance what? Positive. You will get covariance positive. That means securities are moving in same direction. So minus 5 into minus 2. 10, 0, 10, 20. So covariance of x comma y. Covariance of x comma y is equal to covariance of x comma y is equal to summation sigma x minus x bar into y minus y bar divided by n. We should do an average. So that 20 is what? 20 is nothing but what? 20 is nothing but summation sigma x minus x bar into what? Y minus y bar. So that is equal to 20 divided by 3. So the answer is 6.67. So 6.67% is what? Covariance of x comma y. Positive. So I have already told you covariance of x comma y ranges from minus 1 to plus 1. Minus infinity to plus infinity. Minus infinity to plus infinity. It just denotes the co-movement of securities. how the securities are moving. So here 6.67 means what? The securities are moving in same direction and in same proportion. And be careful, the 6.67 is 6.67 percentage square. Percentage square. Okay. 6.67 percentage square, because x minus x minus x bar, y minus y bar. You are multiplying percentage into percentage. Nothing but, okay, later on in question number 31 I will explain. So right now you just write 6.67. 6.67. What is the 6.67? Covariance of a x comma y. So here number has no relevance, but sign has a relevance. Positive, negative. Positive means what? Moving in same direction. Negative means what? Opposite direction. That's it. Okay, covariance of x comma y. Next, sigma xy. Sigma xy is equal to covariance of x comma y divided by what? Sigma x, sigma y. Sigma xy is equal to covariance of x comma y divided by sigma x, sigma y. This number will denote what? Closeness of securities. So covariance of x comma y. Nothing but in denominator x minus x bar into y minus y bar. In numerator x minus x bar into y minus y bar. In denominator what? X minus x bar square into y minus y bar square. Correlation coefficient. What is the covariance of x comma y? 6.67 divided by 4.082 into 1.633. You will get 1. You will get 1. So that by seeing example itself we can say you will get sigma xy plus 1. Why the reason? Because securities are moving in same direction and in same proportion. So clear? So sigma xy plus 1. Okay. So now so return of a portfolio P bar. Return of a portfolio P bar. What is the formula? Wx sigma x plus wy sigma, sorry, I'm sorry. P bar is equal to wx x bar plus wy y bar. P bar means return of a portfolio. P bar means return of a portfolio. How do I get return of a portfolio? Wx x bar plus wy y bar. So weights, I have not given an example. Let us assume weights 60 40. 60 40. 60 40 means 0.6 into what is x bar? 0.6 into 15 plus 0.4 into 14. 0.6 into 15 plus 0.4 into 14. 0.6 and 0.4. Better you write down in the example, in the question. Weight of x is equal to 0.6. Weight of y is equal to 0.4. So what is the answer? 14.6%. 14.6% is. 14.6%. Am I clear? %14.6. Am I clear? So what about sigma p? Sigma p is equal to wx sigma x plus wy sigma y. So 0.6 into, so 0.6 into what? 4.082 plus 0.4 into 1.633, 3.102. Simply we can do a weighted average of a security risk, because sigma xy is equal to what? Plus 1. Sigma xy is equal to plus 1. Am I clear? Sridharan, online students, please do watch the yesterday's class, otherwise you may not understand today's class. So sigma p is equal to 3.1024. Sigma p. Okay, clear? Okay. So understand the covariance formula also. You know the logic for sigma x and sigma y. Yes or no? Covariance of x comma y. So what are the columns? Dx, deviation of x, deviation of y, dx into dy. Covariance denotes what? A co-movement of securities. So that's why we are multiplying deviation of x with deviation of y. Minus into minus plus. Yes or no? Plus into plus. Plus. So that means what? Securities are moving in same direction. So covariance denotes only the co-movement of securities. So that's why covariance of x comma y formula is summation sigma x minus x bar into y minus y bar divided by n. For suppose if there is a probability, be careful, if there is a probability, then summation sigma p into x minus x bar into y minus y bar. Summation sigma p into x minus x bar into y minus y bar. And next sigma xy is equal to covariance of x comma y divided by sigma x sigma y. It denotes closeness of what? Securities. It denotes closeness of securities. Closeness. Here plus 1. Plus 1 means what? Securities are moving in same direction. That we know from covariance of x comma y also. That securities are moving in same direction. And in same proportion. Securities are moving in same, okay, direction and same proportion. Clear? Okay. Done. So this is the example when sigma xy is equal to what? Plus 1. Next. Next, write down the example for what next? Sigma xy is equal to minus 1. Example 2. Now you will get sigma xy is equal to what? Minus 1. Now you will get sigma xy is equal to minus 1. Okay, here x y 1 2 3 25 40 and 55. 25 40 and what? 55. Okay, so y 40 35 30. Okay, so again take weights, same weight 60%, and what 40%. X 60%, Y 40%. Risk cannot be negative. Risk either it can be 0 or more than 0. Risk. ఎప్పుడు నెగిటివ్ రిస్క్ ఉండదు. If you are sitting idle, risk is 0. You may not get loss. That's it. Yes or no? Profit either రాదు కదా. Okay. So for this question, so we have to find out what? First sigma x and then what? Sigma y and then covariance of x comma y, sigma xy. So for this question you will get -1. Why you will get -1? Because securities are moving in opposite direction and in same proportion. Securities are moving in opposite direction and in what? Same proportion. Okay. So sigma x. Find out sigma x. So x 25, 40, 55 total 120, 40 minus 15, 0 plus 15, 225, 225, 450. Sigma x is equal to what? Square root of 450 divided by 3. 12.247 percentage. 12.247 percentage. Clear? Likewise, find out for sigma y also. Y bar y minus y bar square. ఎవరమ్మా సోడా తాగుతున్నారు? ఓకే సారీ. y bar y minus y bar square. Okay. So y. Tell me the numbers. 40, 35, 40, 35, 30. 105, 35, 35. 5, 0 minus 5. 25, 0, 25. You will get 50. So sigma y is equal to square root of 50 divided by 3. 4.082. So when sigma xy is equal to plus 1, what does it indicate? Securities are moving in same direction, same proportion. That means risk cannot be diversified. You cannot diversify the risk because both the securities are moving in same direction, same proportion. Okay. Sigma xy is equal to minus 1. So next what? Covariance of x comma y. Covariance of x comma y. What are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. So x minus x bar, what are the columns? Minus 15, 0, 15. 5, 0, minus 5. By seeing these numbers, we can say you will get covariance negative. Covariance negative, yes or no? Minus 75. You will get minus 150. So covariance of x comma y is equal to minus 150 divided by 3. Minus 50. Minus 50. Covariance of a x comma y is equal to what? Minus 50. Clear? Done? The next what? Sigma xy. Sigma xy is equal to, what is the formula? Covariance of x comma y divided by sigma x sigma y. That is equal to covariance of x comma y minus 50 divided by 12.247 into 4.082. You will get minus 1. ఆశ్చర్యపోయారా? అవసరం లేదు అది. ఎందుకని? By seeing question we can say the securities are moving in opposite direction and in same proportion. So obviously you will get sigma xy what? Minus 1. Clear? Next what? P bar. Next P bar. P bar is equal to Wx x bar plus Wy y bar. That is equal to 0.6 into 40 plus 0.4 into 35. 38 ఎవరు 90 చేశారా? ఓకే, ఫైనల్ ఆన్సర్. ఓకే, 38. సో సిగ్మా పి, సారీ పి బార్ 38%. 38%. కృష్ణవంశీ చేస్తున్నారా? అయిపోయిందమ్మా, వెరీ గుడ్. నెక్స్ట్ చాప్టర్కి వెళ్ళిపోయావా? పి బార్ 38%. నెక్స్ట్ సిగ్మా పి. We can use the simple formula instead of a lengthy formula. So no, because sigma xy is equal to minus 1. When sigma xy is equal to minus 1, we can use simple formula. What is the simple formula? Wx sigma x minus Wy sigma y. So 0.6 into 12.247 minus 0.4 into 4.082. 5.7154. 5.7154. Clear? Sigma p. Okay. So sigma p is equal to wx sigma x minus wy sigma y. So that is equal to 0.6 into 12.247 minus 0.4 into 4.082. 5.7154. Clear? So important note. When sigma xy is minus 1, when sigma xy is equal to minus 1, sigma p can be reduced to 0. When sigma xy is equal to minus 1, sigma p can be reduced to 0. Okay. By investing in by investing in optimum proportions. By investing in what? Optimum proportions. When sigma xy is equal to minus 1, sigma p can be reduced to 0 by investing in optimum best proportions. 60-40 is not the best proportion because you got 5.7154%. You got sigma p 5.7154%. But if you make a proper investment, I mean in proper proportions, the risk can be reduced to 0. Okay. So write down the formula. When sigma xy is equal to minus 1, sigma p can be reduced to 0. For that, weight of x must be equal to, for that weight of x must be equal to sigma y divided by sigma x plus sigma y. Sigma p can be reduced to 0. Sigma p can be reduced to 0. For that wx must be equal to what? For that wx must be equal to sigma y divided by sigma x plus sigma y. Nothing but that should be equal to 4.08 to a 4.082 divided by 12.247 plus 4.082. 0.249. That means instead of 60% in security X, if you invest 24.9%, the risk can be reduced to 0. Let us check. Sigma p is equal to, what is the calculation? 0.249 into 12.247 minus 0.249 into 12.247 minus 0.7751 into 4.082. You will get 0. You will get some number, but that will be close to what? 0. Okay. sigma p is equal to 0.249 into 12.247 minus 0.758 into 4.082. You will get a 0. So when sigma xy is equal to minus 1, risk can be reduced to 0. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. Okay. And for these proportions, if you want to find out return p bar, if you want to find out the return p bar, so what is the calculation p bar? 0.249 into returns 40 plus 0.751 into 35. $36.2 36.245. Okay. Without compromising much in return, we can reduce the risk to 0. Without compromising much in return, because earlier what was the return? 38. Now the return is 36.245. We are just compromising in return by 1.5% something, but whereas risk is being reduced to 0. So this happens when sigma xy is equal to minus 1. Okay. 36.245. Go through the solution. So weight of x must be equal to what? Sigma y divided by sigma x plus sigma y. Please do understand. So this when can be applied only when a sigma xy is equal to what? Minus 1. When sigma xy is equal to minus 1, risk can be reduced to 0. But for that, weight of x must be equal to sigma. So when sigma xy is equal to minus 1, when sigma xy is equal to minus 1, what is the sigma p formula? Sigma p formula. Wx sigma x minus wy sigma y is equal to what? 0. Yes or no? For us, risk must be equal to what? 0. So weight of a x into sigma x minus weight of y can be written as 1 minus w x sigma y is equal to what? 0. Yes or no? Next. Okay. So wx sigma x minus what? Sigma y plus wx sigma y is equal to 0. Let us take wx common. Then you will get sigma x sigma y is equal to what? Sigma y. So wx is equal to sigma y divided by sigma x plus sigma y. So this is the logic for the formula. So weight of a x. But we cannot derive each and every formula in portfolio management. Okay. So when sigma x is, y is equal to, when sigma xy is equal to minus 1, risk can be reduced to 0. But further weight of x must be equal to what? Sigma y divided by sigma x plus sigma y. Weight of x is equal to sigma y divided by sigma x plus sigma y. So sigma y divided by sigma x plus sigma y. Clear? This can be applied when sigma xy is equal to minus 1. So because securities are moving in opposite direction, that too in same proportion. So that's why we can reduce the risk to 0. Okay. But when it is plus 1, we cannot diversify the risk. But when it is other than plus 1, so for example 0.82 or 0.7, 0.3, minus 0.3, then we can diversify the risk. Only when correlation coefficient is plus 1, we cannot diversify the risk. Okay, clear? So next scenario, example 3. Next scenario, example 3. We have taken two examples. First example for sigma xy plus 1. Second example minus 1. Next sigma xy is equal to 0. Or sigma xy, instead of 0, let us try minus 1 to 0. Example 3. I'm taking an example such that you will get sigma xy between what? Minus 1 to 0. You will get negative, but not equal to minus 1. You will get negative. Okay. Here xy. Here x, y, here 1, 2, 3, x 20, 17 and 14. 20, 17, 14. So it is decreasing or increasing? Decreasing. To get between -1 and 0. So y should be decreasing or increasing? X is decreasing, it yes or no? To get negative, y we should take? Increasing. Yes or no? So 10, 18, 20. 10, 18 and 20. Both are moving in opposite direction and not in same proportion. Not in same proportion. Because x first year decreased by 3 and y increased by 8. Next year x decreased by 3 but y increased by only 2. Different proportion. So that's why you will get what? Negative correlation coefficient. Okay. So first we should find out what? Sigma x. Take the same proportions 60, 40. So first sigma x. Sigma x. So what are the columns? X, x bar, x minus x bar, x minus x bar square. So numbers 20, 14 total. 17, 3, 0, minus 3. 9, 0, 9. 18, huh? So sigma x is equal to square root of 18 divided by 3. 2.44. 2.44, huh? Okay, fine. Next, sigma y. Sigma y. So what are the columns sigma y? Y, y bar, y minus y bar. Okay. So y 10, 20, 48, 16, plus 6, minus 6, plus 2, plus 4. 36, 4, 16, 56. Sigma y is equal to square root of 56 divided by 3. 4.32. Clear? Next what? Covariance of x comma y. Covariance of x comma y. columns x minus x bar, y minus y bar, x minus x bar into y minus y bar. X minus x bar 3 0 minus 3 minus 6 2 4 minus 18 0 minus 12 minus 30. So covariance of x comma y is equal to minus 30 divided by 3 minus 10. Clear? So sigma xy is equal to minus 10 divided by minus 10. Sigma xy is equal to minus 10 divided by 2.4 2.44 into 4.32 minus 0. Minus 0.94. It is negative but not equal to what? 0 or minus 1. Not equal to minus 1. What does it indicate? Securities are moving in opposite direction but not in same proportion. Minus 0.94. Next number. What is the next number? 8. Okay. You should not ignore 8. Be careful. Proper rounding off has to be done in SFM especially, because value or blindly follow the suggested answer. So minus 0.948. Negative but not equal to minus 1. This means what? Securities are moving in opposite direction, not in same proportion. So now P bar. P bar. P bar is equal to, what are the weights? 0.6. 0.6 into 17 plus 0.4 into 16 16.6%. 16.6%. Am I clear? Now for sigma p, can I use the short formula, that is wx sigma x plus wy sigma y? No. Can you use wy sigma y, sorry, wx sigma x minus wy sigma y? Can you use that formula? No. I cannot use. Yes or no? Why? Because if it is plus 1, I can simplify. If it is minus 1, I can simplify. If it is 0 also, okay, fine. 2ab part will be 0. Yes or no? So it is lying between minus 1 and 0. So I have to use the lengthy formula. What is that lengthy formula? Sigma p is equal to square root of w x square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy, or in this place, instead of using sigma x sigma y sigma xy, you can write covariance of x comma y. Okay, covariance of x comma y. Instead of sigma x, sigma y, sigma xy, you can write what? Covariance of x comma y. Why? Because see the formula. How do we get sigma xy? What is the formula for sigma xy? Covariance of x comma y divided by sigma x sigma y. That means covariance of x comma y is equal to sigma xy into sigma x sigma y. Yes or no? Are you getting my point? Sigma xy is equal to, what is the formula? Covariance of x comma y divided by sigma x sigma y. Nothing but covariance of x comma y is equal to sigma x. Clear? See this formula. Sigma xy is equal to covariance of x comma y divided by sigma x sigma y. Nothing but covariance of x comma y is equal to what? Sigma xy into sigma x sigma y. Clear? Done? Clear? So substitute and tell me the answer. Sigma p. Square root of wx 0.6 square sigma x 2.449 square plus 0.4 square into 4.32 square plus 2 into 0.6 into 0.4 into minus 10 into minus 10. Or else you can write what? Instead of writing into minus 10, you can write sigma x sigma y sigma xy. That also you can write. Okay. So tell me the answer. Priya, what is the answer? Very good, Amma. 0. 0.589. Okay. 0.58. 0.5889. You should not ignore that number. 0.5889. 0.5889 percentage. 0.5889 percentage. Zero point 5889 percentage. So everybody got the answer or not? 0.5889. Done? 0.5889. Clear? Sigma p. Everybody got the answer or not? సేమ్ ఆన్సరా డిఫరెంట్ ఆన్సర్ వచ్చిందా? ఓకే. So now, when sigma xy is equal to plus 1, we cannot reduce the risk. When sigma xy is equal to plus 1, we cannot reduce the risk. Why? Securities are moving in same direction and in same proportion. But when sigma xy is equal to minus 1, we can reduce the risk to 0. We can reduce the risk to 0. Okay. So, but for that, weight of x must be equal to sigma y divided by sigma x plus sigma y. Okay. So, but when sigma xy is other than minus 1, when sigma xy is other than minus 1, for example, here we got sigma xy minus 0.94. కృష్ణవంశీ బాగా ఆవలించావు తలెత్తుకొని రికార్డ్ స్థాయిలో 30 సెకండ్లు నా కెరీర్లో ఇదే హైయెస్ట్. ఓకే. సో the next note for construction here, when sigma xy is equal to minus 1, when sigma xy is equal to minus 1, risk can be reduced to what? 0. Risk can be reduced to 0. Proudగా ఫీల్ అవుతున్నావా? Risk can be reduced to 0. Okay. So when sigma xy is other than minus 1, we cannot reduce the risk to 0, but we can minimize the risk. Okay, write down Krishnavamshi. So when sigma xy is other than minus 1, for construction of minimum risk portfolio, when sigma xy is other than minus 1, when sigma xy is other than minus 1, because when it is minus 1, we can reduce the risk to 0. Yes or no? But when it is other than minus 1, other than minus 1 means that can be minus 1 to 0 or 0 to plus 1 or 0 or 0. So for construction of a minimum risk portfolio, weight of a x must be equal to, high chances you might forget this formula, weight of x must be equal to sigma y square minus sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Sigma y square minus what? Covariance of x comma y divided by what? Sigma x square plus sigma y square minus 2 covariance of x comma y. High chances you will forget this formula. So wx is equal to, weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Okay. So this formula you can apply even when sigma xy is minus 1 also. When sigma xy is equal to minus 1 also, you can apply this formula. For example, in previous question, instead of sigma y divided by sigma x plus sigma y, you can apply this formula also. Then also you will get the same answer. But when it is other than minus 1, you have to apply only this formula. You cannot apply the previous formula. Are you getting my point? When it is minus 1, you can apply both formulas. When it is minus 1, when sigma xy is equal to minus 1, you can apply both formulas. That is, weight of x is equal to sigma y divided by sigma x plus sigma y, or sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So for example, y we can apply two formulas. When sigma xy is equal to minus 1, you need not note it down. So for example, sigma y square minus covariance of x comma y can be written as sigma x, sigma y, sigma xy divided by sigma x square plus sigma y square minus 2 into sigma x, sigma y, sigma xy. For suppose let us assume sigma xy is equal to minus 1. Sigma xy is equal to minus 1. If sigma xy is equal to minus 1, then what? Sigma y square plus sigma x, sigma y. Yes or no? Okay. Divided by sigma x square plus sigma y square plus 2 sigma x, sigma y. If I take sigma y common in the numerator, sigma y plus sigma x, yes or no? Nothing but sigma x plus sigma y. In the denominator, I can write it as sigma x plus sigma y whole square, yes or no? That is a square plus b square plus 2ab. So this square and this will get cancelled, yes or no? So what is the formula? Sigma y divided by sigma x plus sigma y. So that means when correlation coefficient is minus 1, you can apply two formulas, either of the one. So obviously I will apply what? First formula, because that is simple, yes or no? Why to complicate? Yes or no? But when correlation coefficient is other than minus 1, I have to apply only the second one to find out. So understand the sentence. What is the sentence? When sigma xy is other than minus 1, for construction of a minimum risk portfolio. If you want to minimize the portfolio, if you want to minimize the risk, weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So now let us apply the formula. So weight of x is equal to, so sigma y square, what is sigma y? 4.32 square minus covariance of x comma y minus of minus 10, yes or no? Will be plus 10. Minus of minus 10 will be what? Plus 10. 4.32 square plus 10 divided by 2.449 square plus 4.32 square minus plus 20, yes or no? Plus minus of minus plus, yes or no? Plus 20. So 4.32 square plus 10 divided by 2.449 square plus 4.32 square plus 20. 0.6 0.642. That means weight of a y must be equal to 0.358. 0.358. Yes or no? Clear? Huh? Presently we are following 60-40. Presently we are following what? 60-40. Instead of 60-40, if you change the proportions, phases of portfolio management, portfolio revision, deciding the weights of each security, suppose instead of 60-40, right now the weights are 60-40. Instead of 60-40, if you follow the weights of 0.642 and 0.358, what happens? The risk will further get reduced, but it will not be equal to 0, because here sigma xy is not equal to what? -1. But risk can be further reduced. Let us check whether risk is getting reduced or not. Once again, let us find out what sigma p. Let us find out sigma p with new weights. Sigma p is equal to sigma p is equal to sigma p is equal to square root of so 0.642 square into 2.449 square, yes or no, plus 0.358 square into 4.32 square plus 2 into 0.642 into 0.358 into minus 10. Clear? 0.642 square plus 2.449 square. Sorry, 0.642 square into 2.449 square plus 0.358 square into 4.32 square plus 2 into 0.642 into 0.358 into minus 10. 0.5 0.517. Earlier the answer is 0.5889. From 0.5889 the risk has got reduced to 0.517. The deviation has got reduced. Yes or no? From 0.5889 it has got reduced to 0.517. నెంబర్స్ కరెక్ట్గానే చెప్తున్నారు కదా, బ్లైండ్గా నమ్ముతారు మిమ్మల్ని. నా కెరీర్ని నాశనం చేయొద్దు. ప్రియదర్శిని, వాట్ ఈస్ ద నెంబర్? షీనా శ్రీధరన్, చిట్టి శ్రీకరి, గోపాల్ వర్మ, అభిమతి, వైష్ణవి గణేశన్, ఫైండ్ మీ హూ ఐ యామ్. నేను ఎందుకు కనుక్కుంటా చెప్పు. So sigma p, what is the answer? 0.517. So there can be two other examples. We have done 3 examples. There can be 2 other examples. One is for 0, Zero means what? No relation between two securities. For example, risk-free security and risky security. Risk-free security, treasury bill is a risk-free security. If you want to find out the correlation coefficient between the risk-free security, that is treasury bill and Reliance share, you will be finding no relation. Why? Treasury bill is risk-free. Risk-free means no uncertainty. Every year you will get same rate of a return. Bonds, treasury bonds. Okay. So government bonds, every year you will get same rate of a return. Every year you will get same rate of a return. Every year. Okay. But whereas what happens to the risky security? Risky security means the shares, equity shares in the market. Equity shares in the market, they are risky. They are risky. So there is no relation between what risky security and risk-free security. Risky security return may increase or decrease, but risk-free security return will remain same, constant. Adho risk-free security. Risk-free security, and you know the meaning, yes or no? No uncertainty. Every year investor will get same rate of a return. Okay. For suppose if you are investing in risk-free security and one risky security, the risky security return may increase or decrease, but risk-free security return will remain same. If you calculate the correlation coefficient between these two securities, that is risk-free security and risky security, then you will get 0. You will find no relation. Adho no relation between the risky security and risk-free security. So what can be the fifth example? Correlation coefficient may lie between 0 to 1. So here we have taken an example for what? 0 to -1. -1 to 0. Nothing but there can be 5 scenarios. There can be how many scenarios? 5 scenarios. What are the 5 scenarios? -1, +1, 0, 0 to 1. Clear? So there can be 5 scenarios. There can be 5 scenarios. So return of a portfolio. Return of a portfolio is nothing but what? Weighted average of a security returns. Return of a portfolio is nothing but what? Weighted average of a security return. Let us conclude, okay? Return of a portfolio is equal to Wx x bar plus Wy y bar. Okay. So we can write otherwise also WA ARA. ARA means average return of a security A. But that will take time. So that's why in order to save time, let us write Wx x bar plus Wy y bar. When portfolio is consisting of 3 securities, if portfolio is consisting 3 securities, then what? Wx x bar plus Wy y bar plus Wz z bar and so on. 4 securities, so on. But generally in examination, 2 securities or 3 securities will be given. But practically, even a person, even your friend who is having 1 lakh will be investing in 10 shares. Yes or no? Even in your friend circle, one of your friend might have invested in what? A stock. He might have invested in portfolio. He might have invested in 10 securities. But whereas in classroom or in examination, we are going to calculate return and risk of portfolio consisting of 2 securities or 3 securities. 2 or 3, that's it. Okay. So why only 2 or 3? Because simple. What is the risk of a portfolio formula? Square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. When there are only two securities, first suppose there are three securities. If there are two securities, the formula is a plus b whole square. If there are three securities, then a plus b plus c whole square. Then what is the formula? Square root of wx square sigma x square plus wy square sigma y square plus wz square sigma z square plus 2wx wy sigma x sigma y sigma xy plus 2wx wz sigma x sigma z sigma xz plus 2wy wz sigma y sigma z sigma yz. So maximum they will be giving a portfolio consisting of three securities. That is common. In exams you will get a portfolio consisting of what? Three securities. If portfolio is consisting of three securities, then formula will be similar to what? A plus B plus C whole square. But they will not be giving a portfolio consisting of what? Four securities. If they are giving a portfolio which is consisting four securities, then it is similar to what? A plus B plus C plus D square. So that will become complicated. So that's why they will not give portfolio consisting of what? Four securities. In that case, what we should take? A square plus B square plus C square plus D square plus 2AB plus 2BC, like this and so on. So generally they will be giving portfolio which is consisting of what? Two securities or three securities. Okay, clear? So covariance ranges from what? Covariance ranges from minus infinity to plus infinity. It is an absolute measure of co-movement between two variables. Co-movement between two variables. Krishnavamsi. When past data is given, so what is the formula for covariance of x comma y? Summation sigma x minus x bar into y minus y bar divided by n. But instead of by hearting the formula, columns are important. We should take x minus x bar, y minus y bar, x minus x bar into y minus y bar, and then divide with n. So be careful when the probability is given. When probability is given, then what is the formula? Summation sigma p into x minus x bar into y minus y bar. Okay, we should not divide with n, but generally people will do. Okay, so what are the columns to be taken? P x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. Clear? And what is the other formula? Covariance of x comma y is equal to sigma x, sigma y, sigma x y. Clear? So this I have to discuss. I will be discussing later on. So sigma m square means variance. Sigma m square means what? Variance. Sigma m means market. M means market. Sigma m square means what? It denotes variance of a market. So that again I will discuss. Next, correlation coefficient. Correlation coefficient, it measures the closeness of relation between two random variables. Two random variables. Yes or no? So correlation coefficient ranges from -1 to +1. Okay. Other than the closeness. Correlation coefficient between Krishnavamsi and Pooja. 0. No relation. So mostly husband and wife correlation coefficient will be boyfriend and girlfriend. Correlation coefficient will be what? Minus. At least it will be negative. Yes or no? So sigma AB is equal to 0. Sigma AB is equal to 0. It indicates what? No relation between the securities. Then sigma P is equal to square root of a square plus b square. Yes or no? Wx square sigma x square plus wy square sigma y square. Okay. So when sigma AB, whenever sigma xy is equal to minus 1, sigma xy is equal to minus 1, husband and wife, it indicates what? Perfect negative. That is what? Securities moving in opposite direction proportionately. Then sigma P is equal to, risk of a portfolio is equal to what? Wx sigma x minus Wy sigma y. Okay. In this case, risk can be reduced to what? 0. Risk can be reduced to 0. For that, Wx is equal to sigma y divided by sigma x plus sigma y. Yes or no? Wx is equal to sigma y divided by sigma x plus sigma y. Okay, in concept you will find A and B. Okay. However, when sigma xy is other than minus 1, for construction of a minimum risk portfolio, so weight of x is equal to, నీ రికార్డ్ బ్రేక్ చేసింది మా అమ్మాయి, నీ రికార్డ్ బ్రేక్ చేసింది. ఓకే, ఫీమేల్ కేటగిరీలో అమ్మాయికి ఫస్ట్ ప్రైజ్ ఆవలింతలో. సో వెయిట్ ఆఫ్ ఎక్స్ ఈజ్ ఈక్వల్ టు, వెయిట్ ఆఫ్ ఎక్స్ ఈజ్ ఈక్వల్ టు సిగ్మా వై స్క్వేర్. చాలా సంతోషంగా ఉంది కదా, మనల్ని తిడితే బాధ వేస్తుంది, కానీ మనకన్నా వేరే వాళ్ళు ఇంకా ఎక్కువ తిడితే ఆ సంతోషం ఉంటుంది చూసావా. రైట్ నో కృష్ణవంశీ టాప్ ఆఫ్ ద వరల్డ్. ఓకే, డబ్ల్యూ x is equal to weight of x when sigma xy is other than minus 1. Weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Okay, so clear. So when sigma xy is equal to plus 1, when sigma xy is equal to plus 1, it indicates perfect positive. It indicates what? Perfect positive. That is, securities moving in same direction and in same proportion. Krishnavamshi and his son, correlation will be plus 1. Okay, perfect positive. అంతే కదా. ఫాదర్ ఎలా ఉంటే సన్ కూడా ఏం చేస్తాడు? సేమ్ అంతే చేస్తాడు జనరల్గా. ఓకే, చూసి నేర్చుకుంటుంటారు. సో జనరల్లీ కోరిలేషన్ కోఎఫిషియంట్ బిట్వీన్ ఫాదర్ అండ్ సన్ విల్ బి వాట్? జనరల్లీ ప్లస్ 1. ఓకే, సో దెన్ సిగ్మా పి ఈజ్ ఈక్వల్ టు డబ్ల్యూఎక్స్ సిగ్మా ఎక్స్ ప్లస్ డబ్ల్యూవై సిగ్మా వై. ఓకే, సో నెక్స్ట్ sigma xy lies between minus 1 and 0. It indicates what? Security is moving in opposite direction but not in same proportion. Sigma xy lies between 0 and 1. Security is moving in same direction but not in same proportion. Clear? అర్థమైందా? ఓకే, సో కోరిలేషన్ కోఎఫిషియంట్ ప్లస్ 1 అంటే సేమ్ డైరెక్షన్ సేమ్ ప్రపోర్షన్. డన్. Risk of a portfolio, you know the formula risk of portfolio. What is the formula risk of portfolio? Square root of wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy. When 3 securities, you know, okay, the formula, yes or no? And we have discussed the rule of dominance. So one security is said to be dominating the other security if Manasa. One security is said to be dominating the other security if it is giving a high return for same risk, same return for lower risk, higher return for lower risk, higher return for higher risk. So clear? Okay, done. Break తీసుకొని later on we can start. Okay, 11:20, 15 minutes break. We shall start again at 11:35. 11:35 Krishnavamshi. Okay, thank you so much for your patience. ఈ 15 minutes లో కూడా from the beginning you just recall the formulas and maintain the link. what is SFM, why portfolio management, why risk and return, and how to find out the return and risk of a security, and how to find out the return and risk of a portfolio. What is this correlation? What is this covariance? And if they ask you to find out the risk of a portfolio, what is the first step? You have to visualize the steps. First, we should find out x bar. Next, sigma x, sigma y, covariance of x, y, sigma. I have not given example for 0, sigma x, y, 0. But generally, the correlation coefficient between the risk-free security and the risky security will be 0. Clear? Okay. So once recall the formulas from the beginning. The weightage of this chapter is 14 plus 3 to 4 multiple choice questions. The overall weightage is about 20. And without knowing the portfolio management, derivatives, we cannot understand derivatives and mutual funds as well. So clear? Done? So instead of wasting time, picking the phone and starting chatting or something, Krishnavamsi, just recall the formulas from the beginning, okay? అదేనా ఫోన్ చాటింగ్ అది చేయకుండా ఏం చేస్తావు? ఓకే, రీకాల్ ఫ్రమ్ ద బిగినింగ్. థ్యాంక్ యూ. 11:40కి రండి, ఇక్కడ 2 minutes అయిపోయాలండి. See the next question. So the next question. So next question. So question number 2. Past examination question, CA final and CMA final past examination question. Covariance and the correlation coefficient. The historical rates of a return of a two, the historical rates of a return of a two securities over the past 10 years are given. Calculate the covariance and the correlation coefficient of the two securities. Year 1 to 10 years, security 1 and security 2. So they are asking you to find out what covariance and correlation coefficient. So how do we get covariance? So when the past data is given, how do we get the covariance? Summation sigma x minus x bar into y minus y bar divided by n. Yes or no? So nothing but we take a table. So what are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. Okay. What about the correlation coefficient? Covariance of x comma y divided by sigma x sigma y. Nothing but we should find out sigma x and sigma y also. That means what should be the first step? Sigma x, then sigma y, then covariance of a x comma y, and then what? And then correlation coefficient. Correlation coefficient. Okay. Clear? So let us start the question. Question number 2. Solve this question within 13.65 minutes. Question number 2. We have to solve this question within 13.65 minutes. That is the time allowed for 7 marks question. Okay. So you know the procedure, right? First we should find out what sigma x, then what sigma y, and then what covariance of x comma y, then what sigma xy. So these are the steps. So these are the steps. Okay. So try to solve this question within 13.65 minutes. Okay. Varun, help me. Let us find out together. Okay. So what is the first one? Sigma x. So what are the columns? We should take a heading calculation of a standard deviation of a security x. Calculation of standard deviation of security 1, I think. Security 1. That is sigma x. That is sigma x. So what are the columns? Year, x, x bar, x minus x bar, x minus x bar whole square. Okay. Here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. X 12, 8, 7, 14, 16, 15, 18, 20, 16, 22. So the total 148. That means x bar 14.8. Risk means a possibility of a deviation from the mean. That is what we are finding out. X minus x bar. X minus x bar. Minus 2.8. Minus 6.8. Minus 7.8. Minus 0.8. 1.2. 0.2. 3.2. 5.2. 5.1.2. 7.2. X minus x bar square 7.84. 46.24, 60.84, 0.64, 1.24, 1.44, 0.04, 10.24, 27.24, 27.04, 27.04, 1.44, 51.84, 207.6, 207.6. So standard deviation of security X is equal to square root of 207.6 divided by 10. So 4.56% is the standard deviation of a security X. Standard deviation of a security X, 4.56. Is it correct or not? Everybody got the same answer or not? 4.56. Priyadarshini, Vaishnavi Ganeshan, Abhimathi. So clear? So likewise, we should find out for what? So calculation of standard deviation of standard deviation of a security 2. Calculation of a standard deviation of a security 2. Mohit Singh, Abhimati, everybody online students, are you doing this question or not? Calculation of a standard deviation of a security 2. That is sigma y. Here y, y bar, y minus y bar, y minus y bar square. Try on your own instead of copying. Here Komali చేస్తున్నారా 7 8 Emma Manasa here 1 2 3 4 5 6 7 8 9 10 y 20 22 24 18 15 20 24 25 22. Okay, y bar. So total 2 10. So y bar 21. Next y minus y bar minus 1 1 3 minus 3 minus 6 minus 6 minus 1 3 4 1 minus 1. Y minus y bar square 1 9 9 36. If you're using a calculator for 1 square, 3 square or 6 square, then you have to see your face in a mirror. Okay, 9 16 1 1 84. So sigma y is equal to square root of 84 divided by 10. 2.898. కృష్ణవంశీ అంతేనా? 2.898. 2.898. Sai Krishna. All Sai's. Same answer. Yes or no? 2.898. నీ పేరేంటన్న మోడల్? భార్గవ్. సారీ భార్గవ్. Sigma y is equal to 2.898. 2.898. కనిపిస్తున్నాడు. 2.898 sigma y. Next, what is the next part? Covariance of x comma y. Covariance of x comma y. Covariance of security 1 and 2. Security 1 and what? Security 2. చేస్తారా? Covariance of security 1 and 2. So understanding the concept is not enough. You have to solve the question within 13.65 minutes. That is also very important. So what are the columns? Here x minus x bar, y minus y bar, x minus x bar into y minus y bar. Bhargav చేసారా? Here 1 x minus x bar minus 2.8 minus 6.8 minus 7.8. Okay, minus 0.8 1.2 0.2 3.2 5.2 1.2 1.2. Next 7.2. Clear? X minus x bar. Next what? Vaishnavi Ganeshan Chitti Srikari. Covariance minus 0.8. Very good, Amma. Next y minus y bar minus 0. Y minus y bar minus 1 1 3 minus 3 minus 6 minus 1 3 4 1. X minus x bar into y minus y bar 2.8 minus 6.8 minus 23.4 2.4 minus 7.2 minus 0.2 9.6 23.20. Sir, కోపడకండమ్మా. 20.8. Next 1.2 minus 7.2 minus 8. Okay. So covariance of x comma y. Bhargav minus 8 divided by 10 minus 0.8. Next, correlation coefficient. Correlation coefficient sigma xy is equal to minus 0.8 divided by 4.56 into 2.898. 0. Minus 0. 0. Minus 0. 0. Minus 0.0606. Minus 0.0606 వచ్చిందా? So what is the correlation coefficient? Vaishnavi Ganeshan, what is the answer? Manasa, minus 0.06. Okay. Minus 0.606. Okay, fine. Priyadarshini is minus 0.06053. Okay, fine. This is the correlation coefficient. This is the past examination question, CA and CMA. So each and every question in portfolio management was a past examination question. Each and every question. Okay, clear? మార్నింగ్ క్లాస్లో ఇక్కడ ఒక సూట్ వేసుకుని ఒక అతను ఉన్నారు కదా, నువ్వేనమ్మా? ఓకే ఓకే. సో నెక్స్ట్, see the question number 3. Question number 3. So this is also a past examination question. So question number 1 is not for practice. Question number 2 is also not for practice. Question number 3 is also not for practice. Okay. So right now we are going to practice, but okay. So during preparation time or on day before examination, especially on day before examination, the question number 1 and 2, 3 are not for practice. I will mention which question to be practiced. Okay. So question number 3, return and risk of a portfolio. Mr. A is interested to invest rupees 1 lakh in the securities market. He selected two securities B and D for this purpose. The risk and return profile of the securities are as follows. Security B, D. Security B, D. Risk 10%, 18%. Expected return 12%, 20%. Coefficient of a correlation between B and D is 0.15. Risk and return of securities already given. Correlation coefficient is also given. Correlation coefficient. What is the correlation coefficient? 0.15. You are required to calculate the portfolio return of the following portfolios of B and D to be considered by A for his investment. First one, we are required to calculate portfolio return. How do we get portfolio return? By doing a weighted average of a security return. Yes or no? So next, 100% investment in B only. A is considering to invest 100% investment in B only. Okay. If he invests 100% in B, then return will be 12%. Yes or no? If he is going to invest 100% in B only, then he is going to get 12%. Okay. What about risk? 10%. Very good, Amabargo. Next, second one, 50% of the fund in B and 50% in D. 50% in B and 50% in D. So how do we get portfolio return? By doing weighted average. So 50% into 12 plus 50% into 20. 16. 16 percentage. Yes or no? 16 percentage is the answer. 12% into 50%. We should not use calculator for this. 6 plus 50% into 20. 10. 10 plus 6, 16. Okay. Portfolio return. 75% of the fund in B and 25% in D. So 12 into 75%. 9 plus 20 into 25%. 5. 14% is the portfolio return. What is the next one? 100% investment in D only. 100% investment in D only. So 100% investment in D only. Then what? 20%. Simple. Portfolio return. Also indicate that which portfolio is best from risk as well as return point of view. So they're asking to find out risk also, because we have to mention which is best one from the return point of view as well as risk point of view. First case risk is equal to what? 10%. Last case, that is 100% investment in D only, then risk is equal to 18%. Risk is equal to 18%. We need not apply any formula, yes or no? But whereas for second and third case, to find out the risk, we should apply the formula. What is the formula? Square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma x5. So we have to apply that formula. Sigma p. Okay. Clear? Shall we? So I think you can find out this. Question number 3. 13.65 minutes past examination question. A 100% investment in B only. B na 100% investment in B only. Okay. So then return of a portfolio. Return of a portfolio P bar is equal to, what is the answer? 12%. No calculation is required, yes or no? Next, risk of a portfolio sigma P. Risk of a portfolio sigma P. What is the answer? 10%. So 10% is the answer. Am I clear? Done. Return of a portfolio P bar 12%. Risk of a portfolio sigma P 10%. Next, B. What is the B? 50%. Investment in B and 50% investment in D only. Okay. So now 50% investment in B only and 50% investment in D only. Clear? So now what is the return of a portfolio? Return of a portfolio is equal to 0.5 into 12 plus 0.5 into 20. So the answer is 16%. This is for return of a portfolio. Return of a portfolio. Next what? Risk of a portfolio. Risk of a portfolio. Square root of risk of a portfolio, sigma p. What is the formula for sigma p? W x square sigma x square plus w y square sigma y square plus 2 wx wy sigma x sigma y sigma x. Yes or no? That is equal to square root of 0.5 into 10 plus 0.5 into 0.5 into 18 plus huh? Sorry, square 0.5 square. Thank you, Amma. 0.5 square into 10 square plus 0.5 square into 18 square plus 2 into 0.5 into 0.5 into 10 into 18 into 18 into what? 0.15. Okay. So what is the answer? 10.93. 10.93. Next C. 75% investment in B and 25% investment in D. 75% investment in B and 25% investment in D. Yes or no? Abhimati. Portfolio return P bar is equal to portfolio return P bar is equal to 0.75 into 12 plus 0.25 into 20. 14, 14 percentage portfolio return. Next, portfolio risk. Portfolio risk sigma p is equal to portfolio risk sigma p is equal to square root of 0.75 square into 10 square plus 0.25 square into 18 square 2 into 0.75 into 0.25 into 10 into 18 into 0.15. So answer is 9.30. Okay. 30 9.307. Okay. 9.31. 9.31%. If you observe the first case and third case, first case, what is the return? First case 12. But third case, what is the return? 14%. Okay. First case, what is the risk? 10%. Third case, what is the risk? 9.31%. The return has got increased. At the same time, the risk has got decreased. కొంచెం పాజిటివ్గా చెప్పాలంటే దట్స్ ద బ్యూటీ ఆఫ్ పోర్ట్ఫోలియో. Okay. Portfolio management, portfolio investment. Why do we make a portfolio investment? To diversify the risk. If you compare the first and third, the return has got increased due to the portfolio investment. At the same time, the risk had got decreased. Okay. Next, fourth one. What is the fourth one? 100% investment in 100% investment in D. If you are investing 100% in D, if you are investing 100% in D, then what? Return is equal to risk 18%. Clear? So also indicate which portfolio is best from risk as well as return point of view. From return and both risk point of view, which is the best option? Okay. Third one, if you want to consider both return and risk, which is the best one? Third one is the best one. But if you are considering both separately, from the return point of view, which is the best one? Portfolio 4. From risk point of view, portfolio 3. Clear? So write down the answer, conclusion. From return point of view, portfolio 4 is the best one. From return point of view, portfolio 4. From return point of view, portfolio 4 is the best one. From risk point of view, portfolio 3 is the best one. Clear? If I want high return, I should select D. If I want to select low risk portfolio, then I will go for portfolio 3. So clear? 4. Question number 4. Return and risk of a portfolio. Consider the following information on two stocks A and B. Year 2006 and 2007, return on A and return on a B. 10 and 16, 12 and 18. In the previous question, X bar is already given, X bar and Y bar. But whereas in this question, 2006 and 2007, past information is given, return on A, 10 and 16. That means what? X is given. X is given and Y, X and Y are given. You are required to determine the expected return on a portfolio. We are required to find out expected return on a portfolio containing A and B in the proportion of 40% and 60% respectively. So to find out the expected return on a portfolio, we require what? X bar, Y bar. So what is X bar? 10 plus 16 divided by 2, 13. What about B? 12 plus 18 divided by 2, 15, 13 and 15. So what are the proportions? 40, 60. So 40 percentage into what? 40 percentage into 13 plus 60 percentage into 15. 14.2 is the answer. Simple. Clear? What is the second part? The standard deviation of a return from each of the two stocks. We should find out the standard deviation. What is the third one? Covariance of a return. Covariance of a return. Next, correlation coefficient between the returns of the two stocks and also the risk of a portfolio containing A and B in the proportion of 40% and 60%. So we should find out the risk of a portfolio as well. Risk of a portfolio. So clear? Okay. So simple question. This is also a past examination question. Question number 4. So what is the first part of the question? So return of a portfolio. Return of a portfolio. So return of a portfolio. Okay. So first expected return of security what? X, what is the name? A, that is X bar is equal to 10 plus 16, 10 plus 16 divided by 2, 13%. Next, expected return of security B, that is Y bar. Y bar is equal to what? 12 plus 18 divided by 2. That is what? 15%. 15%. Next, expected return of a portfolio. Expected return of a portfolio, that is P bar. What is the formula? WX X bar plus WY Y bar. That is equal to What is the proportion? 40/60, yeah? So 0.4 into 13 plus 0.6 into 15. 14.2%. 14.2% is the expected return of a portfolio. Clear? Clear? So next what? B part. Standard deviation of a securities, yes or no? Standard deviation of a securities. So standard deviation of a securities. Tell me the columns. Standard deviation of a securities. So sigma x. So sigma x x x bar x minus x bar x minus x bar square. Only 2 years, yes or no? 2 years. So very simple. What is x? X return is given 2006. 2006 10. 2007 16. X bar already calculated. 13 minus 3 plus 3 9 9 total 18. So sigma x is equal to 18 divided by root 18 divided by 2 square root 3%. Yes or no? Is there any complication in this? Simple. Easier than example. Next what? Sigma y. Y bar y minus y bar square. So y 12 18 15 and 15 15 and 15 minus 3 plus 3 9 9 total 18. Sigma y is equal to square root of 18 divided by 2 3%. Clear? So second part completed, yes or no? So let us come to the third part. What is the third part? Covariance. Covariance of x comma y. Covariance of x comma y. What are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. X minus x bar minus 3 plus 3. Y minus y bar minus 3 plus 3. 9 9 18. So covariance of x comma y 18 by 2 9. Okay, clear? You will get correlation coefficient 1. Okay, covariance 9. Next what? Correlation coefficient D. correlation coefficient sigma xy and what sigma p and risk of a portfolio, yes or no? And risk of a portfolio sigma p. Correlation coefficient sigma xy and risk of a portfolio sigma p. So clear? So can we find out that or not? So how do we get sigma xy? Sigma xy is equal to covariance of x comma y, that is 9 divided by 3 into 3 plus 1. Yes or no? Next, sigma p. Directly we can apply the short formula, yes or no? Wx sigma x plus wy sigma y. Okay. So what are the weights? 0.4 into 3 plus 0.6 into 3. 3%. You will get 3%. So done. So today you have to practice question number 5. Question number 5. Okay. Now also try to do on your own. So for sure you're going to do a mistake, clerical mistake, because it involves a probability. Question number 5. This is a past examination question. Question number 5 is also past examination question. Okay, whenever you start portfolio management chapter revision, start with question number 5. If you want to practice each and every question, then time will not be enough. So that's why if you want to start, you have to start with what? Question number 5. When you have no time. Because question number 5, it covers all the points. An investor has decided to invest 1 lakh in the shares of 2 companies, namely ABC and XYZ. The projections of returns from the shares of the 2 companies along with their probabilities are as follows. Projections are given, not the past. Projections with probabilities are given. So probability 0.20. There is 20% chance that investor will get 12% in ABC securities and 16% return in XYZ securities. So total 4 projections are given, 4 probabilities. There are 4 possibilities. There are 4 possibilities. You are required to comment on return and risk of investment in individual shares. Comment on return and risk of investment in individual shares. So commenting is very easy, but first before commenting, we should calculate return and risk of individual shares. Nothing but what? We should find out x bar, y bar, sigma x, sigma y. First we should calculate and then comment. Okay, first we should calculate. Next, compare the risk and return of these shares. So we have to compare the return and risk of these 2 shares with a portfolio of these shares in equal proportions. What is the second step? First we have to compare on return and risk of these 2 individual shares. Second step is what? We should compare the risk and return of these 2 shares with a portfolio return and risk. So in which proportion the investment is being made? Equal proportions. We are making investment in equal proportions. Nothing but The second step is to finding out the return and risk of a portfolio and then compare and comment. That is the second part. Third part, find out the proportion of each of the above shares. Find out the proportion of each of the above shares. Already the proportion is given equal proportion. But again, they are asking you to find out the proportion of each of the above shares to formulate a minimum risk portfolio. To formulate a minimum risk portfolio. What does it mean? What does it mean? Right now they are following equal proportions. But we have already seen the formula for what? Okay, to find out the optimum weight. Weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So we have to apply that formula if correlation coefficient is other than -1. Of course, for suppose if we are getting a correlation coefficient -1, then directly we can find out weight of x by applying the formula sigma y divided by sigma x plus sigma y. Am I clear? So first step what? Finding out return and risk of investment. Okay. So definitely you're going to commit a mistake if you are going to try on your own. So that too a clerical mistake. Definitely. Okay. So try on your own. So question number 5. Question number 5. Question number 5. So first part. What is the first part? Return and risk of shares. Return and risk of shares. Return and risk of shares. Okay. In that first one, sigma what? First I will start with what? Sigma x. High chances of doing a clerical mistake, because the reason is in all the previous questions the past data is given. So the subconscious mind will say you to take the columns x, x bar, x minus x bar, x minus x bar whole square. Subconscious mind will say you to take the columns x, x bar, x minus x bar, x minus x bar square. Okay, because in all the previous questions past data, in most of the questions past data will be given. Okay, so that's why be careful. What are the columns here? X p p into x, x bar, x minus x bar. Yes. Okay, so these are the columns we should take. Okay, try on your own. So definitely you will do a clerical mistake, so that you will get to know where you might go wrong. Manasa, tell me the numbers. 1, 2, 3. Huh? 12, 14, -7, probability 0.2, 0.25. C value. C value. Okay. 0.3. P into X 2.4, 3.5 minus 1.75, 8.4. 12.55. So 12.55 X bar. Next X minus X bar. X minus X bar. X minus X bar. Minus 0.55. 1.45 minus 19.55, 15.45. Next 0.061, 0.525, 95.55, 167.746. One 167.746. Correct enough. Okay. So what is the standard deviation of a security ABC? Square root of 167.746. 12.951. ఎవరైనా డివైడ్ బై ఎన్ చేశారా? చేస్తే చెప్పండి. అలా చేయకూడదని వేరే వాళ్ళకి చెప్పొచ్చు మనం. 12.951. Likewise, what we should find out? Standard deviation of a y. 11.268. That's about 11.27. So what are the columns? Y, P, P into Y, Y bar, Y, P, P into Y, Y bar, Y minus Y bar, P into Y minus Y bar square. So Y. So tell me the numbers. 16, 10, 28, 2. Probability 0.2, 0.25, 0.25, P into Y 3.2, 2.5, 7 minus 0.6 total. So 12.1 is Y bar. Next Y minus Y bar 3.9 minus 2.1, 15.9 minus 14.1. P into Y minus Y bar square. 3.042, 1.1025, 63.2025, 59.643, 126.99. So sigma Y is equal to square root of 126.99, 0.27%. Clear? Clear? So they're asking you to comment. They're asking you to comment yes or no. Security. Security return risk ABC XYZ. So tell me what is the return of a security ABC? 12.55. What is the risk? 12.95. XYZ return 12.1, risk 11.27. So they're asking you to comment on return and risk of securities. So what is the comment? Security ABC is giving high return for high risk. Simple. Write down the sentence. Security ABC is giving high return by high risk. Security ABC is giving high return for high risk. Security ABC is giving high return for high risk. So that is a comment. Clear? So done. Security ABC is giving a higher return for high risk. So done. So now what is the second part? Compare the return and risk of these two shares with portfolio. So that means we should find out the portfolio return and portfolio risk. To find out the portfolio risk, we have a sigma x, sigma y. But what else we require? Covariance of a x comma y. Yes or no? So second part, return and risk of a portfolio. Chaser Andrew, everybody. B part. Return and risk of a portfolio. Return and risk of a portfolio. Return and risk of a portfolio. So what are the columns? Directly we can take columns or what? Covariance. Covariance of x comma y. So find out the covariance of x comma y, because we cannot directly find out the risk of a portfolio. So first we require covariance of a x comma y. So find out the covariance of x comma y and let me know the answer. Minus 144. Minus 144.25. Any other answer? Covariance. Any other answer? Covariance Vaishnavi Ganeshan, what is the covariance answer? Find me who I am. What is the answer? Priyadarshini, Abhimati, Chitti Shrikari. Covariance of x comma y. One 144.25. Any other answer? Huh? Minus? Minus 144. 11 something ఏదన్నారు? డివైడ్ బై చేశారా? రూట్ చేశారా? So what is the answer? Minus 144.25. So be careful when there is a probability. So what are the columns? X minus x bar, y minus y bar, p into x minus x bar into y minus y bar. So what is x minus x bar? Minus 0.55, 1.45 minus 19.55, 15.45. Y minus y bar 3.9 minus 2.1, 15.9 minus 14.1. Next p into x. So probability skip చేసే ఛాన్సెస్ ఉన్నాయి. Students might skip the probability. Be careful. At least one might have skipped the probability. చేశారా ఆల్రెడీ? చెప్పే కదా. ఓకే, సో టెల్ మీ వాట్. నేను గ్యాప్ ఇచ్చింది అందుకే మిమ్మల్ని ట్రై చేయమంది, సో దట్ మీకు అర్థం అవుతుంది కదా ఎక్కడ మిస్టేక్ అవుద్దో. స్కిప్ చేస్తారు ప్రాబబిలిటీ. కొంతమంది ఇప్పుడు స్కిప్ చేసి ఉండరు, దే మైట్ హ్యావ్ టేకెన్ ప్రాబబిలిటీ, బట్ in next questions, at least in any one question, you will be skipping probability. Adhodna, you know the concept, but what subconscious mind. So already chala sarlu తీసుకుందాం మనం. Last column x minus x bar into y minus y bar. So that's why you might forget probability. Be careful. Chitti Shrikari, covariance you got 0.9884. Same mistake. Shrikari, you might have done mistake. So tell me, covariance or correlation? They might be saying correlation. So what is the last column? minus 0.429, minus 0.761, minus 77.711, minus 65.35 total, minus 144.25 is the what? Covariance. Clear? Next, correlation. Sigma xy is equal to minus 144.25 divided by 12.95 into 11.27. Yes or no? So the answer is minus 0.988. So correlation coefficient sigma xy is equal to minus 0.988. Clear? We have not yet completed the solution. So sigma xy, they are asking you to compare the risk and return of shares with portfolio. So clear? Now portfolio return is equal to portfolio return P bar is equal to portfolio return P bar is equal to equal proportions, yes or no? So that means 0.5 into 12.55 plus 0.5 into 12.1, 12.325 percentage is the portfolio return. Yes or no? Clear? Next what? Portfolio risk sigma P. Portfolio risk sigma P. Portfolio risk sigma P is equal to square root of what? 0.5 square into 12.95 square plus 0.5 square into 11.27 square plus 2 into 0.5 into 0.5 into minus 144.25. So the answer is 1.2445 percentage. Portfolio risk is equal to 1.2445 percentage. Clear? 1.2445 percentage. అందరికి అంతే వచ్చింది ఆన్సర్ చెక్ 0.5 square into 12.95 square into 0.5 square into 11.27 square plus 2 into 0.5 into 0.5 into minus 144.25. So clear? So they are asking you to compare, yes or no? What is the answer? Risk of portfolio. Risk of a portfolio, what is the answer? Everybody got the same answer or not? Okay, fine. What is your answer? 1.2465. Okay, that's okay, fine. If you take 3 decimal, the answer will differ. If you take only 2 decimal, you might have got 1.2465 or 55. That's okay, fine. So what is the return of ABC? 12.55. Return of XYZ? 12.1. Portfolio? 12.325. What about the risk? 12.95. 11.27. So they asked you to compare the return and risk of a shares with the return and risk of a portfolio. So what is happening if you are investing only in XYZ? Your return is 12.1, the risk is 11.27. But if you are making a portfolio investment, the return is increasing to 12.325. At the same time, risk is decreasing to 1.2445. Yeah. So they asked you to compare the return and risk of a shares with return and risk of a portfolio. They didn't ask you to comment, they asked you to just compare. But the observation is what? The risk is getting reduced to 1.2445. Clear? But the risk can be further be reduced. The risk can be further reduced by taking what? Optimum proportions. Optimum means best. So the last part is what? See the last part. Find out the formulate. Find out the proportion of each of the above shares to formulate a minimum risk portfolio. Okay, C part. Proportion to formulate minimum risk proportion to formulate what? Minimum risk portfolio. Proportion to formulate minimum risk portfolio. Proportion to formulate a minimum risk portfolio. What is the proportion? So weight of X is equal to. Here I have to use the second formula. Why? Because the sigma xy is not equal to -1. So weight of X is equal to sigma y square minus covariance of x comma y divided by sigma x square sigma y square minus 2 covariance of x comma y. So the high chances that you might forget this formula. So that's why Krishnavanshi, whenever there is a fight with your girlfriend, say this formula and get compromised. Okay, weight of X is equal to sigma y square minus covariance of x comma y. విజువలైజ్ చేసుకుంటున్నావా? గొడవ అవుతున్నప్పుడు ఎలా చెప్పాలి ఫార్ములాని? ఓకే, సిగ్మా వై స్క్వేర్ మైనస్ కోవేరియన్స్ ఆఫ్ ఎక్స్ కామా వై డివైడెడ్ బై సిగ్మా ఎక్స్ స్క్వేర్ ప్లస్ సిగ్మా వై స్క్వేర్ మైనస్ 2 కోవేరియన్స్ ఆఫ్ ఎక్స్ కామా వై. భార్గవ్ 11.27 square minus Minus of minus. So S or no? 11.27 square minus, in brackets, minus 144.25. అంతే కదా? చెప్పండి మా ఆన్సర్స్. సో డివైడెడ్ బై 12.95 square plus 11.27 square minus 2 into minus 144.25. 0.46. 0.465. అంతేనా? నువ్వేదో చెప్తున్నావు. ఏంటంట? ఓకే ఓకే సరే, అది కూడా రాయనా? వద్దులే, రాస్తానులే. సో వాట్ ఇస్ ద న్యూమరేటర్? 271.2629 divided by 583.2154. 0.465. So instead of 50-50, if you make 0.465 and 53.5%, I mean 53.5%, then what? Risk will get reduced further. Risk will get reduced further. ఇంకా risk reduce అవుతుంది. సో ఇప్పుడు if you are making investment in the ratio of 0.465 and 0.535. So clear? చెప్పమ్మా కృష్ణవంశీ, you wanted to say something. Clear? So find out the proportions. These are the proportions. So weight of x is equal to 0.465. Weight of y is equal to 0.535. 1 minus 0.465. So because they asked the proportion of each share. Proportion of each share. So proportion of share x is equal to 0.465. Proportion of share y is equal to 0.535. Okay. So this question is for practice. This question is for practice. You have to practice this question. So after you get the material, practice this additional question number 12. Additional question number 12. Self-examination. Calculate the expected return, standard deviation of our returns, and correlation coefficient between two stocks. Similarly, okay, compare the risk and return of these two stocks with the portfolio of these stocks in equal proportions. Same question, first part and second part, but the third part is the new point. Determine the expected rate of return of a zero risk portfolio consisting of the above two stocks. What is the meaning of this question? Here you will get correlation coefficient -1. You will get correlation coefficient -1. So correlation coefficient -1 means you can reduce the risk to 0. For that, weight of x is equal to sigma y divided by sigma x plus sigma y. You have to find out the weight of a zero risk portfolio. You have to find out the weight of a zero risk portfolio. What is the question Determine the expected rate of a return of a zero risk portfolio. They are asking you to find out the return of a zero risk portfolio, expected return. How do we get expected return of a zero risk portfolio? After finding weights, so Wx x bar plus Wy y bar. Using that formula, you can find out the expected rate of a return of a zero risk portfolio. So this is old syllabus examination question. I think June 23 or something, June 24 or something. So determine, you have to understand the question. Determine the expected rate of a return of a zero risk portfolio. You will get sigma xy minus 1. Sigma xy minus 1 means what? Risk can be reduced to 0. For that, weight of x must be equal to sigma y divided by sigma x plus sigma y. Okay, so after finding weights, P bar is equal to Wx x bar plus Wy y bar. Okay, so today, so try additional question number 12 if you get material. Otherwise, what? At least main question number 5. Main question number 5. Okay, so clear? Done. And I have already asked you to try question number what? 6. I think now you can try question number 6 also. Today, try question number 6 also. Already you tried yesterday. In tomorrow's class, I will discuss what? Question number 6. Clear? So done. So clear? Sai Krishna, Bhargav, Raju. నీ పేరు కూడా రాజు అమ్మా. రవీంద్ర రాజు, అరవింద్ రాజు. నువ్వమ్మా నార్మల్ రాజా, పోతురాజా? ఓకే, రాజు. నీ పేరమ్మా? సాయి కృష్ణ. నువ్వు కూడా సాయిరామ్. ఓకే, టోటల్ ఎంతమంది సాయి? ఇద్దరేనా సాయిలు? ఓకే, లాస్ట్ నీ పేరు? వరుణ్. సాయి వరుణా? ఓకే, ఫైన్. ఓకే, క్లియరా? క్వశ్చన్ నెంబర్ వాట్? ఏ క్వశ్చన్ ట్రై చేయాలి? వెళ్ళు ఆగమ్మా. విచ్ క్వశ్చన్ యూ టు ట్రై? Question number 5 and additional question number 12. Additional question number 12. Okay, so these questions you have to practice and check whether you are able to do that question within 13.65 minutes or not. Okay, be in this trance. The most important tip. Students will be asking for tips. Sir, how to clear CMA? Be in this trance. Trance అంటే తెలుసా? ఈ ధ్యాస. ఈ ధ్యాసలో ఉంటే అయిపోతారు. ఈ ధ్యాసలో లేరు, వెళ్ళగానే ఫోన్ తీశారు. ఓకే, ఇక్కడ ఉండగానే తీశారు కొంతమంది. తీసి వెంటనే మనల్ని ఎవరైనా గుర్తు తెచ్చుకున్నారా అని చెప్పి వెతుక్కొని, ఓకే, ఒకవేళ ఎవరూ మెసేజ్ చేయకపోతే అప్సెట్ అయ్యి, ఇట్లా ఉంటే కాదు కదా. బీ ఇన్ దిస్ ట్రాన్స్. ఈ ట్రాన్స్లో ఉండండి, ఈ ధ్యాస. ఓకే, ఈ ధ్యాసలో ఉంటే ఈజీ అవుద్ది. సో స్టడీ అవర్స్లో ఎన్ని అవర్స్ కూర్చోవాలి అవసరం లేదు. ఈ నెక్స్ట్ 1 hour ఉంది కదా, ఈ 1 hourలో ఏంటి? బీ ఇన్ దిస్ ట్రాన్స్. ఏం చెప్పారు? సో ఆ ధ్యాసలో ఉంటే సరిపోతుంది. జనరల్గా ఏమవుతుంది, ఇప్పుడు నెక్స్ట్ 1 hour అంటే బ్రేక్ టైం కాబట్టి మనం అసలు ఆలోచించాం. అర్థమైందా? పర్సనల్ టైం ఇది. వాళ్ళకేంటి ఫోన్ చేసి బతిమాలుకోవాలి ప్రేమించమని. అర్థమవుతుందా? సో సో అది ఈ ట్రాన్స్లో లేనట్టే కదా లెక్క. స్టడీ అవర్స్లో కూర్చొని 3 hours ఏదైనా ఉపయోగమే ఉంది? ఇప్పుడు ఇది ఇంపార్టెంట్. ఓకే, సో దట్స్ బీ ఇన్ దిస్ ట్రాన్స్. ఈ ట్రాన్స్లో ఉంటే అయిపోద్ది. ఓకే, క్లియర్? వరుణ్, థ్యాంక్ యూ సో మచ్. థ్యాంక్ యూ ఆల్. వెళ్ళమ్మా నువ్వు శ్రీలేఖ, సారీ శ్రీవల్లి. పుష్ప కోసమే ఏంటి? పరిగెడుతున్నావు? So portfolio management. Portfolio means a combination of a securities such as shares, bonds, money market instruments. Yes or no? So what is the objective of SFM? Wealth maximization. Wealth depends on two factors, profit and risk. If a profit increases, wealth increases. But if risk increases, required rate of return increases. Required rate of return increases and wealth decreases. Wealth decreases. Okay. Am I clear? Okay. So there are four types of decisions in SFM. So financing decision. So financing means where to invest. I mean from where to get money. Investing decision, where to put money. Where to put money. And next word, dividend decision, whether to declare a dividend or not. Whether to declare a dividend or not. And next one, portfolio decision. Portfolio means what? Combination of securities. Nothing but portfolio investment means investment in two or more securities. Two or more securities. Okay, fine. So three major activities in portfolio management. First one, selection of securities based on return and risk. Next, construction of a feasible portfolio. Next, deciding weights. Deciding weights. Okay, deciding weights. Am I clear? Next, phases of a portfolio management. What are the phases of portfolio management? Security analysis, portfolio selection, portfolio revision, portfolio evaluation. Okay. So next, what a shareholder gets a return in the form of what? Shareholder gets return in the form of capital appreciation and dividend. Capital appreciation and dividend. Okay. Debenture holder will get return in the form of interest and capital appreciation. Interest and capital appreciation. Okay. So the first part, we completed first part of a portfolio management. So in first part, so we have learned how to find out the return and risk of a security and how to find out the return and risk of a portfolio. Return and risk of a portfolio. Yes or no? Return and risk of a portfolio. So how do we find out the return of a security? First, X. How do we get X? P1 minus P naught plus D1 divided by P naught. P1 minus P naught plus D1 divided by P naught. Okay. X. And next what? So the data can be past data or a future data. If it is past data, we do a simple average. But if it is a future data, we do what? Okay, we do weighted average. That is when probability and future data is given, then we do a what? Weighted average. Okay. So X bar. And next what? Risk. Risk means uncertainty, possibility of occurrence of a loss, possibility of a deviation from the mean. Possibility of deviation from the mean. Okay. Clear? Possibility of deviation from the mean. So that's why you should know what are the columns we should take. Columns we should take. Yes or no? So first, X is equal to, first formula we have learned is what? Return X is equal to P1 minus P naught plus D1 divided by P naught. You know the logic for this, yes or no? P1 minus P naught plus D1 divided by P naught. So return X. Okay. So this formula is used for finding out what? The return. So okay, how do we get expected return for the next year? By doing an average. Yes or no? So next, expected return X bar. expected return x bar, past data or what? Future data. For suppose if it is past data, I will do simple average. For suppose if it is future data, then what? Weighted average. Weighted average. Am I clear? So expected return. Expected return. So after finding out expected return, we should know how to find out the risk of a security. So risk of a security can be measured using variance, standard deviation, and what? Coefficient of a variance. Coefficient of a variance. Okay. So next, risk. For finding out risk, instead of the formula, you should know what are the columns we should take. Okay. So for variance, what is the formula? Summation sigma x minus x bar square divided by n. But when there is a probability, then summation sigma p into x minus x bar square. Yes or no? Standard deviation is square root of a variance. Coefficient of a variance is equal to standard deviation divided by x bar. Standard deviation divided by x bar. It denotes risk per 1 unit of expected return. Risk per 1% of a expected return. So higher the standard deviation, higher the variance, or higher the coefficient of a variance, high risk. High standard deviation indicates what? High risk. High coefficient of a variance indicates high risk. On coefficient of variance, you may get multiple choice question. They may give 4 scenarios. In 4 scenarios, they will give you the standard deviation and what? Expected return. And they will ask you to choose one security. We select a security which is having a lower coefficient of a variance. So how do we get coefficient of variance? A standard deviation divided by x bar. So risk. So what are the columns for risk? If it is past data, what are the columns? X, x bar, x minus x bar, x minus x bar whole square, x minus x bar whole square. These are the columns for past data. Yes or no? Next, if it is future data, x p into x bar, p into x minus x bar whole square. So when it is future data, clear? Next, how do we get coefficient of a variance? Coefficient of variance is equal to standard deviation divided by x bar. Standard deviation divided by x bar. Am I clear? Done. Next. So after learning return and risk of a security, we have learned how to find out the return and risk of a portfolio. Yes or no? Return and risk of a portfolio. Return and risk of a portfolio. So for P bar, no complication. Simply weighted average of what? Security return. Yes or no? P bar. Portfolio return P bar. Portfolio return P bar is equal to WX X bar plus WY Y bar. WX X bar plus WY Y bar and so on. So this is the formula for what? A portfolio return. Weighted average of a security return. weighted average of a security return. Am I clear? So portfolio return. Next, portfolio risk sigma p wx sigma x plus wy sigma y. Can we do this or not? Yes, we can do this only when sigma xy is equal to plus 1. Yes, we can do this, but only when sigma xy is equal to plus 1. So sigma xy plus 1 means what does it indicate? Both the securities x and y are moving in same direction and in same proportion. In that case, the risk cannot be diversified. As you cannot diversify the risk, as you cannot diversify the risk, as you cannot diversify the risk, okay, the portfolio risk is equal to simply what? Weighted average of a security risk. Weighted average of a security risk. Clear? Okay. But so we don't know which formula to apply unless we find out what a sigma xy. Unless we find out what sigma xy. So that's why in yesterday's class I have told you the steps. If they ask you to find out the portfolio risk, so then what is the first step? X bar, Y bar. Yes or no? So sometimes they may not be giving X also. So that's why X bar, Y bar. You know how to find out X. You know how to find out X. Yes or no? How to find out X. Okay, Krishnavamsi. So X bar, Y and Y bar. And next what the second step? What is the second step? Sigma X, sigma Y. You know the columns for sigma X and sigma Y. You know the columns, yes or no? Sigma X and sigma Y. What about the next one? Covariance of a X comma Y. Covariance of a X comma Y. So Vaishnavi, Ganeshan, am I audible? Please do respond. Third one, covariance of X comma Y. You know how to find out the covariance of X comma Y. It denotes co-movement of securities. It denotes co-movement of securities. So that's why what are the columns we are taking? X minus X bar, Y minus Y bar, X minus X bar into Y minus Y bar. Yes or no? So covariance of X comma Y. So you should know the columns. If it is past data, then what are the columns? X minus X bar, Y minus Y bar, X minus X bar into Y minus Y bar. So if it is future data, be careful. There are high chances that you will do a clerical mistake. You know the concept, but subconscious mind will make you do mistake. Okay, so that's why future data, when it is future data, Sai Tejashvi in concept book that there was a mistake. Risk of a security, future data is given, we should not divide with n. Okay, so future data. So if it is future data, what are the columns? X minus X bar, Y minus Y bar, P into deviation of X into deviation of a Y. P into deviation of X into deviation of a Y. Am I clear? Covariance of X comma Y. So covariance of X comma Y just denote the co-movement of securities. How the securities are moving. Whether they are moving in same direction or opposite direction. Just denote the co-movement. Co-movement of a securities. Next, fourth one. Fourth one. Sigma XY. What is the sigma XY? correlation coefficient. Correlation coefficient sigma xy. In some books they might write rxy. Correlation coefficient they might write rxy. So correlation coefficient. How do we get correlation coefficient? Covariance of x comma y divided by sigma x into sigma y. Yes or no? Covariance of x comma y divided by sigma x into sigma y. So based on the sigma xy, the formula depends, yes or no? Based on the sigma xy, there can be how many scenarios? 5 scenarios. There can be 5 scenarios, yes or no? So sigma xy. So there can be 5 scenarios. First scenario, sigma xy may be plus 1. If sigma xy is equal to plus 1, then sigma p is equal to a plus b. Yes or no? So nothing but wx sigma x, wy sigma y. నేను బాగా రాస్తున్నాను కదా. సో చెప్పింది అదే, నేను బాగా రాస్తానని చెప్పి కాంప్లిమెంట్ ఇస్తారు కానీ రాసుకోరు మీరు. ఎస్ఎఫ్ఎంలో డ్రాబ్యాక్ అదే అని చెప్పాను మీకు. అయినా కానీ చూసి నన్ను ఎంకరేజ్ చేస్తున్నారు చూసారు మీరు. ఓకే ఫైన్, పర్లేదు, ఊరికే నన్ను హెట్ అవ్వకండి. ఇప్పుడు సిగ్మా xy ఈజ్ ఈక్వల్ టు ప్లస్ 1. Sigma xy is equal to plus 1. Already complete clarity. If you have a complete clarity, then okay, fine. You need not write. But if you have any, if you're getting confused in steps, then you have to write. Otherwise, not required. So sigma xy is equal to plus 1. Sigma xy is equal to plus 1. Then sigma p is equal to wx. అమ్మాయి పాపం శ్రీవల్లి బాగా రాస్తానంటే బాగా రాస్తానంతే. Sigma xy is equal to plus 1. Then sigma p is equal to wx sigma x plus wy sigma y. Okay. So what is the logic behind this? Because sigma xy plus 1 means securities both are moving in same direction and in same proportion. So the risk cannot be diversified. Risk cannot be diversified because you will get a loss in both the securities, or else you will get gain in both the securities. We cannot reduce the possibility of occurrence of a loss. Possibility of occurrence of loss. Am I clear? Done? Clear? Okay. Next, second. If sigma xy is equal to సమ్ లెజెండ్స్ ఉంటారు ఇక్కడ క్లాస్లో. సార్ ప్లీజ్ సెండ్ పీడిఎఫ్, మార్నింగ్ ఫార్ములాస్ రాశారు కదా అంటే అర్థమైంది మీకు. సో ప్లీజ్ కెన్ యూ షేర్ పీడిఎఫ్. ఏం చేసుకుంటారు మరి ఆ పీడిఎఫ్తో రాయకుండా. సో సిగ్మా xy ఈజ్ ఈక్వల్ టు వాట్? -1. Sigma xy is equal to what? -1. If sigma xy is equal to what? -1. The risk can be fully diversified. Risk can be fully diversified. Okay. If investment is made in proper proportions. If investment is made in proper proportions. Okay. So what is the formula? Sigma p is equal to wx sigma x minus wy sigma y. Yes or no? Okay. So but in this case, what we can do is the risk can be reduced to 0. Risk can be reduced to 0. Risk can be reduced to what? 0. Risk can be reduced to 0. But for that, weight of x must be equal to what? Sigma y divided by sigma x plus sigma y. Sigma y divided by sigma x plus sigma y. Okay. If you invest in this optimum weights, then what risk can be reduced to what? 0. Risk can be reduced to 0. Third case, sigma xy. Sigma xy 0. Okay, correlation between Krishnavamsi and Pooja 0. Okay, no relation, yes or no? So sigma xy 0. Okay, sigma xy 0. Then what? So what is the meaning of this? No relation. No relation. No relation. Okay. So sigma p is equal to Shivali, what is sigma p? Square root of wx square sigma x square wy square sigma y square. Nothing but square root of a square plus b square. Yes or no? Square root of a square plus b square. So that means we can use the simple formula when sigma xy is equal to -1 or +1 or 0. But in most of the cases, sigma xy lies between -1 and 0 or 0 to 1. In most of the cases. Okay. So fourth scenario. What is the fourth scenario? Sigma xy ranges from -1 to 0. You know the meaning of this, yes or no? Securities are moving in opposite direction, but not in same proportion. But not in same proportion. So then what is the formula for sigma p? Here we should use the lengthy formula. Yes or no? So square root of wx square sigma x square wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. Clear? Or else instead of this sigma x sigma y sigma xy, we can use what? Covariance of a x comma y. Am I clear? Done. So we use the same formula for what? When correlation coefficient ranges from 0 to 1. 0 to 1. Clear? Clear? When sigma xy lies between 0 to 1. Then also we use this formula, lengthy formula. So this is similar to what? A square plus b square plus 2ab. Nothing but a plus b whole square. Yes or no? For suppose if there are 3 securities, then it will be what? A plus b plus c whole square. If there are 4 securities, a plus b plus c plus d square. So in examination, they will not be giving a portfolio consisting of 4 securities. So they will be giving portfolio consisting of three securities. If it is 3 securities, then what? A square plus b square plus c square plus 2ab plus 2bc plus 2ac. Am I clear? Clear. Done. Next, you might forget one formula. For suppose sigma xy is equal to +1. The risk cannot be diversified. Yes or no? For suppose sigma xy is equal to -1, risk can be diversified that to 0 up to 0. Yes or no? Okay. But for suppose sigma xy is equal to 0 or sigma xy ranges from -1 to 0 or sigma xy ranges from 0 to 1. In all the three cases, risk can be diversified but not up to 0. Risk can be minimized. No doubt risk can be minimized. So for that, weight of x must be equal to sigma y square minus covariance of x comma y. Very good, amma. Baba adaru. Okay. Sigma x square plus sigma y square minus what? 2 covariance of x comma y. Clear, Krishnavamsi? Okay. So risk can be minimized for construction of a minimum risk portfolio. For construction of a minimum risk portfolio. So weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Done. So there are high chances that you may forget this formula. Okay. This formula, Krishnavamsi. So that's why I have given a tip. What is the tip? Whenever you have a fight with your girlfriend, scold her with this formula. Okay. Weight of x is equal to what? Sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. Bhargav, unnara meeru? Okay. Clear? So we have a completed what? Return and risk of a security and return and risk of a portfolio. Okay. So instead of doing all this, the risk of a portfolio can be calculated using the formula summation sigma p minus p bar square divided by n. Okay. You know the concept, yes or no? Instead of taking x minus x bar, take what? P minus p bar. P minus p bar. So this is completely conceptual formula. But in examination, you will not get marks. In examinations, you will not get marks because the reason is because in suggested answers, they will be giving you a Markovich formula. So this is the formula suggested by Markovich. Okay. So we have to use that formula only. We cannot use what? Summation sigma p minus p bar square divided by n. Clear? So yesterday I have told you one example for -1 to 0, I think. Example 3. Example 3. Can you please give me those facts? -1 to 0. Wait. Here x, y. Yes or no? 1, 2, 3. What is x? 20, 17, 14, 10, 18, 20. Okay, 10, 18 and 20. Clear? Here 1, 2, 3. So for this we have calculated sigma p, yes or no? Sigma p. What is the answer sigma p? for this example? 0.58. I think these are the proportions, yes or no? 60-40, yeah? 60-40. So these are the weights. For this example, we have a calculated sigma p. Sigma p, yes or no? So you got 0.5889. So this sigma p can be calculated using the formula we already know. What is that formula? Square root of summation sigma p minus p bar divided by n. So let me calculate using that formula. So what are the columns we take? What are the columns we take? So this is just for understanding but not required to be noted. Here p, p bar, p minus p bar, p minus p bar square. First year 1, 2, 3. P. P means a portfolio return, yes or no? So what is X for the first year? 20. What is the Y? What is the Y for first year? 10. నీ పేరేంటమ్మా? మోహన్. ఎంకరేజ్ చేయండి అమ్మా మోహన్. రికార్డ్ బ్రేక్ చేశాడు. కృష్ణవంశీని ఆ అమ్మాయి, నీ పేరేంటమ్మా? తేజస్విని, వాళ్ళిద్దరిని దాటేశాడు. 95 seconds వరల్డ్ రికార్డ్ ఇది. సో P portfolio return. P portfolio return for the first year. What is the return of X? 20. And what is the return of Y? 10. Okay. So that means portfolio return for the first year is equal to 0.6 into 20 plus 0.4 into 10. అంతేనా కదా? I am finding out the portfolio return for the first year. Portfolio return for the first year. What is the portfolio return for the first year? 16. Very good, Amma Manasa. Next. 0.6 into 17 plus 0.4 into 18. 17.4. Next 0.6 into 14 plus 0.4 into 20. 16.4. So these are the portfolio returns for the 3 years. For 3 years. Yes or no? So how do we get P bar? By doing a simple average. By doing simple average. So total, I think, what is the total? 49.8. 16.6. So this is the P bar, 16.6. So this we can calculate using the alternative method also. What is the WX X bar plus WY Y bar? So we have a calculate X bar. See the X bar. What is the answers? X bar. For example 3, what is X bar? 17. Y bar? 16. So 0.6 into 17 plus 0.4 into 16. 16.6. Clear? You will get the same number. Okay, 16.6. Are you getting my point? Next, P minus P bar. First case, minus 0.6. Second case, 0.8. Next, minus 0.2. P minus P bar square, 0.36. 0.64. 0.04. 1.5. 0.04. So sigma p is equal to square root of 1.04 divided by 3. 0.5, 588, 9. Okay, something. Okay, we can apply this formula, but conceptually correct and easy. Directly we can find out what sigma p. But in examination, you cannot follow this. Okay, clear? Because stepwise marking will be given, and at the same time, so board material they will be following what sigma x, sigma y, and then what covariance of x comma y, and then sigma p, sigma x y and sigma p. Okay, clear? So with this we have completed the first part. I think we have to discuss question number 6. Question number 6. So yesterday I requested you to practice what question number 5. Practice chesara question number 5. Reasonable expectation. I'm keeping my expectations very low. I didn't ask you to practice each and every question. I just asked you to practice question number 5. And if time permits, or if you have a question bank, then I asked you to practice additional question number 12. Chesar additional question number 12 kuda. Okay, fine. So next question number 6. Question number 6. Question number 6. Question number 6. Bhargav. Hyderabad anamidi. Question number 6. Question number 6. Return and risk of a portfolio. So this question you have to practice even on day before examination. Question number 6. Question number 6. If you're writing both groups, you have to directly practice what question number 6. If you're writing only single group, then what? 5 and 6. 5 and 6. So clear. Question number 6. X Company Limited invested on 1/4/2009 in certain equity shares as below. M Limited number of shares 1000, cost 2 lakhs. N Limited 500 shares 1,50,000. In September 2009, 10% dividend was paid out by M Limited, and in October 2009, 30%. What 30%? 30% dividend paid out by N Limited. On 31st March 2010, market quotations showed a value of rupees 220 and 290 per share of M Limited and N Limited respectively. On 1/4/2010, investment advisors indicate that the dividends from M Limited and N Limited from the year ending 31st March 2011 are likely to be 20% and 35% respectively, and that the probabilities of market quotations on 31st March 2011 are as below. Probability factors 0.2, 0.5, 0.3. Share of M Limited 220, 250, 280. share of a N limited 290, 310 and 330. You are required to calculate the average return from the portfolio for the year ended 31st March 2010. Calculate the expected average return from the portfolio for the year 2010-11 and advise X company limited of the comparative risk in the two investments by calculating the standard deviation in each case. Calculate the average return from the portfolio for the year ended 31st March 2010. Calculate the expected average return from the portfolio for the year 2010-11. Advise X company limited of the comparative risk in the two investments by calculating the standard deviation in each case. Okay. So question number 6. So what is the information? X company limited invested in two shares. What are the two shares? M limited and N limited. How many shares? 1000 shares and 500 shares. So what is the cost? 2 lakhs and 1 lakh 50. So that is the investment, overall investment. Nothing but what is the P naught? 2 lakhs divided by 1000. 200 is the P naught. What about second case? 300 is the P naught. Price at the beginning. Price at the beginning. Okay. So in September 2009, invested on 1/4/2009, yes or no? In September 2009, 10% dividend was paid out by M Limited. And in October 2009, 30% dividend paid out by N Limited. 30% dividend. On 31st March 2010, financial year closing, what are the market quotations? M Limited shares 220, N Limited shares 290. N Limited shares 290. Okay, so P1, price at the end of the first year. Price at the end of the first year. Okay, so the first part of the question is calculate the average return from the portfolio for the year ended 31st March 2010. Okay, so that is the first part. So that means information is relevant up to N limited respectively. On 31st March 2010, the market quotation showed the value 220 and 290. Yes or no? So the information is relevant up to what? N limited respectively. N limited respectively. Am I clear? వెళ్ళిపోయావా ఆకాశం అంచుల దాకా వెళ్ళిపోయావా వెనక్కిరా పడిపోతావు సో ఫస్ట్ పార్ట్ ఆఫ్ ద క్వశ్చన్ వాట్ ఇస్ ద ఫస్ట్ పార్ట్ ఆఫ్ ద క్వశ్చన్ ఫస్ట్ పార్ట్ యావరేజ్ రిటర్న్ ఆఫ్ అ పోర్ట్ఫోలియో ఫర్ ద ఇయర్ ఎండెడ్ 31st March 2010. Okay, so let us start the question. First part of the question, you require P naught P1. So P naught 200, P1 220. Yes or no? Dividend is also given 10%. So first part A, average return of a portfolio. Average return of a portfolio. Varun, ఇది క్లోజ్ చేసాను. Average return of a portfolio. Average return of a portfolio. To find out the average return of a portfolio, how do we get average return of portfolio? Wx into x plus wy into y, or x bar or y bar. Yes or no? So first we require what? X and y. Average return of portfolio for the year ended what? For the year ended 31st March 2010. Average return of a portfolio for the year ended 31st March 2010. Clear? Average return of a portfolio. So how do we get average return of a portfolio? So first we should find out what the return of a M. What is the company name? M. The first return of a M limited shares. Price at the beginning P naught is equal to Mohan Chepama. Price at the beginning P naught is equal to 2 lakhs divided by 200 rupees. Yes or no? Online students, please do respond. Vandana, Priyadarshini, Manju, Darshini, Gopal Verma, Chitti Srihari, find me who I am, Manasa. Price at the beginning 200. Next what? Dividend D1 is equal to dividend D1 is equal to dividend D1 is equal to what? Face value 100 into what is the percentage? 100 into 10%. దీనికి క్యాలిక్యులేటర్ యూజ్ చేశారు ఎవరు ఇద్దరు 100 into 10%, 10 rupees is the dividend. Okay. Next what? Price at the end. Price at the end P1. What is the price at the end P1? 220. Now return X is equal to return X is equal to what? P1 minus what is P1? 220 minus P0 200 plus 10 divided by 200. So what is the percentage? 15% is the answer. Am I clear? 15% is the answer. Done. Likewise, we should find out what return of unlimited shares. So be careful while finding out return of unlimited shares. Return of unlimited shares. Return of unlimited shares. Return of unlimited shares. So what is the price at the beginning? 1,50,000 divided by 1,50,000 divided by 500. 300. Next dividend. Dividend. Be careful, dividend D1. Here the face value is not 100. Face value is 10 rupees. So 10 into 30%. 10 into 30%, 3 rupees. Next, price at the end 290. return is equal to 290 minus 300 plus 3 divided by 300 minus what? 2 point 2 point minus 2.33 percentage. Clear? Next. So they are asking you to find out what? Portfolio return. So this is different kind of a question. So that's why practice. Portfolio return is equal to portfolio return WX X plus WY Y. So generally weights will be given in the question 40%, 60%, equal proportions, etc. But here what? Investment value is given. Investment value. So percentage they have not given directly. They have given what? Investment. So what is the investment? 2 lakhs divided by what? 3 lakh 50. The overall investment is 3 lakh 50. In that X limited value is M limited value is 2 lakhs. So how do we get weights? 2 lakhs divided by 3 lakh 50,000 into 15% plus 1 lakh 50,000 divided by 3 lakh 50,000 into minus 2.33. So the answer is 7 point 7.572. 7.572. Sai Babu. 7.572. ఇటు వచ్చి నన్ను ముందుకు వచ్చి ఒకసారి ముందుకు పంపించే అబ్బాయిని. పేరేంటి? సాయి కదా. ఇట్లా రా. పర్లేదు రా. రా. ఇట్రా. పేరేంటి మీ పేరు? శివాని. ఇక్కడికి వచ్చి కూర్చో ఫస్ట్ బెంచ్లో ఇక్కడ. సరే మీకు కనిపించేలా కూర్చో. వరుణ్ వెనక సైడ్ కూర్చో. వరుణ్ వెనక లేకపోతే అమ్మాయి శివాని పక్కన. వరుణ్ బ్యాక్ సైడ్. ఓకే. So 7.572 is what? Average return of a portfolio. Average return of a portfolio. Shivani, I have seen you somewhere. YouTube. Okay. 7.572. 7.572. Average return of a portfolio. Thank you, Sai. So this is average return of a portfolio for the year ended what? 31st March 2010. So 31st March 2010. So clear? So this is the first part. Are you able to understand the first part? Next, on 1/4/2010, investment advisors indicate that the dividend from M Limited and N Limited for the year ending 31st March 2011 are likely to be 20% and 35% respectively, and that the probabilities of market quotations on 31st March 2011 are as below. So probability factor 0.2, 0.5, 0.3. Price of a share 220, 250, 280, 290, 310 and 330. So this is the next year information. The next year, what is the dividend expected? 20% and 35%. So what are the prices by the end of the next year? They have given three possibilities. Three possibilities. The price of a unlimited can be 220, 250 or a 280. Price of unlimited can be what? 290, 310 or 330. So what is the second part of a question? Calculate expected average return from the portfolio for the year 2010-11. 2010-11. So take heading, the same heading. What average return of portfolio for the year ended? B part. Average. Average return of a portfolio. Average return of a portfolio for the year ended 31st March 2011. Clear? Average return of a portfolio for the year ended 31st March 2011. Clear? So first, to find out the average return of portfolio, first we should find out what? The return of M limited. Return of a M limited. Return of M limited. What is P naught? Price at the beginning of the next year. 220, not the 200. Price at the beginning of the next year. What is the price at the beginning of the next year? 220. 220. Yes or no, Sai? 220. Next what? Price D1. What is D1? 20%. What is the face value? 100 into 20%. 100 into 20%, 20 rupees. Next, price at the end of the next year. Price at the end of a next year. So they have not directly given yes or no. Price at the end of the first year. So price can be what? There are three scenarios, yes or no, three possibilities. What is the first possibility? So the price at the end of the next year can be 220. So what is the percentage of occurrence? 0.2. Nothing but 20% chance that the price at the end of first year can be 220 plus 250 into 0.5 plus 280 into 0.3. So price at the end of the next year can be 220 into 0.2 plus 250 into 0.5 plus 280 into 0.3. So 253, yes or no? 253. Done. Now we can find out return, yes or no? Return is equal to 253 minus 220 plus 20 divided by 220. 24.09%. 24.09 percentage. Clear? 24.09 percentage. Very good, Vaishnavi. Find me who I am. Find answer if you can. Next, return of what? Unlimited. Return of a N limited. Return of a N limited. What is return of N limited? How do we get return of N limited? Same, yes or no? What is P naught? 290. P1, sorry, D1. D1 is equal to 10 into 35%. Next what? P1 is equal to 290 into 0.2 plus 310 into 0.5 plus 330 into 0.3. So P1 is equal to 312. Price at the end of the first year. Am I clear? Done. So okay. Now the return is equal to, what is the return? 312 minus 290 plus 3.5 divided by 290. 8.79 percentage. 8.79 percentage. Clear? So there are high chances that you might do a mistake while finding out the average return of a portfolio. Average return of a portfolio. Average return of a portfolio. Average return of a portfolio is equal to, some students might write 2 lakhs divided by 3 lakh 50 into 24.09 plus 1 lakh 50 divided by 3 lakh 50,000 into 8.79. You might write this, but this is not correct because the weights have got changed. For the next year, the investment values have got changed. So that's why the answer will be, what is the investment value at the beginning? M limited shares 1000 shares and the price is 220. So the calculation will be 1000 into 220 divided by 1000 into 220 plus 500 into 290. Are you getting my point? What is investment value of M limited? Investment value of M limited is 1000 shares into 220. That is 2,20,000. What is the overall value? 1000 into 220 plus 500 into 290. Mohan just miss opposite. Nee daga rala. Okay. 2,20,000 divided by what? 3,65,000 into what? 24.09% plus 500 into 290 divided by 3,65,000, or else you can take 1000 into 220 plus into what? 8.79. For next year, the weights are changing. For next year, the weights are changing. So that's why be careful, okay? Fine. Done. So what is the answer? 18.0 18.0119%. percentage. Clear? Clear? 18.0119 is the answer. Okay, fine. Done. See the last part. So this is a special part. Advise X company limited of the comparative risk in the two investments by calculating the standard deviation in each case. So we have to find out the standard deviation in each case. M limited, N limited, M limited and N limited. కృష్ణవంశీ ఏంటి మ్యారీడా? ఆవలిస్తూనే ఉన్నావు వచ్చిన దగ్గర నుంచి. నైట్ పడుకోనివ్వట్లేదు పిల్లలు, ఏడుస్తున్నారు అదే పనిగా. ఓకే, క్యాలిక్యులేట్ ద 1 yearలో పిల్లలంటే అలాగే ఏడుస్తారు, తప్పదు. Calculate the standard deviation in each case. Calculate the standard deviation in each case. Papa, Baba. Calculate the standard deviation in each case. Okay. Shall we start? Calculation of a standard deviation. So this is the special part in this question. Special part in this question. Okay. Standard deviation. So write down the last part. Calculation of a standard deviation. In new syllabus, they haven't asked this question. So if they want to complicate the question paper, they will ask this question. And their intention is to complicate the paper. Okay. So that's why for the past 5 attempts, they were asking the advanced questions. Calculation of a standard deviation. Calculation of a standard deviation. Okay. Fine. In that first one, sigma x. Sigma x. So be careful. So probability is given, yes or no? So we should find out the standard deviation for the next year. Probability is given. Okay. When probability is given, what are the columns? X. Leave more space for x. Okay. X. P. P into x. X bar. X minus x bar. P into x minus x bar whole square. ఓకే కృష్ణవంశీ, ఏమైంది కోపంగా చూస్తున్నావు? నేనేమన్నాను? పాపా బాబా అన్నాను అంతే కదమ్మా. ఇన్ఫర్మేషన్ ఎక్స్ పి, పి ఇంటూ ఎక్స్, ఎక్స్ బార్, ఎక్స్ మైనస్ ఎక్స్ బార్, పి ఇంటూ ఎక్స్ మైనస్ ఎక్స్ బార్ స్క్వేర్. ఓకే, క్లియరా? డన్. ఓకే, X calculation. So there are 3 scenarios, yes or no. Probability is given. So this part has to be considered separate. So then you will not get confused. So X, how do we get X? P1 minus P0 plus D1 divided by P0. There are 3 possible scenarios. First possibility, the price can be 220. Okay. So what is the calculation? 220 minus 220. Price at the end of the year 220, at the beginning also 220, plus dividend. What is the dividend? 20 divided by what? 220. Note down the answer. In question bank you will find different columns, you will get confused. So 220 minus 220 plus 20 divided by 220. So Krishnavamsi, what is the answer? 9.09. Okay, clear? Priya, what is the next calculation? ఏమైంది అలా చూస్తున్నావు? తిరునాళ్ళు తప్పిపోయినమ్మా ఇలాగా. 250 minus 220, 30, 90 is not 20 divided by 220. 250 minus 250 minus what? 220 plus 20 divided by 220. 22.72. Very good, Amma Priyadarshini. Vaishnavi. Next what? What is the next calculation? Manasa. 280 minus 220 plus 20. Very good, Amma. 36.36%. 36.36% is the answer. Am I clear? So this is X. Next what? Probability. What is the probability? 0.2, 0.5, 0.3. Next P into X. 1.818, 11.36. Very good, Amma. 10.908. 24 point. So this is what we got in second part. 24.09. X bar. Yes or no? Next what? X minus. So X bar. 24 point. Sai Vikrant. Where is this Raju? Ravindra Raju? Aravind Raju? He might come. Okay. He didn't came to yesterday's first session, right? But he asked doubt. Now today he will come for second session and again he will ask doubt. X minus X bar. వాళ్ళ ఫాదర్ నెంబర్ ఇవ్వమ్మా నాకు. ఉందా లేదా నీ దగ్గర? His father came from Coimbatore for his admission, so that's why I wanted to talk to him. X minus X bar. X minus X bar. మీలో కూడా పేరెంట్స్తో పాటు ఎవరు జాయిన్ అయ్యారు? ఓకే, ఫైన్. Krishnavanshi, you came with parents. Very good, Amma. Bhargav, I know your parents, right? Oh, yes. X minus X bar. X minus X bar. Tell me X minus X bar. Minus 14.996. Minus 1.366. 12.2. Can we take the total of X minus X bar? No. Because total will be? No. Total will not be equal to 0 because it is probability question. But even then we cannot take. Okay. But if we take P into x minus x bar, if we take the total of P into x minus x bar, then we get 0. So that's why we should take what? The square. P into x minus x bar square. Tell me the numbers. 44.976, 0.9329, 45.19, 195. So what is the total? 90, 91 point. Shivani 91.1039. So sigma x is equal to square root of 91.1039. Okay. So subconscious mind will ask you to divide 191.1039 with 3. So be conscious, okay? Sai, what is the answer? Very good, Amma. 9.55, 9.54 percentage. In similar way, find out the standard deviation for the next company, that is unlimited, sigma y. Find out sigma y. I'm not going to calculate. Find out sigma y. So what is the answer sigma y? 4.827. Sigma y, you will get 4.827. ఆషికి మూవీలో హీరో లాగా వర్షంలో తిరగకండి, జ్వరాలు వస్తాయి. అర్థమవుతుందా? Sigma y is equal to 4.827 percentage. So try the next one, sigma y. Priyadarshini, will you try this or not? Manasa, you want me to write or what? Gopal Verma, Manju Warrior, Chitti, the Robo, Srikari. 4.827. Online students, are you going to calculate this or not? Very good, Amma Chitti. Priyadarshini, 4.827, very good. Vaishnavi, okay, you're doing right, fine. So what is the answer? 4.827. So this is a different kind of a question. If you see 1, 2, 3, 4, 5, if you know the concept, you can do what up to 5. But sixth will is somewhat different. So that's why be careful, okay? So sixth you have to practice. If the same question is given in weekend exam or in grand test, you may not be able to do. Same question. Once again, once again, I'm repeating question number 6. If the same question, if it is asked in weekend exam or in any grand test, you may not be able to do. Okay. So you might do only first part. You might do a mistake in second part, or else if you're not doing mistake in second part, at least what in third part. Okay. So with this, we have completed the first part, return and risk of a security and what? Return and risk of a portfolio. Return and risk of a portfolio. So clear? Return and risk of a portfolio. Done. So after break, we shall start the next concept, that is systematic risk and unsystematic risk. Systematic risk and what? Unsystematic risk. Okay. At 10:50 we shall start. Okay. 10:50 next session. So next concept beta. Next concept beta. So in first part of the portfolio management, we have learned how to find out the return and risk of a security and return and risk of a portfolio. The risk of a security can be measured using variance, standard deviation, or a coefficient of a variance. Likewise, risk of a portfolio, sigma p. Sigma p. Yes or no? Standard deviation. So the standard deviation is equal to total risk. Standard deviation is nothing but what? Total risk. Standard deviation is equal to total risk. Okay. And this total risk can be systematic risk or a unsystematic risk. Total risk can be what? Systematic risk or an unsystematic risk. So unsystematic risk can be diversified, but systematic risk cannot be diversified. Systematic risk cannot be diversified, but unsystematic risk what? Can be diversified. So total risk is equal to systematic risk plus unsystematic risk. Which risk can be diversified? Unsystematic risk can be diversified. For example, inflation. For example, Donald Trump, tariff effect. So Donald Trump, if he is going to increase the tariff rates, it is going to affect not one single company. Okay. So the inflation in US is going to increase. The inflation in US is going to increase, and the price of a goods are going to increase. If the price of a goods increases, then what happens to the demand? Demand will decrease. Yes or no? So the point is, systematic risk means a country specific. It is applicable to all the companies. Like for example, Corona is an example for what? Systematic risk, because it is going to affect each and every company, country. Okay. So systematic risk, it cannot be diversified. For example, even if you have made investment in 10 stocks, still you will be losing money, because Corona is going to affect what? Everybody. So it has affected, COVID has affected what? Everyone. COVID has affected what? Everybody in the society. Yes or no? So even a school going student has got affected, college going student has got affected, colleges has got affected, schools has got affected, everybody has got affected. So that's why COVID is what? Systematic risk. It cannot be what? Diversified. Nothing but. So what is the object of a portfolio management? Portfolio management objective is to diversify the risk. Portfolio management objective is to diversify the risk. Okay. So portfolio management objective is to diversify the risk. Okay. So here systematic risk cannot be diversified. For example, you are investing in X Limited. At the same time, you are investing in Y Limited also. So that is portfolio investment. Yes or no? Portfolio investment means investment in two or more securities. If you are making investment in two or more securities, what is the purpose of making that investment? To diversify. To diversify the risk. Yes or no? To diversify the risk. Okay. If the risk has got diversified, okay, only unsystematic risk can be diversified, but systematic risk cannot be diversified. Example, war. For suppose if a war begins between the Pakistan and India, then what happens? Every company will get affected. Not a single company. Every company will get affected. War. War is not selectively going to affect only X Limited. War is not selectively going to affect what? Y Limited. So war is going to affect what? All the companies. So that's why that systematic risk cannot be diversified. Systematic risk cannot be diversified. Okay. What about unsystematic risk? Unsystematic risk can be diversified. So unsystematic risk examples: labor strike in a company. Labor strike in a company. So labor strike in a company is a systematic risk or unsystematic risk? Labor strike, it is an unsystematic risk. For suppose labor in X Limited company are doing strike, still our investment in Y Limited is safe. Yes or no? Only the share price of X Limited will get affected. Will get affected. Likewise, inflation, GDP, inflation, GDP, interest rates. These are the examples for what? Systematic risk. GDP, inflation, interest rates. These are the examples for what? Systematic risk, and cannot be diversified. The risk arising due to the inflation, GDP, or interest rates cannot be diversified, because increase or decrease in interest rates are going to affect all the companies equally. Are you getting my point? Okay. So what is an unsystematic risk? Unsystematic risk means company specific or industry specific. Company specific. Company specific or industry specific. So for example, so you might be aware of a cinema ticket prices in the previous government, Andhra Pradesh. Yes or no? If the cinema ticket prices are going to be increased, or I mean decreased, cinema ticket price is going to be decreased, then only what? Film producing companies are going to get affected. Why do the real estate company will get affected? Real estate company will not get affected. Pharmaceutical company is not going to get affected. Only what? The film producing companies will get affected. Yes or no? So unsystematic risk is also called as a residual variance. Residual means left out. residual variance. It is a company specific or industry specific. It can be diversified. So the company specific risk or industry specific risk can be diversified. So are you getting my point? Clearer? So total risk is equal to combination of systematic risk and unsystematic risk. Which risk can be diversified? Only unsystematic risk can be diversified, which is company specific or industry specific is can be diversified. So what about the systematic risk? Systematic risk cannot be diversified. Okay, systematic risk cannot be diversified. Am I clear? So okay. So here for the timing, systematic risk. Beta denotes a systematic risk. Beta denotes what? Systematic risk. It denotes responsiveness of a security return with respect to the market return. You might have already came across beta in business valuation. So beta. So beta, we also call it as sensitivity of a security return with respect to market return. Sensitivity, sensitive. We call some people sensitive, yes or no? We call some people insensitive. Sensitive, insensitive. Sensitive and insensitive. For example, Krishnavamshi has got recently, okay, gone through a breakup. But still he is what? He is having a smile on a face. That means this person is sensitive or insensitive? This person is sensitive or insensitive? Insensitive. Okay. So again he got patch up and again the same smile. Sensitive or insensitive? Insensitive. He is maintaining the smile irrespective of what? Breakup, marriage or whatever. So the point is what? He is insensitive. He is what? Insensitive. Are you getting my point? Okay. So for example, Mohan has got through a breakup and he has, attempted what? Okay, he attempted a suicide. Example, let us assume. So that means what? He is sensitive. He is what? Sensitive. Insensitive, sensitive, sensitive. So recently you might have seen some news or news, wife killing husband in Meghalaya something. Okay, keeping wife, husband dead body in drum and all. So, okay, here wife a sensitive or insensitive? Sensitive only. Wife sensitive only. Sensitive. That's why what she has done murder. Sensitive only. Okay. Sensitive doesn't mean what only sympathy. Even anger is also what sensitive. If I'm getting anger, that means what I'm sensitive. Not just what okay, sadness, even anger, happiness, whatever it is means what sensitive. Okay, sensitive, sensitive and insensitive. Likewise, company is also what sensitive to the market. Company is also sensitive to the market. Are you getting my point? For example, sensitive and insensitive. We are the same person, irrespective of our surroundings, irrespective of an opposite person. Whether you get positive result or negative result, whether you're okay getting a response from opposite person or not, you're the same person. That means what? You are insensitive. You are insensitive. No change. You're not changing just because of other person. You are the same. That means what? It is insensitive. Insensitive. Okay. So, but for suppose if you are changing with respect to the other person, with respect to the other person, then what? That means you are sensitive. Clear? Advainda? Okay. Sensitive means responsiveness with respect to the opposite reaction. Opposite reaction. Here beta denotes a systematic risk. It denotes responsiveness of a security return with respect to what? Change in market return. Change in market return. Okay. So market, for example, if markets are good, then our company will also perform well. That means our company is sensitive or insensitive. Our company is sensitive. If the market is not doing well, our company is also not doing well. Sensitive. So if markets are doing well, our company is not doing well. Sensitive only. If a market is not doing well, our company is doing well, then also sensitive. Okay. But our company is not doing well, irrespective of a market. Whether market is doing well or not, our company is not doing well. Okay, that means what? Insensitive. That means no relation between market and company. Okay, so likewise, our company is doing well, irrespective of a market. Irrespective of a market. That means what? Insensitive. That means what? Insensitive. For example, so as we have already discussed, Krishnavamsi is insensitive to puja behavior. Yes or no? Insensitive or sensitive? For example, Pooja Hegde, she got hurt in shooting. Okay. Will Krishnavamsi cry or what? No. That means what? He is insensitive. Krishnavamsi will dance or what? No. That means what? Insensitive. Okay. So sensitivity doesn't mean only happiness. Any type of emotion. Any type of emotion. Okay, clear? Insensitive means what? We are not bothered at all. We are not bothered. Okay. So here also beta denotes responsiveness of a security with respect to the market. Security means shares, bond, money market instrument. Money market instrument. Okay. So here whenever I say market, market means a Nifty or a Sensex index. Whenever I say market, market means what? Index. Index. So the popular index in India. So what are the popular index in India? Nifty and Sensex. Nifty is for NSE, National Stock Exchange. Sensex is for BSE, Bombay Stock Exchange. So whenever I say market, market means what? Index. Whenever I say market, market means what? Index. Market means index. So what is index? Even in your question bank, you might find index. In any book, you will find index. In any book, yes or no? What does the index denotes? Okay, index will give you an overview. What does this book contains? Yes or no? What does this book actually contains? Yes or no? Index will give you what? Overview. What does this book contains? Likewise, NSE, National Stock Exchange index Nifty. Nifty is the index. What does this Nifty index indicate? Okay, Nifty will show, Nifty will give an overview of the markets in India. Nifty will give you overview of the performance of the companies in India. How the businesses are doing in India. How the businesses, whether the businesses are doing well or not. Okay, if Nifty is increasing, okay, even in news you might have seen, if Nifty points are increasing, that means what? So today markets have done well. If Nifty points have got decreased, so today markets have not done well. Yes or no? So Nifty means what? Nifty is an index. Nifty is an index. Nifty, it evaluate the performance of only 50 companies, largest companies, 50 largest companies in India in terms of a market capitalization. How do we get market capitalization? number of shares into market price per share. Number of shares into market price per share. A number of shares into what? Market price per share. Clear? So Nifty companies, Nifty is nothing but what? Index. It shows the performance. Nifty points are calculated on the basis of 50 largest companies. 50 largest companies. In terms of what? Market capitalization. So market capitalization means number of shares into market price per share. So okay, so Nifty points, they are simply calculated on the basis of what? 50 companies. 50 companies. So 50 companies are selected based on what? Market capitalization. How do we get market capitalization? Market capitalization. Market price per share into number of shares. Okay. How these Nifty points are calculated? Nifty points are calculated. So I'm taking a simple example for calculation of Nifty points. I'm taking only X limited and Y limited. But Nifty actually contains how many companies? 50 companies. 50 companies. Let us assume X limited is having 1,000 shares. When market price per share 100. Y limited is having 2,000 shares and the price is 200. What is the market capitalization? 1,000 into 100. 1 lakh. Next 4 lakhs. Total 5 lakhs. Total what? 5 lakhs. 5 lakhs is the market capitalization. 5 lakhs is the market capitalization. So Nifty, let us assume the Nifty base points is equal to 100. So let us assume today Nifty points is equal to 100. Today Nifty points 100 and Nifty, let us assume only containing 2 companies. Actually it contains how many companies? 50 companies. So to understand the concept how the Nifty points are calculated, I am taking only 2 companies, X limited and Y limited. So X limited there are 1,000 shares, market price per share 100, and Y limited 2,000 shares and market price per share 200. 200. So tell me, next day what happens? The share prices, not next day, for every minute what happens? The market price per share may increase or decrease. So that means what? Every minute the market capitalization keeps on changing. Keeps on changing, yes or no? Keeps on fluctuating. So here if market capitalization increases, then what happens to the Nifty points? Nifty points will increase. When does the market price per share increases? If the company is performing well, if the investors having a faith that the company is going to perform well or performing well, then what happens? The share price will increase. If market price per share increases, then what happens to the market capitalization? Increases. If market capitalization increases, then what happens to the Nifty points? Nifty points will increase. Nifty points increase means what impression it will give to the investors? What impression it will give it to the public or a government? The markets are doing well in the country overall. Okay, if Nifty points are increasing means what? It indicates BCCA also is doing well. BCCA is also doing well. Every company in India is doing well. Okay, are you getting my point? So, how the Nifty points are calculated? For example, the next day, X limited and Y limited. So the shares will remain same, yes or no? Unless there is a bonus issue, rights issue, or a buyback. Okay, so the number of shares will remain same. Let us assume the market price per share has got increased to 110 and this has got increased to 220. Market price per share has got increased to 110 and 220. Let us assume. So what is the market capitalization? 1,10,000, 4,40,000. Overall, 5,50,000. Now the Nifty point for the next day is equal to. Now the Nifty for the next day is equal to. So Nifty points 100. When the market capitalization is 5 lakhs, Nifty points is equal to 100. Yes or no? Now the market capitalization has got increased to 5 lakh 50. Now the question is for 5 lakhs 100. For 5 lakh 50 question mark. Are you getting my point? For 5 lakhs, when the market capitalization is 5 lakhs, when the market capitalization is 5 lakhs, how many points? 100 points. But now the market capitalization is 5 lakh 50. So what happens to the Nifty points? Nifty points will increase. Nifty points will increase. Nothing but what is the calculation? 5 lakh 50,000 divided by 5 lakhs into 100. So Nifty points will be 110. Nifty points will be 100. Okay, fine. So Nifty points 100. Done. I mean Nifty points 110. So if the market price of a Nifty company increases, then automatically what happens? Market capitalization increases. If market capitalization increases, Nifty points will also increase. Likewise, same with Sensex also. Same with Sensex. Same with Sensex or any index. Any index, if you take New York Stock Exchange or any stock exchange, the index is calculated based on what? Market capitalization. If a market capitalization increases, then automatically index points will also increase. So whenever I say the market means what? Index. Whenever I say market means what? Index. Am I clear? Okay. So beta, what does beta denotes? Beta denotes systematic risk. It denotes responsiveness of a security return with respect to change in market return. Market return. Responsiveness of a security return with respect to change in market return. Sensitivity. Beta is also called as sensitivity. It measures the sensitivity of a security with respect to the market. Okay, are you getting my point? So, for example, beta is equal to 1. Beta can be positive or negative or 0. Beta can be negative. That means -2, -3, -4. Beta can be positive. That is what? 3, 4, 5. Or beta can be what? 0 also. Beta can be 0. If a beta is negative, what does it mean? Beta is negative. Beta is negative means market and security moving in opposite direction. Beta positive means moving in same direction. And beta ranges from -infinity to +infinity, not -1 to +1. Beta can be 5, 10, 15, 20. Okay, and beta is a ratio, not a percentage. Beta is a ratio. So beta negative means what does it indicate? For example, beta of a Sairam Limited, beta of a Sairam Limited is equal to 0. That means what? No relation between market and Sairam Limited shares. Nothing but Sairam Limited shares are performing. Sairam Limited is performing well irrespective of a market, or Sairam Limited is not doing well irrespective of a market. Nothing but Sairam Limited is insensitive to the market. So there is no relation between Sairam Limited and market. If there is no relation between Sairam Limited and the market, then beta of a Sairam Limited will be 0. Okay. So beta of a Mohan Limited is negative. Beta of a Mohan Limited is negative. What does that mean? Opposite direction. That means what? If market is doing well, Mohan Limited is not doing well. If a market is not doing well, Mohan's company is doing well. But this is very rare, because if markets are good, then only there are high chances of our company doing well. అంతే కదా, అందరూ బాగుంటేనే మనం బాగుంటాం, అంతేకాని మనం మాత్రం ఎలా బాగుంటాం? ఓకే. సో మన ఇల్లు, మన ల్యాండ్ రేట్స్ మాత్రం ఇంక్రీజ్ అవుతాయా? ఇంక్రీజ్ అయితే ఏంటి? ఆల్ ద ల్యాండ్ ప్రైజెస్ హ్యాస్ టు ఇంక్రీజ్. హౌ డు ఓన్లీ ఆర్ ల్యాండ్ రేట్ విల్ ఇంక్రీజ్? నో. So likewise, what most of the cases, the beta of a companies will be positive. Beta of a companies will be positive in most of the cases. That negative is rare. Negative will be rare. So most of the cases beta will be what? Positive only. Beta positive means what? Both market and security moving in same direction. Both market and security moving in what? Same direction. Are you getting my point? Okay. So beta can be what? Positive, negative, or 0. 0 means what? No relation. So beta of a Krishnavamsi Limited 0. That means what? No relation with the market. Okay. So beta of a Sairam positive means what? Same direction. Beta of a Mohan Limited negative means opposite direction. Market and security moving in opposite direction. So beta measures sensitivity. Beta measures what? Sensitivity. Beta, if it is 0, no relation, that means insensitive. Security is insensitive. Security companies, the shares are insensitive. If a beta is positive or negative, sensitivity can be negative or positive. Sensitivity can be what? Negative or positive. Clear? Beta can be what? Sensitive. I mean sensitivity can be what? Negative or positive. Negative or positive. క్లియరా? అర్థమైందా మీకు? నార్మల్గా కూడా అంతే కదా. సో మోహన్ బ్రేకప్ అయింది, బట్ కృష్ణవంశీ ఫీలింగ్ హ్యాపీ. సెన్సిటివిటీ వాట్? నెగిటివిటీ. సెన్సిటివిటీ సెన్సిటివ్. నెగిటివ్ ఆర్ పాజిటివ్? నెగిటివ్. వెన్ మోహన్ ఈజ్ ఫీలింగ్ సాడ్, కృష్ణవంశీ ఈజ్ ఫీలింగ్ హ్యాపీ. ఓకే, క్లియరా? సో sensitivity can be what? Negative or positive. Likewise beta can be what? Negative or positive. So most of the cases beta of a company will be what? Positive only. Okay. High beta indicates high risk. High beta indicates high risk. High beta, nothing but high sensitivity indicates what? High risk. High sensitivity indicates high risk. So let me give an example. So for example, Krishnavamsi, he gave a small chocolate to his girlfriend. She felt very happy. She felt very happy. Okay. And next he spent 2 minutes time with his girlfriend. She felt very, very happy. Okay. So that means what? High sensitivity. High responsiveness. High responsiveness. Even if he is spending 2 minutes time, she is feeling very happy. Even if he is giving small chocolate, she is feeling very happy. For suppose if he stops giving that small chocolate, then what happens? Okay, she feel very, very, very sad. మనం పాజిటివ్ చూస్తున్నాం అంతే. వాట్ అబౌట్ నెగిటివ్? వాట్ అబౌట్ నెగిటివ్? ఓకే, మీకు అర్థమైందా? సో హై సెన్సిటివిటీ మీన్స్ వాట్? హై రిస్క్. హై సెన్సిటివిటీ మీన్స్ వాట్? హై రిస్క్. అర్థమవుతుందా? హై సెన్సిటివిటీ మీన్స్ హై రిస్క్. ఆర్ యూ గెటింగ్ మై పాయింట్? లైక్ వైజ్ బీటా, ఫర్ ఎగ్జాంపుల్ బీటా 2, beta of a Mohan Limited is equal to 2. What does it mean? If a market changes by 1%, security of a Mohan, I mean nothing but Mohan Limited share price changes by 2%. It is a ratio. It is a ratio. So beta of a Mohan Limited is 2. Beta of a Mohan Limited is 2 means what? If a market changes by 1%, here the share price changes by 2%. Clear? So beta of a Sairam Limited 10. If a market changes by 1%, Sairam Limited share price changes by 10%. Okay, nothing but if a market increases by 1%, share price of Mohan Limited increases by 2%. If a market changes by, I mean market increases by 1%, share price of a Sairam Limited increases by 10%. Okay, which is better? You might feel Sairam is better because market increases by 1%, Sairam Limited share price increases by 10%. But that is high risk, because if a market decreases by next day, if a market decreases by 10%, then share price decreases by 100%. Share price decreases by 100%. So that means what? High risk. High beta, high risk. High beta indicates what? High risk. Okay, beta is equal to 0 means no risk. Beta is equal to 0 means what? No risk. High beta means high risk. Low beta means low risk. Low beta means low risk. So generally beta of a risk-free security will be 0. Beta of a risk-free security will be 0. Treasury bond, government treasury bond. Government treasury bond. So government treasury bond, so beta will be 0. Why? Fixed rate of a return. Whether markets are performing well or not, investors will get fixed rate of a return. So that's why beta of a risk-free security is equal to 0. And also beta of a cash. If you are having a cash 500 or 1000 as of now, so beta of that cash is also 0. Why beta of a cash is also 0? For example, today markets are doing well. Will the cash in your pocket is going to increase? No, your cash will remain same. For suppose if market is not doing well, even then the cash in your pocket will remain same. That means what? Beta of a cash is 0. No relation between the cash position and market. No relation between the cash position and market. Are you getting my point? So here total risk is equal to systematic risk plus unsystematic risk. Systematic risk is a country specific, but unsystematic risk is a company specific or a industry specific. Systematic risk cannot be diversified. Unsystematic risk can be diversified. Beta denotes, for the timing, beta denotes systematic risk. Okay, not 100% correct, but for the timing, beta denotes what? Systematic risk. Raju? Okay, beta denotes systematic risk. It denotes responsiveness of a security return with respect to change in market return. Beta of a risk-free security and cash 0. Beta of a market is always equal to 1. Beta of a market. Beta of a market 1. Why? Because if market changes by 1, market changes by only 1. Beta denotes responsiveness of a security with respect to market. Beta of a market means what? Responsiveness of a market with respect to market. Yes or no? So beta of a market will always be equal to what? 1. If you are finding out a sensitivity of U with U, you will get what? 1. If you are finding out if you are finding out sensitivity with respect to what? U only, then what? 1. Nothing but if you are feeling sad, that means what? You are going to feel sad only. No sad gunta, no happy gunta. Are you getting my point? So sensitivity of U with U is 1. Likewise, sensitivity of a market with market is what? 1. So that's why beta of a market is what? 1. Beta of a market is equal to what? 1. Clear? Next, beta can be positive. Beta of a company is beta of a Reliance or beta of a Wipro, or can be what? Negative, positive, or 0. So beta positive means what? Market and security moving in same direction. Beta negative means market and security moving in opposite direction. Beta 0 means no relation between market and security. No relation between market and what? Security. Am I clear? Clear? Last. What is your name? Pratima. Okay. So when 2 years or 2 periods data is given, so how to find out beta? For examination point of view, you should know how to find out beta. So beta concept is very important, because again in derivatives, security valuation, in business valuation, you might have came across this beta. Beta is a risk factor. So if beta increases, beta is a risk factor. Beta is a risk factor. If beta increases, risk increases, yes or no? So that's why K is equal to RF plus RM minus RF into beta. Nothing but if beta increases, what happens? KE increases. Cost of equity KE increases. This is a fundamental point. If risk increases, required return increases. If required return increases, wealth decreases. If a beta increases, KE increases, yes or no? If a KE increases, what happens to the P naught price? P naught is equal to D1 divided by KE minus G. P naught is equal to D1 divided by KE minus G. This you might have came across, yes or no? D1 divided by KE minus G in business valuation. Or else I will be discussing in time value of money. Okay. So here, how do we get P naught? P naught is equal to D1 divided by KE minus G. So what is this KE minus G? Okay. KE, required rate of a return. So understand the concept. If risk increases, KE will increase. So KE is the denominator, yes or no? If a KE increases, what happens to the P naught? P naught decreases. P naught, current market price of a share, is equal to D1 divided by KE minus G. So if a current market price P naught decreases, then obviously wealth of a shareholder will decrease. Wealth of a shareholder will decrease. But our ultimate objective is to maximize the wealth of a shareholder. Maximize the wealth of a shareholder. Are you getting my point? Okay. So beta can be positive, negative, or 0. So beta of a risk-free security is 0. So that's why KE of a risk-free security is equal to only RF. Because RF plus RM minus RF into beta. Beta of a risk-free security is equal to 0. That means what? RF. Required rate of a return of risk-free security is equal to RF. For suppose market, if you are investing in Nifty, If you are investing in Nifty. So then what is the beta of a market? Beta of market is 1. Beta of a market is 1. That means what? RF plus RM minus RF. RF and RF will get cancelled. Then what required return is equal to RM. Nothing but if you are investing in market, then required return is equal to RM. If you are investing in risk-free security, required return is RF. But if you are investing in any equity share, then RF plus RM minus RF into beta. If a beta of that equity share is high, then obviously KE will increase. If a beta of that particular equity share is less, then your KE will decrease. Clear? Done? So how do we find out the beta? First understand what does beta denotes. Beta denotes what? Responsiveness of a security return with respect to change in market return. With respect to change in market return. With respect to what? Change in market return. Okay. So simple calculation. Simple calculation. Vaishnavi, my voice clear or not? Vaishnavi, is my voice clear or not? Manasa. So how do we get the beta? Beta denotes what? Responsiveness of a security with respect to what? Market. So beta is equal to change in security return divided by change in market return. Beta is equal to what? Change in security return divided by change in market return. Change in market return. Okay. So for example, year market security. Year market and what? Security. Year 1, 2. For example, market return 10, 12. Nothing but year 1, what is the market return? 10. What is the market return for second year? 12. What happened to the market return? Market return has got increased by 2%. What was the market return for the first year? 10. Second year? 12. Security. Security market return 12 and 18. 12 and 18. So by seeing these numbers, we can say that both security and market are moving in same direction. Both are moving in same direction. That we can say. Yes or no? So how do I get beta? Beta is equal to change in market, security return with respect to market. So that's why security has to come in numerator, market in the denominator. Because beta is a responsiveness of a security return with respect to change in market return. Change in market return. Okay. So what is the calculation? Change in security return. 18 minus 12 divided by 12 minus 10. You will get what? 3. It is a ratio, not a percentage. It is a ratio. What does that mean? For every 1% change in market, security is changing by 3%. For every 1% change in what? Market, security is changing by 3%. Or else if you see the example, market change is 2%, security change is 6%. For every 2, 6 means what? For every 1, 3. So beta is equal to 3. So we can use this simple formula when only 2 years data is given. Only when 2 years or 2 periods data is given. 2 periods. If only 2 periods data or 2 years data is given, then what is the formula? Change in security return divided by change in market return. But when more than 2 periods data is given, 1, 2, 3, then I cannot apply this formula. Yes or no? How can I apply this formula? Change in. If I have to find out change, there should be 2 periods. But if there are more than 2 periods, then cannot apply this formula. So what is the beta formula? Change in security return divided by change in market return. Okay, portfolio management is very important, but unfortunately rainy season. ఓకే బాగా కూల్గా ఉంటుంది, నిద్ర వస్తుంటుంది, అర్థమవుతుంది, దుప్పటి కప్పుకొని పడుకోవాలనిపిస్తుంది. బట్ వెరీ ఇంపార్టెంట్ కదా పోర్ట్ఫోలియో మేనేజ్మెంట్. సో వాట్ ఈస్ ద బీటా ఫార్ములా? చేంజ్ ఇన్ సెక్యూరిటీ రిటర్న్ డివైడ్ బై చేంజ్ ఇన్ వాట్? మార్కెట్ రిటర్న్. సో దిస్ ఫార్ములా కెన్ బి అప్లైడ్ వెన్, ఇప్పుడే చెప్తున్నా, నీ పేరేంటమ్మా? వర్ష. నువ్వు కూడా పడుకుంటే వెళ్ళమ్మా వర్షాకాలంలో. వర్ష లెంత్ తక్కువే ఆవలించడంలో, బట్ ఫ్రీక్వెన్సీ ఎక్కువ అమ్మాయిది. మోహన్. సో 10 seconds ఆవలిస్తుంది, బట్ ఫ్రీక్వెంట్గా ఎవ్రీ 1 minute ఆవలిస్తుంటుంది అమ్మాయి వర్ష. సో వాట్ ఈస్ ద బీటా ఫస్ట్ ఫార్ములా? వెన్ 2 periods డేటా ఇస్ గివెన్, చేంజ్ ఇన్ సెక్యూరిటీ రిటర్న్ డివైడ్ బై చేంజ్ ఇన్ మార్కెట్ రిటర్న్. థ్యాంక్స్ అమ్మా, వెలుగును ప్రసాదించు. చేంజ్ ఇన్ సెక్యూరిటీ రిటర్న్ డివైడ్ బై చేంజ్ ఇన్ మార్కెట్ రిటర్న్. ఓకే, so this formula can be applied only when 2 periods data is given. 2 periods data is given. Am I clear? Okay, but when more than 2 periods data is given, then. But in first formula you should know. So what does beta denotes? Responsiveness of a security return with respect to change in market return. Denominator market, numerator security. Numerator what? Security. So next formula, I mean when more than 2 periods data is given, beta is equal to covariance of S comma M divided by what? Variance of a market. Covariance of S comma M. S means security, M means market. Covariance of S comma M means it denotes co-movement of security and market. How does the security and market are moving? Covariance of S comma M divided by what? Variance of a market. So beta is equal to covariance of a S comma M divided by sigma M square. Okay, so denominator market. Denominator what? Market. Variance of market. Numerator security. So covariance of security and market. So what I'm writing is not relevant. What is the formula? The deviation of S into deviation of market. S or no? Forget about summation sigma and N. If you ignore summation sigma and N, what is the ds into dm? Deviation of security into deviation of a market. Covariance of S comma M means security and market. It denotes co-movement of security and market. So divided by M minus M bar square. Yes or no? So what is left out? Deviation of security divided by deviation of market. Responsiveness of security with respect to market. With respect to market. So that's why the second formula, when more than 2 periods data is given, when more than 2 periods data is given. So what is the formula? Covariance of S comma M divided by sigma M square. Covariance of S comma M divided by sigma M square. Am I clear? Done. Covariance of S comma M. So what is the other formula for covariance of S comma M? Very good, Amma. Covariance of S comma M is equal to sigma S, sigma M, sigma SM. Can I write this or not? Sigma S, sigma M, sigma SM. Can I write this or not, Manasa? Very good, Amma. Okay. Sigma S, sigma M, sigma SM. Okay. So beta is equal to, instead of covariance of S comma M, I can write what? Sigma S, sigma M, sigma SM divided by what? Sigma M square. Then what happens? Square and sigma M will get cancelled. That means I can write beta is equal to sigma SM into, good afternoon, Amma, sigma M. Sigma SM into what? Sigma S divided by sigma M. Beta is equal to sigma SM into what? Sigma S divided by what? Sigma M. So this is the formula for beta. Can we write this or not? This third formula is being derived from the second one only. Covariance of S comma M is equal to sigma S, sigma M, sigma SM. Sigma M and square will get cancelled. Okay. Again here also security numerator, market denominator. Sigma SM means what? Correlation between security and market. Correlation between security and market. Sigma SM into sigma S divided by sigma M. Sigma SM into sigma S divided by sigma M. Clear? So for finding out beta, what do we require? Generally 2 years data will be given in examination, or more than 2 years. Generally more than 2 periods data will be given. So when the more than 2 periods data is given, then you have to apply second formula, that is covariance of S comma M divided by sigma M square. Sigma M square means variance of a market. So what should be the first step? Sigma M square. How do we get sigma M square? How do we get sigma M square? Summation sigma M minus M bar square divided by N. Yes or no? Nothing but what are the columns we should take? M bar, M minus M bar, M minus M bar whole square. Next, covariance of S comma M. S minus S bar, M minus M bar. S minus S bar into M minus M bar. But we cannot directly take S minus S bar. Why? Because we do not have a S bar. We have to find out, yes or no? Are you getting my point? So beta is equal to covariance of S comma M divided by what? Sigma M square. Covariance of S comma M divided by sigma M square. So what are the columns we should take, and what is the first step? First we should find out sigma M square only. Why? If we find out sigma M square, while finding out sigma M square, we would be finding out what? M bar. We would be finding out what? M bar. And we are also going to find out what? M minus M bar. That we can use in covariance of S comma M. Are you getting my point? So nothing but first step will be, these are the columns you should take, yes or no, when there is no probability. When there is no probability. When past data is given, formula is okay. What is beta formula? Covariance of S comma M divided by sigma M square. So what are the columns? M, M bar, M minus M bar, M minus M bar whole square. What is the second step? We require covariance of a S comma M. How can we find out covariance of S comma M? We cannot directly take S minus S bar. How do we get S minus S bar? Yes or no? So that's why for covariance of S comma M, what are the columns? We should start with S, S bar, S minus S bar, M minus M bar, ds into dm. Nothing but deviation of security into deviation of a market. Clear? Or else you can write S minus S bar into M minus M bar. అర్థమైందా? If I find out the covariance of SM first, then I have to take extra two columns, yes or no? What are the two extra columns? S, S bar, S minus S bar. M, M bar, M minus M bar. And then what? S minus S bar into M minus M bar. So that will be too lengthy. So that's why what? First we should find out what? Variance of a market. So what are the columns for variance of market, Shaheen? M, M bar, M minus M bar, M minus M bar square. So what are the columns for covariance of S comma M? S, S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. Clear? Because in question they may not give S. They may not give S. We should start from calculating what? S. How do we calculate S? P1 minus P0 plus D1 divided by P0. From there we should start. Okay, so you should remember the columns. You will get habituated to these columns once we do the questions. This is when past data is given. When past data is given. But when future data is given, when future data is given, then what? Will the columns remain same? No, the columns will not remain same. Varsha, what are the columns? Varsha, columns. Emma. Oh, okay. M, P, P into M, M bar. Very good. M minus M bar. Very good, Amma Varsha. P into M minus M bar whole square. So these are the columns. M, P, P into M, M bar, M minus M bar, P into M minus M bar whole square. So these are the columns when the future data is given. Clear? Antena kada? So instead of security X, we are taking what? Market. Instead of security X, we are taking what? Market. So what about the covariance of S comma M? So what are the columns for covariance of a S comma M. Can anybody please? Priyadarshini, Darshini, Abhimati, Chitti, Vandana, Manasa, Vaishnavi, Manju. All girls, no boys. Okay. MP, P into M, M bar, M minus M bar, P into M minus M bar square. Okay, so columns S, P, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. These are the columns. So these are the columns S, P, P into S. Why these columns? Because we require S bar. Yes or no? So covariance of S comma M means deviation of security into deviation of a market. That means we require S minus S bar and M minus M bar. So we can get M minus M bar from variance of market column. Variance of market table, yes or no? So that's why these are the columns. S, P, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. When past data is given, okay, fine. But when future data is given, so definitely students are going to do a clerical mistake. They may ignore probability in the last column and divide with n, or else they may take probability, but still they may divide with n. Okay. So despite of warning, in next 1 hour, you will be doing a mistake. Okay, in a probability question, you are going to do a mistake. If you are trying on your own, you are going to do a mistake probability, because subconscious, most of the times, the past data will be given. Okay. So out of 3 questions, 2 questions past and 1 question will be what? Probability. We get habituated to what? Past data. So that's why you might do a clerical mistake. Be careful, okay? బాయ్స్ ఏంటమ్మా బాయ్కాట్ చేశారా? ఎవరు రాలా క్లాస్కి? ఆన్లైన్ బాయ్స్, ఫైండ్ మీ హూ ఐ am. Clear? Okay. So what is this beta? Beta denotes responsiveness of a security with respect to what? Change in market. Clear? So how do we get portfolio beta? Portfolio beta is nothing but weighted average of a security beta. Okay. Portfolio beta. Portfolio. Thank you for your response. Find me who I am. Clear, sir. Done. How do we get portfolio beta? Weighted average of a security beta. Simple. Simply we do the weighted average of a security beta. So beta denotes what? Systematic risk. If you want the portfolio systematic risk, portfolio beta, how do we get portfolio beta? Weighted average of a security beta. But whereas we already told that total risk of a portfolio is not equal to the weighted average of a security risk, yes or no? We should consider correlation coefficient, something, yes or no? But here we are doing simply weighted average. Can we do like this? Yes. because systematic risk cannot be diversified. Beta denotes systematic risk and systematic risk cannot be diversified. So that's why we are straight away doing weighted average of a security beta. Am I clear? We are simply doing weighted average because what? Why? What is the reason? Because systematic risk cannot be diversified. Systematic risk cannot be diversified. So that's why we are doing what? Weighted average. In every question paper, you will find calculation of a portfolio beta. In every question paper. So that is simple. How do we get portfolio beta? By doing a weighted average of a security beta. In every question paper. 2 marks. In 7 marks question. Okay. So either in portfolio management or derivatives, one question, first part will be to find out what? Portfolio beta. How do you get portfolio beta? By doing weighted average of a security beta. Done? Okay. Done, Krishnavamsi? Am I clear? So now let us move on to the beta concept 8th question. But before moving on to 8th question, let us complete the 7th question. 7th question yesterday we discussed, yes or no? Out of 6 securities, we should select 3 securities. We are selecting A, C and E. Yes or no? You know the logic, yes or no? We are going to select a security which is giving a high return for low risk, or high return for same risk, or same return for low risk, or high return for high risk. So that's why A, C and E are selected. First part has got completed. But the second part, what is the second part? Assume a perfect correlation. Assume perfect correlation. Perfect correlation means +1. Assume perfect correlation means +1. Show whether it is preferable to invest 75% in A and 25% in C, or to invest 100% in E. What is the second option? Investing 100% in E. If you are investing 100% in E, what is the return? 9% is the return and risk is equal to 5%. If you are investing 100% in E. What is the first option? Invest 75% in A and 25% in C. So what is the return I am going to get? 75% in A means 75% into 8. 75% into 8. 6. Plus 25% into 12. 75% into 8 plus 25% is into 12. 6 plus what? 3. 9. That means you are getting a same return. If you are investing 100% in E, you will get 9%. If you are investing 75% in A and 25% in C, then also you are going to get 9%. Am I clear? Done. What about the risk? Risk, we need not use the lengthy formula. For calculation of risk, we need not use the lengthy formula. Why? Because the correlation is perfect correlation. The correlation is perfect correlation. Perfect correlation. So that's why we can directly what? We can directly do the weighted average of a security risk. Weighted average of a security risk. That means 75% into 4. 75% into 4, 3 plus 25% into 12, 75% into 4, 3 plus 25% into 12, 3, overall 6. So 9% return, 6% risk. Whereas E, 9% return, 5% risk. Same return for low risk. Security E is giving a same return for low risk. So that's why what? Okay, which is preferable? So investing 100% in security E is preferable. Clear? Seventh question, is it clear? Mohan. Manju, is it clear? Priyadarshini, find me, is it clear? Okay, fine. Come to the eighth question. Come to eighth question. Very good, Amakrishna Vamsi. ఎక్కేసావు మెట్టు క్యాప్ తీసి ఇచ్చావు చూసావు వాటరు సాయిరామ్కి సాయి కృష్ణనా వెరీ గుడ్ అమ్మ ఆనందంతో తాగలేకపోయాడు మనడు సో ఎయిత్ క్వశ్చన్ బీటా కోఎఫిషియంట్ so this question is not for practice but here we are going to do but on day before examination you need not do this question number 8. Given below is the information of market rates of returns and data from two companies A and B, year 2007, year 2008, year 2009. Total how many years data is given? 3 years data is given. So that means we cannot use the first formula, that is change in security return divided by change in market return. Change in market return. So we have to use the second formula. What is the second formula? Covariance of S comma M divided by sigma M square. ఎవరు కృష్ణ వంశీ గాలి ఎంతనా ఓకే క్లోజ్ చేయడానికి వెళ్ళాడు మనోడు బయటికి వెళ్ళాడా you are required to determine the beta coefficient of the shares of company A and company B. Bhargav, we should find out what beta coefficient for company A and company B. Company A and company B. What is the first step? Tell me. First step. Question number 8. Question number 8. So you must be able to guess the columns instead of practice. So beta covariance of S comma M divided by sigma M square. There are two securities A and B. That means what? What is the first step? Sigma M square. Sigma M square is common for both the securities. Next what? Covariance of A comma M And next covariance of B comma M. I should find out covariance of security A with market and covariance of security B with market. Yes or no? Yes or no? Okay. So A variance of a market. Sigma M square. A variance of a market sigma M square. A variance of a market what sigma M square. So what are the columns? The data given is past data or a future data? Past data. Very good, Amma. Varun, my parent, Amma. Mamshi, very good, Amma. What are the columns? M, M bar, M minus M bar, M minus M bar whole square. These are the columns, yes or no? Tell me the numbers. Market, 12, 11, 9. 12, 11, 9. 12, 11, 9. So what is the total? 32. M bar. 10.67. M minus M bar. 1.33. Next. 0.33. Can I take total of M minus M bar? No. That will be equal to what? 0. Here no probability. So that's why total will be equal to 0. Next. 1.7689. 0.1089. 2.78. 2.7889. So total 4.6667. So sigma M square is equal to 4.6667 divided by 3. Yes or no? So what is the answer? 1.11. 1.55. Varsha, what is the answer? 1.55. Yes or no? Vandana, Abhimati, Darshini. తగ్గిందా వర్షం చూడలేదా బయటికి చూసావుగా covariance of variance of market is equal to what? Variance of market is equal to what? 1.55. So to find out beta, what else we require? We have to find out beta for both company A and company B. So next what be? Covariance of A comma M. A is a security, yes or no? M means what? market. So what are the columns? A, because we cannot directly find out A minus A bar, yes or no? So A bar, A minus A bar, M minus M bar, A minus A bar into M minus M bar, or else dA into dm. So tell me the numbers. 13, 11.5, 9 point, 34 point, 11.43, 1.57, sorry, 1.57, 0.07, minus 1.63. M minus M bar is already calculated, yes or no, in the previous part. 1.33, 0.33, 1 point minus 1.67. So both security and market are moving in same direction. Yes or no? When deviation of A is positive, deviation of market is also positive. When the deviation of security is negative, deviation of market is also negative. Then you will get covariance positive and beta also positive. Tell me the numbers. Sai Krishna. A minus A bar into M minus M bar. 2.0881. 0.0231. 2.7221. 4.8333. 4.8333. Am I clear? So this is not the final answer, yes or no? Covariance of A comma M is equal to 4.8333 divided by 3. 1.6, 1.61 is enough, okay? Very good, Darshini, 1.61. Vaishnavi. Likewise, we should find out what? Very good, Amma. Krishnavamsi. Covariance of B comma M. I'm not going to calculate covariance of B comma M. You calculate covariance of B comma M. Covariance of B comma M. What are the columns? B, B bar, B minus B bar, M minus M bar, B minus B bar into M minus M bar. Tell me the final answer. Covariance of B comma M. Calculate as fast as possible. Covariance of a B comma M. 6 point, 0 point. Krishnavamshi answer 0.78. 0.761. Brand ambassador Shivani answer 0.771. Manasa 0.778. So Vaishnavi answer 0.776. 0.777. Okay, fine. Sai Krishna. What is your native place, Sai Krishna? Markapuram answer 0.778. Vaishnavi, you are from which place? Shivan, you are from? Orissa answer 0.778. Krishnavamshi? Marsa. Ekkada? Mylavaram. Mylavaram answer 0.778. So Vaishnavi, Chennai answer also 0.778. Clear? Varsha? Varsha from Chandramandalam 0.77. 0.77? 777. Okay, fine. So Darshini, everybody got the same answer. Chitti, the robo, same. Manasa, same answer. Vandana, same. Pedareddy, same. Now, same. Huh? Mohan, you also same. సో బీటా ఏ చేయలేదా? తలెత్తుకు చూస్తున్నారు పైకి. వాట్ అబౌట్ బీటా ఏ? చేయాలి కదా బీటా ఏ బీటా బి. చాలామంది కోవేరియన్స్ ఆఫ్ బీకేఎం స్టేజెస్ ఇంకంతే తలెత్తుకుని చూస్తున్నారు ప్రౌడ్ ఫీలింగ్తో. వాట్ ఈస్ ద యాక్చువల్ క్వశ్చన్? దే ఆర్ ఆస్కింగ్ యూ టు ఫైండ్ అవుట్ వాట్ బీటా ఏ అండ్ బీటా బి. వర్ష, వాట్ ఈస్ బీటా ఏ? Beta A is equal to 1.61 divided by okay Pavitra. Pavitra, whichever I am speaking in Telugu is not relevant. So beta A 1.61 divided by 1.557. So what is the answer? 1.038. So beta B 0.778 divided by 1.77. So Pavitra, what is the answer? 0.501. 0.4 double 0.501. Okay. Pavitra, what is your answer? So beta of a B is equal to 0.5. Pavitra, is this your first class? So beta calculation. So beta A 1.038, beta B 0.501. Which company is having a high risk? Which company is having high risk? Company A is having high risk. Company A is having what? High risk. So done. Okay, Pavitra, please do watch previous lectures. Next, see the ninth question. Ninth question. Everybody should write answer. I mean, note down the answer because you will find different columns in question bank. Question number 9. Beta of a coefficient with portfolio. I mean, not portfolio, with probability, that is beta coefficient with probability. The distribution of return of a security F and the market portfolio P is given below. Security F and market is given below. Probability is 0.3, 0.4, 0.3. Security return 30, 20, 0. Market return minus 10, 20 and 30. You are required to calculate the expected return of security F. You are required to calculate the expected return of a security F. That means F bar. And the market portfolio P. You are required to calculate the expected return of the market portfolio P. And then what? Covariance between the market portfolio and security and beta for the security. Nothing but if you have to find out the beta, you have to find out what? Variance of market, covariance of security and market. So while finding out variance of market, obviously you will find what? M bar. Nothing but expected return of a market portfolio P. Yes or no? While finding out covariance of S comma M, obviously you will you will be finding out S bar. That is expected return of a security F. So question number 9, try on your own. Complete this question within 13.65 minutes. Now the time is 12.27. 12.27, 12:27. It is the time. Try on your own. Everybody trying or not? Everybody, Priyadarshini, Manju, Darshini. You have to try on your own. Find the answer. So what is the answer? Beta is equal to minus 0.636. 3 minutes అలా చేశారు. 3 minutes అయిందా? ముందే చేశారా లేకపోతే ఇప్పుడు చేశారా? వావ్. వేరియన్స్ ఆఫ్ మార్కెట్ సిగ్మా ఎం స్క్వేర్. $264. Wise to me, very good. Minus 0.636. So variance of market, what are the columns? M, P, P into M, M bar, M minus M bar, P into M minus M bar whole square. M minus 10, 20, 30, 0.3, 0.4, 0.3, minus 3, 8, 9, total 14. M minus M bar, minus 24, 6, 16. P into M minus M bar square, 170, 2.8, 14.4, 76.8, total 264. Clear? Next B. B what? Covariance of security and market. Covariance of security and market. What are the columns? S, S, P, P into S, S bar, S minus S bar, M minus M bar, P into DS into DM. Yes or no? Okay. Tell me S. 30, 20, 0. 0.2, 0.3, 0.4, 0.3. P into S. 9, 8, 0. 17. Next. 13, 3, minus 17. Minus 24, 6, 16. Minus 93.6, 7.2, minus 81.6, minus 168, minus 168. So beta. So before writing beta, so first expected return of security S bar is equal to, what is the answer? 17. 17. Next what? Expected return of a market. M bar 14. Next what? They asked you to find out covariance of. So covariance of S comma M. Answer minus 168. Okay, next what? Beta. Beta of a security is equal to minus 168 divided by 264. So the answer is minus 0.636. Clear? So minus 0.636 is the answer. Beta of a security. Done. Induma. Clear? Beta of a security is equal to minus 0.636. Done చేశారు అందరూ? ఎవరైనా డివైడ్ బై n చేశారా? Anybody divide by n? Anybody ignored probability? Okay, fine. Next question. For today, 10th is the last question, okay? See the 10th question. So this question is for practice on day before examination. This question is for practice. Question number 10. So the following information are available with respect of Krishna Limited. With respect of a Krishna Limited, the following information are available. Here, Krishna Limited average share price, dividend per share, average market index, dividend yield, return on government bonds. Return on a government bonds. Return on a government bonds means RF. Risk-free return. Risk-free return. Compute beta value of a Krishna Limited. Compute beta value of a Krishna Limited at the end of 2015. And state your observation. So this question is for practice on day before examination because state your observation. State your observation. Okay. State your observation and you cannot write your own observation. What they are expecting that you have to write. Okay. So that's why first beta, calculation of beta is also little complicated. And what in addition to that, they're asking you to state your observation. So what is that observation? Okay. So this is CA final pass examination question. Recently, this question was not asked in CMA final, but they may ask. Question number 10. So beta. So what is the beta formula? Covariance of S comma M divided by sigma M square. So what is the first part? Sigma M square. Sigma M square means M bar, M minus M bar, M minus M bar whole square. So this question is not with probability. No probability is given in the question. Yes or no? So whether M is given in the question or not. Whether M is given in the question or not. So M is not given in the question. M is not given in the question. 2013, 2130, these are not years. Average market index. Okay. So here M is not given. We have to find out M using the formula P1 minus P0 plus D1 divided by P0. So here in this question, M is the special point, M and S. M and S. In previous two questions, M is given, S is also given. But in this question, M is not given and also S is also not given. So that's why first question, first part. What is the first part? First step. Question number 10. This question is for practice. So today you do the cumulative practice. Cumulative practice in the sense 5, at least cumulative reference and do practice today's question. So question number 5, refer. Question number 6, practice. Question number 10, practice. What about additional question number 12, refer? Okay, if you have done yesterday. If you have not done yesterday, practice today. So question number 10. What is the first part? Variance of a market, sigma m square. Variance of market, sigma m square. Variance of a market, sigma m square. Okay. Variance of market, sigma m square. So no probability is given, yes or no? So what are the columns? M, M bar, M minus M bar, M. For M you need more space. So how do we get M? P1 minus P naught plus D1 divided by P naught. I cannot find out for the year 2012. Why? Previous year is not there. P naught is not there. Yes or no? I can find out for 12 13. 12 13. So 12 13. For 12 13. What is the P1? 2130 is the P1. We are calculating the variance of a market. So variance of a market. So that's why I told. Okay, this question for practice. 2130. What is this 2130? P1, price at the end of the year 1. Price at the end of a year 1. What is the price at the beginning? 2013 plus 2130 minus 2013 plus dividend. Here dividend amount is not given. Dividend yield percentage is given. Dividend yield percentage is given. Nothing but what? Straight away. So generally we use the formula P1 minus P naught plus T1 divided by P naught. Here the calculation should be what? 2130 minus 2013 plus, you cannot take 4. That is not a dividend amount percentage. So nothing but dividend yield is nothing but what is the formula for dividend yield? D1 by P naught. D1 by P naught. So D1 by P naught. So that's why you should take 2130 minus 2013 divided by 2013. Nothing but you have taken P1 minus P naught divided by P naught. What else you have to take? You should take D1 divided by P naught. That is already given in the question. Straight away D1 by P naught is given. So that's why add 4%. Are you getting my point? Be careful in this question. Dividend amount is not given. Dividend yield is given. Dividend yield means how do we get dividend yield? How do we get dividend yield? Dividend yield is equal to D1 divided by P naught. Yield means return. Yield means what? Return. Dividend yield means dividend return. So what is your investment? Your investment is P naught. Dividend yield means D1 by P naught. So that's why be careful. Varun, are you getting this point? 5%. I'm sorry. 5%. Thank you, Varun. 5%. Not 4%. 5%. We should take D1. We should take D1. So dividend yield at the end of the year 1. Dividend yield at the end of the year 1. So that's why this question is for practice. Even I have taken 4%. Yes or no? We should not take 4. We should take 5. First in the point. Here dividend amount is not given. Dividend percentage is given. Vaishnavi Ganeshan. Chitti, everybody, are you able to understand this point? So what is the calculation? 2130 minus 2013 divided by 2013 plus 4%. Sorry, 5%. 2130 minus 2013 divided by 2013 plus 5%. So what is the answer? 2130 minus 2013 divided by 2013. You will get one number. Convert that number into a percentage and then add 5. You might be adding directly. 2130 minus 2013 divided by 2013. You will get one number. Convert that number into a percentage. Then add to 5. You cannot add number and percentage. 10 point. So this is the special part of this question. 10.81%. Next. What is the next calculation? 2, 2350 minus 2130 divided by 2130 plus 6%. You may get confused. Be careful. 2130 minus 2013 divided by 2013. You will get one number. That number has to be converted into percentage. And then add 5. 16.33. Krishnamamji, అర్థమైందా? I think you are not getting 10.81, right? Why you are not getting 10.81? First of all, this part 2130 minus 2013 divided by 2013, you will get one number. I think you will get 0.0581. That has to be converted into percentage. Then you will get 5.81 plus 5. Oh, percentage type చేసావమ్మా plus 5. Next what? Next calculation. 2580 minus 2350 divided by 2350 plus 7%. 16.79. Total 10.81 plus 16.33 plus 16.79. 43.93. 43.93. M bar 14.62. 6. 14.64. Next, M minus M bar minus 3.83. Next, 1.69. Next, 2.15. So M minus M bar square 14.6689, 2.8561, 4.6225. 20, 22 point, 22.115. Hmm. Is this the final answer? No. Sigma m square is equal to 22.15 divided by 3. 7.383 percentage. 7.3825 or 383 is the answer. What is this? This is variance of a market. This is variance of a market. Next step, what we should find out? Covariance of a security and market. Yes or no? What is the next step? Covariance of security and market. Covariance of security and market. What are the columns? S, for S we need more space. S bar, S minus S bar, M minus S bar, M minus M bar, S minus S bar into so tell me the S calculation. Tell me S calculation. 250 plus what? 22. 22 is the D1. This time dividend amount is given. This time dividend amount is given. Be careful. Not the dividend percentage, dividend yield. 253 plus 245 plus 22 divided by 245. 12.24. Next, 310 minus 253 plus 25 divided by. So the answer 32.41. Next, 330 minus 310 plus 30 divided by 16.13 total 60.7 60.78 S bar 20.26 S minus S bar minus 8.02 12.15 minus 4.13 M minus M bar minus 3.83 1.69 2.14 2.147 actual number. Okay. Next, S minus S bar into M minus M bar. 30.72, 20.509. Next, minus 8.87. Okay. Total. Total. Sai Krishna, what is the total? 42 point. Values this. 42.38. Okay. So covariance of S comma M is equal to 42.38 percentage. Now we can find out beta or not. So no, I think divided by what? Divided by 3. 14.126 percentage. So beta of a security is equal to 14.126 divided by 7.38. 1.91 913. Okay, okay. 1.913 or 914? 1.914. Okay. 1.914 or 3. So 1.914 or 3 is what? Beta. Covariance of S comma M divided by sigma M square. So in this question, what is the special point? Calculation of M and S, especially M. Instead of dividend amount, dividend yield is given. Nothing but that is already D1 by P naught. That is not D1, that is D1 by P naught. Krishnamamsi chesara. See the M calculation and S calculation. So in this question, what is the special point? M calculation and S calculation. This question is for practice. So we have a calculated beta, but one more point is this: state your observation. Okay, so today you observe the point. Tomorrow we shall discuss. Okay, tomorrow let us state our observation. Okay, so beta calculation. So total risk is equal to systematic risk plus unsystematic risk. Unsystematic risk can be diversified. Systematic risk cannot be diversified. So beta denotes a systematic risk. It denotes the responsiveness of a security return with respect to change in market return. Here beta 1.914. What does it mean? For every 1% change in market, security, that is Krishna Limited shares, changes by 1.914 percentage. Okay, am I clear? So systematic risk is a country specific, unsystematic risk is a company specific. Beta can be positive, negative or zero. So beta can be positive, negative or zero. Beta can be positive, negative or zero. And beta denotes sensitivity of a security return with respect to change in what? Market return. So why are we calculating this beta? This beta can be used for finding out required return. There is a link between SFM and business valuation. Generally first SFM and then business valuation. Because beta, okay, beta will impact what? KE. KE is equal to RF plus RM minus RF into beta. If a KE gets affected due to beta, then obviously value of equity share will also get affected. Value of equity share is equal to D1 by KE minus G. D1 divided by KE minus G. Yes or no? Okay. So beta. So why we are finding out beta? So to know whether the share is underpriced or overpriced, security is underpriced or overpriced. In next class, we are going to discuss underpricing or overpricing. Okay, clear? Thank you. So in last class, we have discussed up to what? So beta coefficient, yes or no? In last class, we have discussed up to beta coefficient. So three fundamental essential elements of a business: financial resources, right management team, clear and realistic strategy. Clear and realistic strategy. Okay. Four types of a decision in SFM: investing decision, financing decision, dividend decision, portfolio decision. Portfolio decision. So objective of SFM is to maximize the wealth. Wealth depends on two factors: the benefit we get and risk. So risk means a possibility of occurrence of loss, possibility of deviation from the mean average, possibility of deviation from the expectation, possibility of deviation from the expectation. And next, uncertainty. Okay, if risk increases, required rate of return increases, and if required rate of return increases, wealth decreases. If risk increase, if risk increases, required rate of return increase increases, and wealth decreases. Okay. So portfolio management. So the portfolio management objective is also to maximize the wealth of a investor. Wealth of a investor. Portfolio means a combination of a securities such as shares, bonds, and money market instruments. Money market instruments. So before making investment, any investor will consider two factors, that is return and risk. Return and risk. Okay. So equity shareholder will get return in the form of capital appreciation and dividend. Capital appreciation and dividend. Debenture holder will get return in the form of interest and capital appreciation. Interest and capital appreciation. Okay. And next what? There are three major activities in portfolio management. First one, selection of a securities based on return and risk. Based on return and risk. Next, construction of a feasible portfolios. Next, deciding the weights in which proportions the investment has to be made. So these are the five major activities. And the object of a portfolio management is safety of a principal, stability of a income, growth, marketability, liquidity. Okay, and diversification. Main objective is diversification of a risk. Yes or no? So phases of a portfolio management. What are the phases of a portfolio management? Security. Okay. So security analysis, portfolio selection, portfolio revision, portfolio evaluation. Okay. Mohit Singh, if you are preparing for both groups, better you attend only A category topics. Okay, it is enough. Next. So first part of the portfolio management, we have discussed how to find out the return and risk of a security and return and risk of a portfolio. Return and risk of a portfolio. So okay, next, how do we get return? So first we learned how to find out X return is equal to P1 minus P naught plus T1 divided by P naught. Okay. Next, risk of a security instead of formula, you have to, Okay, remember the columns, that too with the logic, and risk means a possibility of deviation from the mean. That's why we are taking x minus x bar. So past data, if a past data is given, what are the columns? X, x bar, x minus x bar, x minus x bar whole square. Future data, x, p into x, x bar, x minus x bar, p into x minus x bar whole square. And next, so risk can be measured using variance, standard deviation, and coefficient of a variance. Standard deviation is equal to square root of a variance. Coefficient of a variance is equal to standard deviation divided by x bar. Standard deviation divided by x bar. Next, portfolio return. Portfolio return is nothing but weighted average of a security return. Weighted average of a security return. So that is wx x bar plus wy y bar. Okay. What about the portfolio risk? Portfolio risk sigma p is equal to square root of wx square sigma x square plus wy square sigma y square plus 2 wx wy sigma x sigma y sigma xy. So it is similar to a square plus b square plus 2ab. Okay, so why we are using this lengthy formula? Because of sigma xy. We cannot simply do the weighted average of a security risk. We have to consider the correlation coefficient, closeness of our securities. So instead of sigma x, sigma y, sigma xy, we can use what? Covariance of a xy. Okay. Steps. If you have to find out the portfolio risk, what are the steps? First, we should find out x, x bar, y bar. And next, what? Sigma x, sigma y. Sigma x, sigma y. And then covariance of a xy. So covariance of x comma y. So the columns, if a past data is given, what are the columns? X minus x bar, y minus y bar, x minus x bar into y minus y bar. If the future data is given, then x minus x bar, y minus y bar, p into x minus x bar into y minus y bar. Next is sigma xy. Calculation of a sigma xy is not mandatory, but if you find out sigma xy, then you will get to know whether to use the small simple formula or lengthy formula. Yes or no? How to find out sigma xy? That is very simple. Covariance of x comma y divided by sigma x sigma y. So if sigma xy, there can be 5 scenarios. Sigma xy ranges from -1 to +1. Covariance of x comma y ranges from minus infinity to plus infinity. Minus infinity to plus infinity. Covariance of x comma y. So sigma xy ranges from -1 to +1. So now sigma xy, if it is -1, then sigma p is equal to wx sigma x minus wy sigma y. Sometimes you will get negative sigma p, but you have to ignore the negative sign because the risk cannot be negative. Risk cannot be negative. If you are not doing anything, risk is 0. Risk can be either positive or 0. Risk cannot be negative. Okay. So sigma p, if sigma xy is equal to -1, then sigma p is equal to wx sigma x minus wy sigma y. Next, what is the next one? Sigma xy can be what? +1. If sigma xy is equal to +1, then sigma p is equal to wx sigma x plus wy sigma y. So when sigma xy is equal to -1, risk can be reduced to 0. Further weight of x must be equal to sigma y divided by sigma x plus sigma y. Am I clear? Next, sigma xy is equal to 0. Sigma xy is equal to 0. Then square root of sigma p is equal to square root of wx square sigma x square plus wy square sigma y square. Okay, and if sigma xy is ranging from -1 to 0 or 0 to 1, then we have to use the lengthy formula, that is square root of wx square sigma x square plus wy square sigma y square plus 2wx wy sigma x sigma y sigma xy. Okay. Next what? So if there are three securities, then the formula will be similar to what? A square. So A plus B plus C whole square. If there are three securities, yes or no? Am I clear? Next. So when correlation coefficient is other than -1, risk can be reduced, minimized. Cannot be reduced up to 0, but risk can be minimized. For that, weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. 2 covariance of x comma y. Am I clear? Okay, done. So next we started with beta, yes or no? So how we started? Okay, discussing beta. Total risk is equal to systematic risk plus unsystematic risk. Unsystematic risk can be diversified. Systematic risk cannot be diversified. Unsystematic risk is a company specific. It can be diversified by making a portfolio investment. Unsystematic risk can be diversified by making a portfolio investment. Unsystematic risk can be diversified by making a portfolio investment. If you are investing in two or more shares, then automatically unsystematic risk will get diversified. So what about the systematic risk? Systematic risk cannot be diversified. Systematic risk cannot be diversified because it is country specific. So beta denotes a systematic risk. Okay. It denotes responsiveness of a security return with respect to change in market return. With respect to change in market return. So beta is a sensitivity of a security return. Sensitivity. Beta is a sensitivity of a security return. Sensitivity can be positive, negative, or 0. 0 means what? Insensitive. 0 means what? Insensitive. Okay. RGV, sensitive or insensitive? Insensitive. Okay. Okay. He pretend to be like insensitive. Maybe he is sensitive, yes or no? So insensitive. So if security beta is equal to 0, what does it mean? No relation between market and security. Market and security, yes or no? Okay. So right now war is going on between Russia and Ukraine, yes or no? So are we people sensitive or not? No. Yes or we are not sensitive actually. Because maybe due to distance or what, we don't know. We are what? Insensitive. We are not bothered about what? Russia, Ukraine war. I mean, the point is, okay, maybe few people may be sensitive, but most of the people are sensitive or insensitive? Insensitive. Okay. So beta can be what? Positive, negative, or 0. So sensitivity. Positive means what? Same direction. Negative means what? Opposite direction. 0 means what? No relation. 0 means what? No relation. So how do we find out beta? So and simple. When 2 periods data or 2 years data is given, change in security return divided by change in market return. Change in market return. Yes or no? So when more than 2 periods data or 2 years data is given, then covariance of S comma M divided by sigma M square. Covariance of S comma M divided by sigma M square. Yes or no? And next what? Sigma Sm into sigma S divided by sigma M. Sigma Sm into sigma S divided by sigma M. Beta calculation. Beta calculation. Okay. High beta indicates high risk. High beta indicates high risk. Low beta indicates low risk. Okay. Am I clear? Done. So why this beta is being calculated? Simple. High beta indicates high risk. Yes or no? If risk increases, required return increases. So CAPM, capital asset pricing model, KE will increase. If KE increases, what happens to the price of a share? Price of a share decreases. Ultimately, the objective is to maximize the wealth of a shareholder. The market price has to increase. Yes or no? So that's why we are calculating the beta. Okay, fine. Next, so underpricing and overpricing. Underpricing or overpricing. So return X. So let us write down the continuation sigma P. So what are the steps? X x bar, y bar, sigma x sigma y, covariance of x comma y. And then what? Sigma xy, sigma P. Okay. Next. So this we already discussed, but again I am writing sigma xy, sigma xy. So there can be how many scenarios? 5 scenarios. First scenario, sigma xy is equal to -1. What does it denote? Security x and y are moving in same direction and what? Sorry, opposite direction, same proportion. Opposite direction, sigma xy is equal to -1. What does it indicate? Opposite direction, same proportion. Opposite direction, same proportion. Okay. So then sigma p is equal to what? Wx sigma x minus what? Wy sigma y. You may get negative. You may get sigma p negative, but you have to ignore the negative sign. Next what? Risk can be reduced to 0. Risk can be reduced to 0. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. So sigma xy, if it is equal to -1, that indicates opposite direction, same proportion. Then sigma p is equal to wx sigma x minus wy sigma y. Risk can be reduced to 0. Further, weight of x must be equal to sigma y divided by sigma x plus sigma y. Clear? What can be the second scenario? Sigma xy is equal to +1. So this is called as perfect correlation. Perfect correlation. Sigma xy +1. What does that mean? Same. Same direction. Same proportion. Same direction, same proportion. Same direction and what? Same proportion. So then sigma p is equal to sigma p is equal to wx sigma x plus wy sigma y. Risk what? Cannot be diversified. Risk cannot be diversified. Why risk cannot be diversified? Because both the securities are moving in same direction and in same proportion. Either we get profit in both the securities or we lose money in both the securities. So risk cannot be diversified. So what can be the third scenario? Third scenario, sigma xy is equal to 0. If sigma xy is equal to 0, no relation. Sigma xy is equal to 0 means what? No relation. No relation. So then sigma p is equal to. Then sigma p is equal to what? Square root of wx square sigma x square plus wy square sigma y square. Sigma p is equal to square root of wx square sigma x square plus wy square sigma y square. So this is the risk of a portfolio sigma p. Yes or no? Am I clear? So this is the third case. Okay. Next, fourth scenario. Sigma xy ranges from what? -1 to 0. So what does it mean? Opposite direction, but not in same proportion. Opposite direction, but not in same proportion. So here we have to use what? Lengthy formula. Yes or no? Next, what is the fifth scenario? Sigma xy ranges from 0 to 1. So what is this? Same direction, but not in same but not in same proportion. Sigma xy is equal to 0 to 1. Same direction, but not in what? Same proportion. Okay. So here 3, 4 and 5. In this case, risk can be what? Minimized. Yes or no? For that, weight of x must be equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So weight of x is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. So there are 5 scenarios. Yes or no? Clear? So after completion of this topic, so we started with what? Systematic risk and unsystematic risk. Systematic risk and what? Unsystematic risk. Nothing but beta. We started what? Concept beta. So beta. So in beta we have 3 formulas. Yes or no? So beta we have a three formulas when only 2 periods data is given. So then what is the formula? Change in security return. Change in security return. Change in security return divided by change in what? Market return. Understand the beta. Beta is responsiveness of a security return with respect to change in market return. Beta can be positive, negative, or zero. High beta indicates high sensitivity, high risk. So what is the second formula? Beta is equal to covariance of S comma m divided by sigma m square. SFM we need not prepare MCQs separately. If you know the concept, you can solve MCQs as well. So beta is equal to covariance of S comma m divided by sigma m square. Next, what is the third formula? Third formula, beta is equal to sigma sm into sigma s divided by sigma m. So okay, so most of the cases we use what? The second formula, beta is equal to covariance of S comma m divided by sigma m square. So but steps. So what is the first step? First step, we should start with what? Sigma m square. Sigma m square, yes or no? First we should start with sigma m square. In this, there can be two scenarios. Past data. If it is past data, so what are the columns? M, M bar, M minus M bar, M minus M bar square. So what can be the second scenario? Future data. Okay. Taking columns is very important. So generally students will note down the columns from the book and thereafter they start calculating. So that is calculator practice. Okay. First you should guess the columns. What should be the steps? Okay. So future data columns. What are the columns? M, P, M, P, P into M, M bar, M minus M bar, P into M minus M bar whole square. Sigma M square, yes or no? So after finding out sigma M square, then what? Covariance of a S comma M. Second step, covariance of a S comma M. And again covariance of S comma M also. There can be two scenarios. What are the scenarios? Past data. If it is past data, what are the columns? S, past data. S, S bar, S minus S bar, M minus M bar, S minus S bar into M minus M bar. So these are the columns. Yes or no? Okay. Next, what is this next scenario? Future data. If it is future data, what are the columns? S, P, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. Yes or no? Okay, S, P into S, S bar, S minus S bar, M minus M bar, P into S minus S bar into M minus M bar. So be careful when there is a probability in the question. Probability. Okay. Last column, you might take the total and then divide with what? N. Or else you might ignore the probability. You might ignore the probability. Okay. Next. So next concept. Under or overpricing. Next concept, under or overpricing. Under or overpricing. Under or overpricing. So what is this under or overpricing? Under or overpricing. Okay. As an investor, we have to take a decision when to buy the security, when to sell the security, when to hold. When to hold. Okay. As a fund manager, for suppose if you are a fund manager, you are making an investment on behalf of the investors. You have to decide whether to hold the security or whether to buy the security or whether to sell the security. Under or over pricing. Okay. You know the CAPM return, yes or no? So what is the CAPM return formula? CAPM return is equal to RF plus RM minus RF into beta. Capital asset pricing model. CAPM return. Okay. So this is also called as required return. For the risk investor takes, he require RF plus RM minus RF into beta. What is the logic behind this? RF means a risk-free rate of a return without taking any risk. Without, for suppose there is no risk. What is the investor is going to expect? RF. Risk-free return. Risk-free return. The name itself indicates risk-free return. Without any risk. When there is no risk, investor is going to expect what? Risk-free return. So for example, beta is equal to 0. What does it mean? No risk, yes or no? Whether market is going to increase or decrease. If a beta is equal to 0. If beta is equal to 0, what does it mean? No relation between the security and market. That means whether market is going to increase or decrease. Our security return is going to remain same. Our security return is going to remain same. Yes or no? So that means what? That means no risk, no uncertainty, no uncertainty. Certainly we are going to get what? The return. Government bonds. Example, government bonds, 8% government bond. What does it mean 8% government bond? Irrespective of a market, we are going to get 8%. Whether the markets are going to perform well or not, still we are going to get what? 8%. The relation between the risk-free security and the market is 0. No relation. There is no relation. So sensitivity of a risk-free security is equal to 0. Sensitivity of a risk-free security is equal to 0. For suppose if beta is equal to 0. If beta is equal to 0. So generally beta of a risk-free security will be 0. Beta of a risk-free security will be 0. Then what is the CAPM return? CAPM return is equal to what? RF. Yes or no? Because RM minus RF into beta. 0. Nothing but if you are making an investment in risk-free security, then what is your required rate of return? Your required rate of return is risk-free return. So that is 7% or 8% that you will be expecting. Generally, the risk-free return will be ranging from 6% to 8%. So you will be expecting what? 6% or 8%. If beta is equal to what? 0. If beta is equal to 0. But generally equity shares beta will not be equal to 0, because equity shares of any company will be influenced by the market. Generally beta of companies will be positive. If markets are doing well, our company will also perform well. Okay, so beta of ITC will not be equal to 0. Beta of ITC will not be equal to 0. Beta of ITC will be what? Somewhere around 0.9 or 8 or 1, 2 or something. Because beta ITC company shares will be affected by the market. Generally, company shares are affected positively by the market. Okay. So, what about the beta of a market? Beta of a market is equal to what? 1. Beta of a market is equal to 1. Why beta of a market is equal to 1? Because if market changes by 1, market will be changing by 1. Sensitivity of a U with U is 1. So sensitivity of a market with market is what? 1. So beta of a market is equal to 1. If a beta is equal to 1, then what about CAPM return? What about CAPM return? CAPM return is equal to what? RM. CAPM return is equal to RM. RF plus RM minus RF into beta. Am I clear? Yes, Sham. Volatility is nothing but risk. Okay. Volatile. So equity share is a volatile. It is sensitive to the market. So CAPM return is equal to what? RM. If you are investing in market, In yesterday's class, I have told market means, whenever I say market means what? Index, Nifty or Sensex. So if you are investing in market, what do you expect? You expect what? Market return. You expect a market return. Clear? Next, if you are expecting in a company, if you are investing in a company which is having a beta 2, if you are investing in a company which is having a beta 2, then what is your expectation? Your expectation will be RF plus. Obviously, you will expect risk-free return, because when there is no risk itself, you are expecting what? RF. Yes or no? Without any risk, you will expect RF. Here you are taking risk because beta of a company is equal to 2. So that's why your expectation will be RF plus RM minus RF. It is called as market risk premium. Market risk premium. If you are expecting, for example, in second case, when beta is equal to 1, what is your requirement? RM. Nothing but RF plus RM minus RF. If you are investing in market, what is your expectation? RF plus RM minus RF. RF risk-free return, you will expect risk-free return plus you will expect a market risk premium. As you are investing in market, you are expecting a premium. What is the premium? RM minus RF. RM minus RF. So here RF and RF getting cancelled and your requirement is what? Nothing but RM. So here if you are investing in a company which is having a beta of a 2, then what is your expectation? RF plus RM minus RF into 2. You will expect 2 times of a market risk premium. You expect 2 times of a market risk premium. Beta 2 times. Beta is a ratio. Beta is a ratio. Beta 2 means what? Security changes by 2. Changes 2%. If market changes by 1%. If market changes by 1%, your security is going to change by 2%. So security is having a 2 times of a market risk. 2 times of a market risk. So that's why the required return for a company which is having a beta 2 is what? RF plus RM minus RF into 2. Okay, nothing but if risk increases, required return will also increase. So first, risk-free security. Is there any risk in risk-free security? If you are making investment in risk-free security, is there any risk? No risk. What is your expectation? RF. What is your requirement? Your requirement is what? RF. But instead of investing in risk-free security, you are investing in market. That means you are taking risk. Instead of investing in risk-free security, if you are investing in market, that means what? You are taking risk. You may get profit or a loss. There is an uncertainty in the market. Yes or no, Nifty points may increase or decrease. So if you are investing in market, then what is your expectation? RF plus market risk premium. What is market risk premium? RM minus RF. Excess. You expect some excess. RM minus RF. So ultimately your expectation if you are investing in market is what? RM. Your requirement. Okay. But if you are investing in equity, if you are investing in a company which is having a beta 2, if you are investing in a company which is having a beta 2, then what is your expectation? Obviously your expectation will be more than RF and market also. Why your expectation is more than market? Why your requirement is more than market? Because beta of a company is 2. So that means what? Company is more volatile than the market. Company is more volatile than the market. If a market changes by 1%, your security is going to change by 2%. So that's why what is your expectation? RF plus RM minus RF into 2. Clear? For suppose if beta is equal to what? 3. Then what is the expectation? RF plus RM minus RF into 3. As volatility increases, sensitivity increases, then what happens to the required return? Required return will also increase. So the simple basic point is if risk increases, required return increases. If risk increases, required return increases. So CMA student will expect more than what the degree student expects. Simple reason, because risk is high in CMA course, so that's why the required return is also increasing. Whether we get actual return more than the degree student or not is different. What is our requirement? Our requirement is what? More than the degree student. Okay. So this CAPM rate is nothing but what? Required return. Required return. Okay. Now buy, hold or sell. Nothing but this comes under or overpricing. Under or overpricing. So now I compare the CAPM return, that is required return. It is also called as theoretical return. Theoretical return. Theoretical return. So first scenario, actual return, actual return or expected return. Nothing but most of the case what X bar, actual return or a expected return. What the security is expected to give. What the security expected to give, that is X bar. For suppose if actual return, if actual return or expected return, that is X bar, is greater than required return, greater than what? Required return or CA PM return. If required, if actual return or expected return is greater than what? Required return or CA PM return. It means security underpriced. Security underpriced. So buy. Security is underpriced, hence what? Buy. Security is underpriced, hence buy. So understand the logic. So why we are buying the security? If actual return or expected return is greater than required return or CAPM return, so buy the security. Buy the security. Okay. Yes or no? For example, Mohan requirement. So his wife must be a cost and management accountant. Cost and management account. That is his requirement. That is his requirement. But the fact is, he is also a chartered accountant. Is he going to marry or not? Is he going to marry or not? He is going to marry. Yes or no? Nothing but what? We cannot say buy. Nothing but what? He is going to marry. Nothing but if you are good, if you are going to get more than your requirement, more than what? Requirement. Are you going to buy the stock or not? Yes. For example, CAPM return is equal to 15%. CAPM return is equal to 15%. What does it mean? For the risk you are taking, you should get only 15. But the security is giving 20%. The security is expected to give 20%. So will you buy the stock or not? Yes, I will buy the stock because it is underpriced. It is underpriced. So for the risk I am taking, I should get only 15%, but the stock is giving what? 20%. So the stock is underpriced and I'm going to buy the stock. Okay. And next, the second scenario, reverse. What is the second scenario? Second scenario, actual return or expected return. Actual return or expected return less than actual return or expected return less than Actual return or expected return less than what? Required return or CAPM return. Okay. So then what security? Underpriced or overpriced? Security is overpriced. Security is overpriced. So second case, actual return less than actual return or expected return less than what? Required return or CAPM return. So that means what? Overpriced. So when it is overpriced, sell. If I have already the security, I'm going to sell it. So for example, my CAPM return 15%. For the risk I take, I should get 15%, but actually the security is giving only 10%. So it is better to sell the security. It is better to sell the security. Yes or no? What is my requirement? 15, but the security is expected to give only 10%. If I am already holding the security, what should I do? I should sell the security because security is not meeting my requirement. Okay, clear? Next, third. What is the third scenario? Equal to. Third scenario equal to. Third scenario equal to. Equal to means correctly valued, nothing but correctly priced. Equal to means correctly priced. If it is correctly priced, hold for some time. Hold for some time. If it is correctly priced, my requirement is 50%, so 15%, and security is also giving 15%. My requirement is 15%, and the security is also giving 15%. My security, I mean, my requirement is 15%, security is also giving 15%. So security is correctly priced. So that's why what? Hold. You're not going to get any benefit. You're not getting any loss also. So hold it. Your requirement 15, security is also giving 15. If you have already the security, then hold. Okay. Clear? So this is a simple concept. If you're getting confused, then better calculate Jensen's alpha. What is this? Jensen's alpha. Jensen's alpha. Jensen's alpha. How do we get Jensen's alpha? Actual return minus CAPM return. Actual return minus what? CAPM return. Jensen's alpha. Actual return minus CAPM return. Okay. So if Jensen's alpha is positive, If Jensen's alpha is positive, buy. If Jensen's alpha is negative, sell. If Jensen's alpha is 0, hold. Clear? So when you will get positive, if actual return is greater than CAPM return, then obviously you will get what? Positive. Buy. If Jensen's alpha is negative, that is actual return is less than your requirement, sell. If it is 0, hold. Clear? So if they ask you to find out underpricing or overpricing, whether to buy or hold or sell, then you better calculate Jensen's alpha, because valuers are simply following the suggested answer. So one student, he has written a decision buy, hold or sell by comparing actual return and CAPM return, but no mark is given. No marks were given, even though he is conceptually correct, because they were expecting you to find out what Jensen's alpha. How do we get Jensen's alpha? Actual return minus CAPM return. So okay, if Jensen's alpha is positive, buy. If it is negative, sell. If it is 0, hold. Nothing but you can write the decision by comparing actual return and required return, CAPM return also. Conceptually correct. But they are giving marks as per what suggested answer. So that means they are expecting you to find out what Jensen's alpha. Clear? So underpricing, overpricing. Whenever you feel the asset is underpriced, you buy. If you feel it is overpriced, what? You sell. Okay. Next comparison, same continuation. Actual market price greater than CAPM market price. Actual market price is greater than what? CAPM market price. Actual market price is greater than CAPM market price. Actual market price is greater than what? CAPM market price. What is this actual market price and CAPM market price? CAPM market price means using CAPM KE, we can find out what? The theoretical market price. How do we get theoretical market price? D1 divided by KE minus G. D1 divided by KE minus G. So time value of a money. So we have to discuss. Okay. So D1 divided by KE minus G. What is that formula? Nothing but we are bringing the future benefit to the present value. Do you know the formula? D1 divided by KE minus G. Okay. So if actual market price is greater than what? CAPM market price. Nothing but market price calculated using CAPM return. Market price calculated using CAPM return. So then it is said to be security overpriced. Security what? Overpriced and what? Sell. So be careful. So the above one is comparing the return. We are comparing what? Return. This time we are comparing what? Market price. What is the CAPM market price? It is also called as theoretical price. It is also called as equilibrium price. Equilibrium price or a theoretical price. So we have learned one theory in the class. What is that theory? CAPM. Using that theory, we are going to find out the market price. Let us say, for example, we are getting a market price of 120. So as per our theory, the market price must be equal to what? 120. But whereas the actual market price is 150. So that means what? Overpriced. As per our theory, the market price must be equal to only 120, but the market price is actual 150. Are we going to buy or sell? Sell. For example, while buying a land or something plot or a flat, you will apply some theory, yes or no? For example, while buying a land, you might be having a theory like, for example, outer ring road is coming or nearby airport is going to come. Okay. So shopping mall is going to come or some school or a college is going to come. So the land price is going to increase. So as per our theory, for example, land price must be equal to 1 CR, 1 CR, 1 crore. So but whereas in the market the price is 2 crores, then what we do? We are going to sell the land. Ante kada? If we have a land, we are going to sell the land. Yes or no? For suppose, as per our theory, the price must be equal to 1 CR, land price. But whereas in the market, 50 lakhs only. 50 lakhs only. Then what? We are going to buy. If we have our money, we are going to buy. So whenever we feel any asset, it is overpriced, we sell it. If it is underpriced, we buy it. So this, okay, concept is very important for derivatives also. Whenever you feel the asset is underpriced, you buy it, and if it is overpriced, you will be selling it. Okay, clear? Clear? Okay, are you getting my point? Okay. So for suppose Mohan is going to sell his bike for rupees 2000. So that is the actual price. But as per your theory, the price is what? 10,000. Your theory 10,000, but whereas in actual reality, he is going to sell what? 2,000. So then what? Underpriced. Are we going to buy or sell? Buy. Ante kada. If I am going to sell this projector for rupees 1,000, are you going to buy or not? Yes. అవసరం ఉన్న లేకపోయినా కొంటారు, అవునా కదా? If I'm going to sell this television for rupees 2,000, you're going to buy because it is underpriced. Yes or no? So likewise, if Mohan is asking, okay, Mohan is willing to buy this AC for rupees 1 lakh. Okay, am I going to sell it or not? Immediately I will sell. Yes or no? I will discontinue the class and I will sell the AC. Yes or no? Why? Because as per my theory, this AC must be okay costing at 30,000 or 40,000, but he is willing to pay 1 lakh. I will sell. So if it is overpriced, I will sell. If it is underpriced, I will buy. Yes, Sai Tejasvi, and find me. In book, there might be a wrong concept book, so please correct it. If actual market price is greater than CAPM market price, security overpriced. So what? Sell. Next, the second. What is the second one? So actual market price is actual market price is less than the CAPM market price. Then what? Underpriced. So what? Buy. Underpriced, so buy. Write down the second one. Actual market price is less than CAPM market price. So then security is said to be what? Security is said to be underpriced. Security is said to be underpriced and what? Buy. Security is said to be underpriced, so buy. Clear? What is the last category? What is the last category? Equal. If it is equal, what? Correctly priced. Correctly priced, so hold. Correctly priced, so hold. Okay. Third one, if actual market price is equal to CAPM market price, it is correctly priced. So correctly priced means what? Hold. Okay. Clear? So this is under or overpricing, and this is very important for derivatives also. First, you should understand under and overpricing. So what is this CAPM market price? This is our theory, classroom theory. As per our theory, the price must be equal to, let us say, for example, 120. If in the market it is 150, that means what? Overpriced. Okay, sell. If it is 80, underpriced, because as per our theory it must be equal to 120, but whereas in the market it is 80, buy. For suppose if it is 120, our theory 120 actually is also 120, both are same, so correctly priced. If you have a asset, hold. Okay, so buying or sell will be done if there is under or overpricing, but if there is correct valuation, then what? So nobody is going to buy or sell, but whereas value depends on a perception, so that's why the buying and selling will happen. So on daily basis, buying and selling of a shares happens because the value depends on what? Perception. Okay, value completely depends on what? Perception. So value is not same in every case. So value completely changes with the perception. Yes or no? So that's why somebody may like you and somebody may dislike you. Yes or no? Somebody knows your value, somebody doesn't know your value. That means what? The value depends on a perception. Okay. In your mother's perception, your value might be what? Okay, high. Okay. But the value in the perception of your friend or some stranger, the value is what? Completely low. So value completely depends on what? Perception. Okay. Clear? So in yesterday's question, we have left a small part. State your observation. State your observation. So what is this observation? So for 1213, what is the actual return? Security return, Krishna Limited share actual return. Krishna Limited actual return. 12.24 for 1213. So this part is important because state your observation, what we have to observe. In examination, you may not be able to identify. So here we are comparing what? CAPM return and actual return. What is the actual return for 1213? Krishna Limited, Krishna Limited, Krishna Limited. What is the actual return? 12.24. What about 1314? 32.41. And next 1415. 16.13. 16.13. So these are the actual returns, yes or no? So for 1213, for 1213, for 1213, for 1213, what is the CAPM return for 1213? For 1213, what is the CAPM return? RF 6%. Given in the question, yes or no? Government bonds 6% plus RM. What is RM for 1213? M 10.81 minus RF 6% into beta. So we have a calculated beta in the first part 1.913 914 916. Okay, clear. So we are comparing the CAPM return and actual return. For 1213, if you see the actual return and CAPM return, actual return is less than CAPM return. Actual return is less than CAPM return means security is giving less than our requirement. Less than our requirement. That means what? Overpriced. Sell. It is not meeting our requirement. CAPM means our requirement. CAPM means our requirement. Second case, what is our requirement? 25.76, but whereas actually is 32.41, which is beyond the requirement. So buy the security because it is underpriced. Next, 26.65 is our requirement, but the security is actually giving 16.13. So it is overpriced. So sell. Clear? So this is the observation. So this is the observation. Okay, clear? Done. Are you able to understand this under our overpricing? So there are two. One is comparison of market price. First one is comparison of returns. When you compare return, actually is greater than. If actually is greater than CAPM, then what? Buy. Yes or no? But whereas market price, if actually is greater than CAPM, sell. So do not get confused, okay? First case we are comparing the return and second case we are comparing what? Market price. So first case if you are getting confusion, then what? Better you find out Jensen's alpha. If Jensen's alpha is positive, buy, negative, sell, and 0, hold. Clear? But instead of by hearting, let us apply the logic, then it would be better. Clear? Done. In next class, we shall continue with 11th question. So 2:45. After lunch break, our class will start at 2:45. Okay.